Good morning, everyone. I'm Shauna Smith.
And I'm Dan Roberts. Alexis and Brian are on their way to Davos for the World Economic Forum. This is the first trade for Friday, January 17th.
Well, breaking up Facebook, a new lawsuit wants Mark Zuckerberg to give up control and sell off Instagram and WhatsApp. But could the social network actually be facing a shakeup?
Joining the 1 trillion club, Google parent company Alphabet joins Apple and Microsoft as the world's $3 trillion market cap companies right now. What is pushing that stock higher this morning?
And hello, Peacock. NBC unveiling its new offering in the streaming wars with 3 tiers and a lot of conditions. Why you might not be able to watch The Office unless you pay up.
All right, let's go to check of the futures right now ahead of the opening bell on this Friday morning. As you can see, green across the screen after we just recently hit record highs. The Dow right now, futures up more than 100 points.
Well, it looks like another record day on Wall Street. Well, let's get more detail on what's moving the market in this morning's Morning Buzz.
Emily McCormick is live in the newsroom. Hi, Emily.
Hi, Dan. So housing starts, we just got those crossing the tape at 8:30 a.m. Those results were spectacular. We had those up 16.9% from November to a seasonally adjusted annual rate of 1.608 million, the highest level in 13 years, well above that 1.1% gain to 1.38 million expected. We also saw November's housing starts upwardly revised to a level of 1.375 million. Looking at the December gains, those were driven by the more volatile multifamily building category, which includes apartments and condos. Those rose 29.8% to the highest level since 1986. Single-family starts also posting a strong showing, those up 11.2%. Turning to building permits, those fell a little bit more than expected, down 3.9% month on month to a seasonally adjusted annual pace of 1.416 million. Consensus had expected a decline of just 1.5%. On its face, that's a little disappointing since building permits are a future proxy for home building coming up. But at the same time, this drop was expected, some payback after that very strong November that we saw. Overall, this is supportive of a strong housing market, and it portends a strong showing for residential investment once we get those fourth quarter GDP expectations out in the next couple of weeks.
Emily, we've been talking about the leadership that we have been seeing from tech now for quite a while, it seems. Well, Alphabet, that's Google's parent company, hit $1 trillion market cap for the first time and now joins Apple and Microsoft, those companies. Amazon briefly crossing that $1 trillion mark. How significant do you think this is?
It's huge, and it's really speaking to the discrepancy in the U.S. between these big tech giants and the other players, particularly in the blue chip S&P 500. If we look at these top companies, that's Alphabet, Apple, Microsoft, and Amazon, those now comprise 15% of the weight in the S&P 500, meaning any shifts in these stocks have huge implications for the direction of the market overall. Looking just at Alphabet, shares are now up 40% from a low in June, with analysts increasingly bullish about the company's prospects for ad revenue. This company may have even further to run. Earlier this week, Deutsche Bank raised its price target on Alphabet to a street high of $17.35, saying that the stock trades too cheaply even now. Looking ahead, could be a really strong 2020 for Alphabet.
That's certainly what a lot of analysts on the street are saying. All right, Emily McCormick, thank you. Well, now to today's big story. We are keeping a close eye on Facebook this morning now that it's facing a lawsuit that could force Mark Zuckerberg to give up control of the company. Now, the suit from 4 competitors is accusing Facebook of being, quote, one of the largest unlawful monopolies ever seen. Now, Facebook calls the claim without merit. We have Dan Halley here joining us. And Dan, my big question to you is, do you think they have a case?
You know, this is something, it's interesting because the way they word this lawsuit is hews very closely to what politicians have been saying about Facebook, as well as Google, Amazon, Apple, kind of the whole big tech industry as a whole. And really, these companies seem to be focused more on how Facebook initially said to them, look, come into our platform, become an app, rely on our APIs, our application interfaces, and take data from Facebook to build out your businesses. And then Facebook shut off that faucet and kind of squeezed out those companies. Yeah, it doesn't sound like them, right? Well, it'll be, you know, the idea that they're telling Facebook to not allow or suing to not allow Facebook to combine the Facebook proper, WhatsApp, and Instagram. That's really, I think, the key part of this argument, because that's exactly what regulators are hoping to do. And that's something that Facebook has been planning, because they basically say, look, it'll make it easier for us to do things all around, but it also insulates them from potentially being broken up. So I don't know whether this lawsuit will eventually prevail, but that particular aspect is incredibly interesting.
And you mentioned WhatsApp. News today that Facebook is not going to have ads on WhatsApp. Is that a little bit of a give right now with all the negativity against Facebook? I saw that news and I thought, okay, Facebook is trying to say, wait, see, we're hearing everyone. We can have some parts of our suite of products that aren't so obnoxious.
I don't know, only because we have, their potential cryptocurrency that's still floating out there. Libra. They don't seem to get the idea that when there's a lot of pressure on them, they may want to just take their foot off the gas for a hot second. So that doesn't seem to me to be what the issue is. I think they were more afraid of alienating the 1.3 or 5 billion users that are on WhatsApp, because that's an end-to-end encrypted messaging service. A lot of people, outside of the U.S. rely on that as their primary form of communication, and so they didn't want, I think, to alienate those people and have them flock to another service. Right. They are, however, going to start introducing ads eventually, but it'll be similar to the section of WhatsApp that's more along the lines of Facebook stories or Instagram stories, something along those lines. It's not going to be in the app itself. And they're working more with companies to set it up so that they can speak directly to consumers easier. So I think that's a smarter way for them to do it than just do straight up ads. Don't forget, the ad issue is what drove out the co-founders of WhatsApp, even though they sold, and they left billions of dollars on the table.
Well, and Kevin Systrom gone too. A lot of these people who sell to Facebook, at some point, they become a little disillusioned. Surprise, I mean, Oculus, we've talked about. Another example of Facebook acquisitions where the people who sold, eventually they realized, maybe I can't necessarily achieve all my dreams for my company now that I've sold to Facebook.
Yeah, I mean, it's interesting. I think the idea from this lawsuit of also trying to have Zuckerberg be removed as the primary shareholder, that seems like, I don't think that's going to fly at all. That just seems very out there. But just trying to take a stab in the dark at really anything to get back at them, I think, for hurting these businesses. So, I mean, the idea, though, that they want to kind of, help in the breakup of Facebook, that really is the part that gets you.
Of course they do.
Yeah, I know. We'll see. I mean, I think it also just speaks really as well to the culture at Facebook. We talk about the fact that they're acquiring so many companies. A lot of these founders that you guys were just mentioning decide to leave or are forced out. So it also speaks really to the question, I think, about under Mark Zuckerberg, what the company will be like, not only in just a year from now, but 3 or 5 years down the road.
I mean, stock will keep going up, though.
Oh, yeah. There's advertisers see that people don't leave. So they're just going to say, whatever, here's our money. I mean,
all about the ad sales. In fact, we were talking about how we have a now 4th company that has hit $1 trillion market cap. There's really no other company that's close yet, but I do think Facebook is likely the next one, but it'll be a while. All right, we got to leave it there. Hallie, thanks so much.
Thank you very much.
Coming up here on The First Trade, we'll talk about Schlumberger earnings with Inez Frey live on the floor of the NYSE. Plus, Nissan publishes all the juicy details of its big probe into Carlos Ghosn. Welcome back to The First Trade. It's time for one of today's trending tickers. It's Gap. The retail company has announced it is no longer spinning off Old Navy into a separate public company. And that news sent the stock higher yesterday, and it is higher in the pre-market this morning. Now, the move has given analysts a more positive outlook on Gap, with Bank of America Merrill Lynch and MKM Partners hiking their price targets. Jefferies and Wedbush, however, have both maintained their ratings, agreeing with the decision, but encouraging more improvement. Now, Gap has been a really interesting story because we have talked for weeks or even months about how Gap has been struggling, but they were always able to point to Old Navy as the silver lining. And then there was news that it was going to spin off Old Navy, and people said, well, wait a minute, now you're going to spin off the successful part. And in many ways, Gap right now reminds me of L Brands, where you've got Victoria's Secret, which repeatedly has missed on sales, and L Brands has kind of refused to renew and refresh that brand, even though people have encouraged him to. But L Brands also owns Bath and Body Works, not Bed Bath & Beyond, and that has been doing very well.
That'd be quite.
So you've got one part of the business doing well, and did they spin it off, or is it stronger together?
Well, and what's interesting here is that, so when this was first announced, it was just around a year ago. So that's when Old Navy was doing very, very well. Their sales were strong. It was kind of the bright spot in Gap's portfolio of different divisions. But since then, we've seen the sales at Old Navy slow a little bit. Also, we had the departure of CEO Art Peck. So there was a lot of questions about whether or not this will be the right move. And since Old Navy isn't quite the standout that it was just a year ago, I think a lot of the analysts, as you can see on the street, there were certainly some relatively bullish calls on the company, but I think that's because of the fact that they're more comfortable, at least for now, with Old Navy staying under the Gap.
Hold on to the strong thing you have.
All right, well, let's take a look at what's happening over in Asia. We have Yujin Liu there from the South China Morning Post.
Hong Kong stocks gained for the 7th straight week. The Hang Seng rose 1.5%, driven by a historic trade deal between the U.S. and China. But for investors based in the mainland, the agreement failed to inspire confidence. The Shanghai Composite dropped 0.5% this week. The market was focused on the latest economic data released on Friday. China's GDP expanded by 6.1% in 2019. That is in line with the government's target, but the slowest level in almost 3 decades. However, there were a couple of silver linings. December industrial output came in better than expectations, and so did retail sales. In more cheerful news, the operator of China's most profitable section of the high-speed railway network made a strong market debut. Beijing-Shanghai High-Speed Railway soared 38% on Thursday. Its $4 billion IPO was one of China's biggest in the past decade. That's all from me in Hong Kong. Back to you in New York.
All right, that's the news out of Asia. Now let's head to the New York Stock Exchange and check in with our friend, Yahoo Finance's Inez Frey, for an early look at what is happening before the bell. Hi, Inez.
Hi, Dan. We're watching Schlumberger this morning. This is after reporting their fourth quarter earnings, beating on the top and the bottom line. North American revenue was down 13%. That's really one of the only areas where revenue declined year over year. And this was expected because the company last year had warned that U.S. drilling would see a slowdown in the U.S. Also, for 2019, full year revenue in North America was down 10%. International revenue was up 7%. And looking into 2020, executives say that they're expecting international revenue to increase at the same pace or even higher. Then we're also watching CSX, the first U.S. railroad company to report its fourth quarter earnings, beating on earnings but missing on revenue, with the company citing a softer industrial economy and also coal volumes that were down. So they're citing some coal headwinds. And looking into 2020, executives said in the conference call that it took a while for the industrial activity to cool, and it'll take a while to heat back up. And as they look into 2020 for full year revenue, they're expecting it to be flat to down 2%.
All right, Inez, thank you. Well, let's take a look at what's moving the European markets, taking a look at the DAX, the FTSE, and the CAC, all trading to the upside. It looks like the CAC is the outperformer really so far, up just over 1%. We have Yahoo Finance's Oscar Williams-Groot joining us from London. And Oscar, one thing that's standing out to us today, the pound coming under pressure this morning after some disappointing retail numbers out of the UK. What's the latest?
Well, it's been a dreadful Christmas for Britain's retailers. We've had a string of profit warnings over the last 2 weeks, and now we have official data to back it up. The Office for National Statistics here in the UK said that retail sales fell by 0.6% over Christmas. That was compared to expectations of a 0.5% rise in sales. Now, this is putting pressure on the pound because Bank of America, they're saying it's almost nailed on now that we'll see an interest rate cut at the end of the month. Expectations have been growing. And as a result, we're seeing a sell-off of the pound. It was trading higher than ahead of these retail numbers, but as soon as they were published, it just dropped off a cliff, and it's now marginally lower against both the euro and the dollar.
Oscar, Nissan has also released some of its statements about the probe into former chairman Carlos Ghosn. What are we hearing from Nissan? And I know that Ghosn's camp has also quickly responded.
That's right. It's real tit for tat with this battle between Ghosn and his former company Nissan. Last night, Nissan, the car company, released a 40-page report that it said was a summation of a 10,000-hour investigation into Ghosn's conduct when he was chairman of Nissan. Makes a string of allegations, including underreporting his earnings by over $100 million during an 8-year period, spending millions on using the private jet of both Renault and Nissan for personal business, and also using company funds for things like parties at the Cannes Film Festival, and even spending it on Cartier jewellery. Now, of course, Ghosn's camp dispute this. They say the investigation was biased and just designed to oust him.
Right. All right, Oscar Williams-Groot, thanks so much for the update. And speaking of overseas markets, our team of all-stars is on their way to Davos right now for this year's World Economic Forum. Tune in next week for complete live coverage of Davos right here on yahoofinance.com and also on our app.
All right, well, the amount of streaming services to come to market recently could make it hard for adult consumers to choose what to watch on any given day. And deciding as a parent adds a whole other layer of complexity. So what do these devices need to do to stand out from the competition? Joining us now, we have Epic's CEO, Kevin Donahue. And Kevin, I want to point out, Epic obviously is an education, a technology platform. So you focus on really the importance of education. When it comes to these streamers, there are so many competitors right now in this space. Why is education such an important way just to differentiate some of the products that are out there?
So first, I should say I'm the co-founder of Epic, and my co-founder is the CEO. But thank you. Yeah, I think it's really important that any major media company that's going to have a streaming service must have a direct-to-consumer strategy that involves children and family. And with children's content, what parents want, and in large part beyond entertainment, is really the quality of the content and how beneficial is that content for children. I mean, a lot of major media companies have been able to create great, wholesome family content. Really, Disney is the leader in that, of course, and they have that advantage in terms of capturing that audience and retaining them. But I think a lot of other media companies really need to build up those kids' brands and really work on injecting a lot of really quality into the content that parents will recognize as something that it'll be good for their kids.
Now, even Disney, there are questions about, whether there is a long enough tail of interest from kids who are young today, right? I mean, I know Frozen is huge, but it's interesting because I cover the streaming wars very closely, and a lot of the criticism of Disney Plus has been that all the content, in a way, is old. It's the nostalgia effect, but, is there really enough sustainability there? Even the new stuff, people say, well, it's old because it's either a prequel, a sequel, a remake, a reboot, and I'm just curious your take on that, on whether most parents think that Disney Plus right now is a sort of healthy, safe place to just park the kid in front of.
I think it is, because of Disney's brand. But as I say, with every major media company trying to go direct to consumer, they don't all have Disney's brand. So they're going to really struggle. No matter how much money they're going to spend in the billions of dollars to try to really do this, you can't build a brand overnight. And how are you going to do that? How are you going to reach this audience? And with my company, Epic, what we've done is we use schools for that. We give our product free to schools. We're the leading digital reading platform for kids in the world. And so we've built our audience up to 20 million kids through schools and teacher use and classroom use. So we've been able to sort of boil the ocean of brand awareness within that to reach the consumer and connect to the consumer that way in a very targeted way. So I think when you think about the strategies for digital streaming services around children, they need to think holistically about building relationships digitally, not only just through the content they're delivering, but they might want to also think about partnerships or ways to, through offline communities, reach that kids and family audience.
What are some of the partnerships that would make sense in this space?
Well, I can speak to one, with my company. We have great distribution, very targeted, as I mentioned, of about 20 million kids that we reach. But in addition to that, we have data from 1 billion books that have been read on our service. And the other thing that is going to be needed for the decisions around programming, for the strategy for reaching kids and family and retaining them, is really making the right choices about what kids are truly interested in now. So, we're talking about, is the content old? Is it dated? I mean, there is something to be said about the fact that over time, different things are more in trend and different things are more popular. Now, some things are classic. Disney creates a lot of classic things. But all major media companies are always looking for what's the next big thing that kids are going to be interested in.
I'm fully in support of anything that gets kids reading more. So that's
yeah. So, I mean, reading and viewing great programming. I mean, I think it's all going to be brought together. I think it's very interesting what Amazon has done in the streaming wars. I mean, basically, they don't say that their business is video streaming. I mean, Prime is their business, right? So they try to create a holistic approach to the consumer in a very interesting way so they can deliver lots of different types of value, lots of different touch points with the consumer. And I think that the way that media companies will try to achieve this is through partnerships and really sort of stacking and blending services for families and other demographics.
All right, Kevin, thanks so much.
Sure, thank you.
Well, coming up here on The First Trade, we'll have some news about missile strikes in Iraq, the Australian Open moving forward despite those fires, and Major League Baseball's worst scandal since the steroid era. We'll be back. Stay with us.
Welcome back. Let's take a look at some of today's news bites. Federal prosecutors investigating leaks of classified information have reportedly set their sights on former FBI Director James Comey. Now, several reports saying that prosecutors want to know if Comey gave information to reporters about a document connected to the Clinton investigation. President Trump recently suggested Comey should go to jail. 11 Americans are recovering from concussions following the Iranian missile strike on Iraqi bases housing U.S. troops. Now, the military is saying in a statement. Now, this contradicts what President Trump assured, that no Americans have been harmed in the attack. The injured Americans were taken to U.S. military sites in Germany and Kuwait for treatment. And a shakeup may be about to take place behind the scenes of the Grammys. Chief Executive Deborah Dugan was placed on administrative leave. Now, it happened 10 days before the ceremony. The Academy's board suspended her after misconduct allegations. Dugan is the Academy's first female chief executive. And it's a cheating scandal heard around the world. The Mets are looking for a new manager after parting ways with Carlos Beltran for his role in the Astros cheating scandal in 2017. And even though the Astros were already punished, there's also word that star players Jose Altuve and Alex Bregman may have worn devices that buzzed to help them steal signs. The MLB, though, denies these new accusations. And the Australian Open is still on. That's despite the concern for air quality because of the ongoing bushfires. Now, the first Grand Slam of the season will begin on Monday. We have Rafael Nadal, Serena Williams, Novak Djokovic, and Roger Federer all raising $5 million for victims of the fire. The wildfire has killed 28 people, 1 billion animals, and destroyed 3,000 homes. Well, the opening bell is coming up next here on The First Trade. And here's a look at the action in overseas markets. We'll be right back. Welcome back to The First Trade. We are now a few minutes away from the opening bell. Futures right now are still moving to the upside. We have the Dow up 86 points ahead of that opening bell, just around 90 seconds from now. S&P and NASDAQ also holding on to gains. Well, let's go around the bell with David Nelson. We have Chief Strategist at Bell Point Asset Management. We're also joined by Stephen Guilfoyle, President of Sarge 986 LLC. And Stephen, let me start with you. Another record high day yesterday. Looks like we're going to be moving in the upside direction right now. Could anything stop this market, or is there any challenges, headwinds out there that you see as a potential, I guess, risk going forward?
Well, certainly. As many things could stop this market, just a change in sentiment for one. I think earnings have to catch up to valuation. Whether that could happen one way, that could happen the other way. The USMCA is a positive. The deal with China is a positive. Larry Kudlow speaking about tax cuts 2.0 is a positive for the markets. Whether we get it or not, it's a positive for sentiment going into an election year. The election year itself is a potential negative. There's so many situations. Plus, besides the political, you have the geopolitical. So yeah, you have to protect yourself. I'm probably at higher cash levels than I like right now because everything's been hitting target. And when I move the target, it hits it again and again. In fact, right now, I have positions without targets, which is a cardinal sin I have never done in 34 years in the business because I don't want to be down to zero on these longs.
Right, up, up, up. And David, in your note you sent us this morning, you were talking about how markets have shrugged off so many headwinds, and that's true. I wonder what could happen that markets wouldn't be able to shrug off because Iran was no big deal. Trade deal kept getting delayed. That was no big deal. Now we got the phase one deal.
Yeah, the bad news is that there's just too much good news. You know, I'll give you a couple of things to worry about.
Let me stop you real quick. We're just showing the opening bell on Wall Street. You can see the opening bell at the New York Stock Exchange and the NASDAQ right now, signaling the start of the trading day.
And here, real quick, let's bring you some of the headlines that we are watching on the first trade front page. We have housing data is the first on our list, and it was a home run. Now, December saw housing starts surge 17%. That's a 13-year high, but building permits did fall 4%. Plus, we're also looking at Facebook because the company is under fire. The company is being sued by a group of app developers saying that Mark Zuckerberg should give up control. Facebook calls the suit, quote, without merit. Facebook is also reportedly not putting ads on WhatsApp. That's according to a Wall Street Journal report. And the Prime Minister of Ukraine is resigning. That's because he was caught on tape saying that the country's president doesn't know anything about the economy. A potential problem there. So, of course, those are some of the three stories that we are watching today. But let's get back to the markets because, David, it is another move to the upside.
Yeah.
When you take a look at what we got in that phase one trade deal, was that enough? Were you happy with what you saw?
It was actually better than I thought. And I thought the elephant in the room for that was the fact that China capitulated and that the tariffs are largely still in pace. That speaks volumes to their economy. They must have been really struggling. That 6% GDP that we saw coming out overnight, I question that. You know, sometimes with their numbers, I don't know whether to put a plus or a minus sign in front of it. So there's a lot of things for us on our plate right now. The bad news, as I said before, there's so much good news that everybody's piled into one side of the boat. I'll give you two things to think about. The Fed is adding $100 billion a month to the balance sheet, telling us it's not QE. Trust me, it's QE. And the other thing is to Stephen's point. You know, we're heading into an election year where we're going to challenge an economic system that's been in place since the dawn of the Republic. That should spook investors. At some point, there's going to be volatility, at least at the sector level. Healthcare, energy are just the top.
Well, and do you agree with the political take a lot of people seem to have, which is that if the candidate in 2020 is Elizabeth Warren, then markets should be concerned. Otherwise, should continue apace.
Yeah, if it's a centrist, you know, somebody like a Joe Biden, I think the markets will follow the economy and earnings in that order.
All right, let's bring in Jared Blicker. He's standing by at the Wi-Fi Interactive board. And Jared, it looks like another record day on the street.
Yeah, all the indices open up at record highs here, and these are the sectors in the S&P 500. Tech leading the way for the second day in a row. Communication services, financials, discretionary. So pretty cyclical base rally that we have going on. Materials and industrials leading to the downside. We did have some negative earnings in terms of the transports as well. Those are a little bit underwater. But here's the Dow heat map. Here, Apple is up about 0.25%. Microsoft, another record high, up 0.4%. Visa, Procter & Gamble, lots of record highs to discuss. Only IBM really leading to the downside here, 1.2%. And just to talk about, this is options expiration day, by the way. So we have index options rolling off on the open. It looks like the S&P 500 was getting pinned at 33.25, and now it has some freedom to move. Nomura is estimating that about one third of the dealer long gamma position is rolling off. So what that means is we could have more volatility. The indices have more run to room as we develop throughout the day and also going forward into next week. That doesn't really flip short until we get all the way down to 3240 in the S&P 500 or all the way up to 3400.
Sarge, Jared mentioned tech there, and of course, tech. It wasn't very hard to predict that 2020 would be another year when tech names would lead the way, but we talked earlier in the show about Alphabet hitting that $1 trillion market cap mark. Do you expect more trouble legally for these big tech companies, but will that actually affect their stocks in 2020?
I do expect more trouble legally. I don't expect it to impact the stocks long term. Going over what you just said and what Jared just said about those transports, don't pay too much attention to the numbers you saw from KSU and from CSX, all right? Efficiency is fine. If the Chinese really buy all the stuff they say they're going to buy, cargo is going to move, they're going to be fine.
David, one thing coming out this morning, Boeing, Bank of America was saying that Boeing could take another big, ugly charge for the 737 MAX, could be as high as $20 billion. When you take into account the fact that investors have been able to shrug off Boeing's, I guess relatively shrug off Boeing's problems so far. Do you expect that to continue, or will something like this finally get?
I think what investors understand with Boeing is it's a duopoly, and they understand that Airbus, even if they got all the orders, they can't manufacture the plane. So Boeing's going to come out of this at some point. I think the message now, is that we're learning now this plane should have never even have happened. It's pretty clear at this point that they extended the flight envelope too far, and they had to put a fix in there. And it's unfortunate. Boeing made a lot of mistakes here. It's going to take a while to turn this around. The question is, even if they get this plane back in the air, what's going to get passengers back on the plane? You know, will passengers work around that and try to book other ways?
It's funny. You know what's going to save them? You know what's going to save Boeing? China Phase 1. All right? They have to buy a lot of manufactured goods from the U.S. The U.S. doesn't make a lot of manufactured goods, but Boeing, when things are operational, makes expensive stuff. And China needs to buy it.
Well, we've also talked about how Boeing, in a way, is sort of too big to fail. I mean, it's been a Teflon trade because who's a competitor to Boeing? There's only Airbus, and they're not at the same
Plane
level.
Still isn't in the air yet.
You gotta fly.
The black swan event is if this plane does not fly.
Especially through the summer.
They should re-release that plane when it's fixed under the McDonnell Douglas banner.
You know, the president was right. He actually told them to rebrand the plane and offer something new on it. The fact that they're going to name this the 737 MAX, they should do something about that. Marketing 101.
I guess, but then just stepping back and just talk, because we could go on with Boeing forever and ever, but talking about what we're really seeing in the market, Stephen, we've seen this rotation out of momentum names and into value stocks now for a little bit here. Do you expect, is that a smart trade, do you think, in 2020?
Yeah, I do think the industrials rise. I do think you have to watch the spread between what 3-month T-bills yield and what the 10-year yields, not just for the inversion for the sake of a possible recession, but this is what's controlling sector rotation. This is why you saw defensive names outperform the last few days, and the expansion in that spread is why you're seeing the techs and growth type names suddenly perform better the last 36 hours.
I've been making that call for the last decade right now. Growth has outperformed value by over 100% in the last 10 years. At some point, reversion to the mean takes over. If Apple came back 30%, it would still be in a defined uptrend at this point. That's how far extended.
That's one of my stocks without the target.
Yeah, Apple has been a wild story because, you know, everyone's talking about the super cycle, and I feel like it's been a little, the hype is now overinflated about 5G because we're already hearing reports that the Apple 5G phones could be delayed even into 2021, and yet everywhere you look, analysts putting out super bullish notes on Apple.
You saw the TSM numbers, right? Taiwan Semiconductor. That's supportive of the fact that Apple's at least spending on this. So, I mean, yeah, their CapEx is higher. Let's hope they can turn it into dollars.
Let's go back to Jared Blickery at the touchscreen. Jared, what else are you watching today? You talked about tech earlier.
Yeah, well, I was just looking at the 10-year T-note, and to Sarge's point here about the sector rotation that's been going on. So this is a 1-year chart of the the 10-year note here, and we can see that it's been consolidating for the last 5 months. 2 days ago, it was threatening to break down through this wedge here, and the longer-term direction is definitely down, and that could point to a sub 1% T-note yield, if you can believe that. However, if it breaks to the upside, it could easily get to 2.5%. That's going to determine a lot of the flows, whether it's going to be into the momentum names, if it goes to the downside, or if it goes into the value and cyclical names, if it goes to the upside. Regardless, stocks have been participating in the rally no matter what the T-note yield has done, and some of those include the stocks, the chip stocks, which have done phenomenally well over the last year, up 60–70%.
The key is the Fed keeps anchoring those short-term yields. All right, as long as they keep doing that, the longer-term yields can trade in the free market.
Well, and when we talk about just the overall markets right now, I mean, it's another day, like I said before, it's another record high. David, when we had the Dow above 29,000, the S&P holding above 3,300, do you think that market is expensive, or are you still finding some value out there, reason to buy?
Ask me in 3 months. To Stephen's point earlier, at this point, what has to happen this time, earnings have to deliver. We can't go another leg higher on multiple expansion at this year. Too early in the game. We've had a good start. J.P. Morgan, that was a great number. Morgan Stanley, a good number. Big miss from Target, but I think that was largely company specific. They talked about electronics. I don't go to Target for electronics. I go to Best Buy or Apple.
But they didn't change their numbers, Target. Interesting. Cornell hung tough on that.
Well, and Target was our company of the year, actually, in 2019. And, you know, we saw a lot of notes coming out that, okay, yes, Target missed, but a lot of it is, look, Target did say they were going to be investing more in stores and spending more. And I think a lot of people are still pretty bullish on how Target has done, especially compared to Amazon. I mean, I think if you asked about Target 4 years ago, people would say everyone is running scared from Amazon. Now Target kind of giving Amazon
There's competition in the online space right now. It's not just Amazon anymore. Some of these companies are going to survive. Some of these companies got it. They invested a lot of money. It's taking them a long time to catch up. They'll never better catch Amazon, so to speak. But a lot of other companies will fall away. That business will go down.
And they don't have to sell a lot of toys in January and February.
Yeah, that's true. Stephen, are you seeing any, I guess, opportunity in some of these retail names? We talked about a lot of the big focus on e-commerce, but then there's also the names like Kohl's, JCPenney.
Right.
JCPenney is not really a great example.
I thought they're all dead.
Macy's that haven't been doing quite as well.
Macy's is the home run in the that's shrouded. You can't see it just yet, all right? Macy's has a New York Stock Exchange Investor Day on February 5th. They're going to unveil their next 3-year plan because the last one was such a success, all right? So this time, they're actually going to try to act on that. What I expect is, this is just me, this is conjecture, I'm not in Jeanette's head, all right? I expect some kind of move on the real estate. They're going to try to capitalize on the real estate, produce a whole bunch of capital. Maybe hey, if I'm Macy's, I build up at 34th Street. All right, I sell apartments, but hey, that's just me.
You're getting into a whole new business.
Want to live in Macy's housing? Right.
The yield is down to 8%, guys. Right. It was 10%.
Yeah. All right, we got to leave it there. Stephen Guilfoyle, Sarge, thanks so much. David Nelson, thank you. And thanks to Jared Blickery, who was at the touchscreen. All right, we're just a few minutes into the trading day. Let's see what's moving the markets here at the open. Let's check back in with Yahoo Finance's Inez Ferre at the New York Stock Exchange. Hi, Inez.
Hi, Dan. We're looking at one of the transport stocks, J.B. Hunt, under pressure this morning, down more than 4% after missing on the top and the bottom line, citing some of its segments. J.B. Intermodal for the fourth quarter revenue for JBI came in flat. Also, its truck segment revenue was down 20% for the fourth quarter. It cited some of the headwinds, including increased rental prices, expenses, also lower gross margins for one of its businesses, and some IT expenses as some of its drags. And then also looking at Jumia, yesterday Jumia was up more than 25% after the company named a new commercial officer, Kenneth Ayola. The former CCO will now become CEO of Jumia Ghana. Now this stock has had quite a journey since the company went public last year. Its IPO price was at $14.95. It gained 75% on its first day of trading. Then back in May, you had Andrew Leff from Citron, which basically accused the company of fraud, saying that it had some discrepancies in its SEC filing. Since September, this stock has been trading below $8 a share with a low of around $5 a share.
All right, Inez, thank you. Well, we are getting new details on one of the newest entry, or the newest entry in the streaming wars. We have Comcast unveiling much more about NBC's planned Peacock streaming service. Now, it will include 3 tiers of free option with ads, a $4.99 a month premium version with ads, and a $9.99 a month premium version that's ad-free. And that's just a few days before Netflix unveils its latest earnings. Let's talk much more about this with Tuna Amobi. He covers the streaming space at CFRA. And Tuna, when you take a look at what we heard out of Peacock yesterday, the 3 different tiers, one thing that stuck out to me is that their premium version will include sports. That's one differentiating factor when we stack up all these streaming giants against one another. Do you think there's room for this many players in the space?
You know, so yeah, absolutely. I think the sports offering really is something that really will set this service apart from others, as you rightly alluded to. But the streaming space has gotten very, very crowded, as you know. Our sense is that Peacock is going to have a better than long shot to become one of the viable players just because of the resources of the parent company and also the content. My concern, though, is that, the route to profitability, typically gets bumpy. That's something that Wall Street will be watching closely. They've talked about 5-year break-even plan. Not too unsimilar to what Disney's talked about. On the flip side, they're talking 30 to 30 million subscribers in the first 5 years. That number, if you consider Comcast and Cox subscribers, some 24 million that could upgrade, right away could seem very conservative. So there's various moving parts here.
Tuna, Dan here. Thanks for coming back on. I'm glad you mentioned profitability because I had the chance to sit down with David Zaslav of Discovery a few weeks back, and he was saying, now, of course, he's hardly the only person who has said this, but he was saying that right now you're seeing new apps, and then in about 3 or 4 years, you're going to see a lot of those newer streaming offerings shut down or close or some kind of consolidation. There's so much spending right now, and a lot of these things, as you mentioned, are going to take a long time to achieve profitability. So how long will that cycle be before we see, instead of new apps and new offerings, we'll see the field shrink again?
Right, that's a great question, and one that we keep an eye on. Obviously, I think there's going to be an inevitable shakeout of this space. Whether that happens in the next 2 years or 5 years, remains to be seen. One thing I know is that the major conglomerates that have the major studios and content and resources to be able to weather the near-term losses for these startups, I think are more likely to stay in the game longer term. Sooner than later, though, some of the mid to smaller tier players could be, in fact, rolled up by the bigger players. And in fact, that's already happening right now when you see names, shut down like, View, etc. And remember, this streaming battle is not just playing out on the content side. It's the same thing on the device front, across all genres. So that's why we really think that this is going to be something to keep an eye on over the next year or two to see who survives.
Tuna, let's talk about the prestige element here, too, because Netflix was up for so many Golden Globes and kind of crushed the studios with nominations. Then it only won a couple, and everyone said, oh, tough night for Netflix. Now we got the Oscar nominations, and Netflix is up for 24. But a lot of times people say, look, it's not really about awards, and yet everyone pays attention when you don't win many awards, when you had a lot of nominations. So how important are awards for these streaming services? Apple also had a rough time at the Golden Globes, had a couple nominations, didn't get any.
It's incredibly important. I think the way to think about it is not just the impact to the bottom line. I think the buzz that you generate, the brand building impact of these awards, the fact that you're able to leverage that into, more to extend your relationships with the Hollywood talent. I think you see a lot of directors and actors and actresses now willing to work with these, streaming studios because they understand that, the visibility and the flexibility that they get kind of outside of the normal, Hollywood system is quite attractive to these marquee and, A-list, talent. So that's what the award gives you, the ability to build your brand and get flexibility and expand your relationships. And I think if you're Netflix, it's really kind of, for the most part, worked out very well for them, despite the, as you alluded to, the wins. I mean, this quarter is going to be huge for their film, releases, whether it's kind of Irishman or Two Popes. And I think you've seen Netflix kind of moving towards that hybrid model, despite the resistance that they're still facing from the theaters. So I think the award season is incredibly important for the streaming players. That's why you see Amazon and Apple, everyone else trying to get a leg up in this.
Tuna, we're going to get results out from Netflix next week. Lots of questions about whether or not we're going to see subscriber growth underperform. That's been what some of the bears out there on Netflix have been warning about. What are your expectations?
So we know they guided to 7.6 million globally, 7 million internationally, and 600,000 US. I mean, my sense is that they're going to hit those numbers. I mean, if Q3 is any indication, I don't think the impact of streaming is going to start to have any meaningful impact until perhaps the second half of this year. I know a lot of investors have been kind of, some have been running for the exits with the streaming wars intensifying. I think the more important, number is going to be the Q1 guidance for this year and potentially any commentary for the rest of the year. Qualitatively speaking, last Q1 in 2019, they did 9.6 million globally. Now that could be a tall number to beat. So I think we're going to be watching very carefully for any commentaries that could signal that the competition is finally starting to have an impact. Our sense is that Netflix is going to, be one of the, potential, one of the potential streamers that are going to be left standing when all is said and done.
Yep, a lot of competition. Tuna Mobi of CFRA, thanks for joining us.
Thank you so much.
And we'll be right back here at The First Trade.
now for a look at some of the companies in stocks the Yahoo Finance team is watching for you today. Fiat Chrysler looking to work with Foxconn for a joint venture to build electric cars in China. Now, the two companies confirmed that they are in talks to develop new battery electric vehicles. Each would own 50% of the joint venture. Wingstop looking to expand to 6,000 restaurants, more than 4 times what they currently have. The company says that fourth quarter sales surged 12.2%, beating expectations. Now, Wingstop also saw its 16th year in a row of same-store sales growth. The stock has skyrocketed over 250% since its IPO in 2015. Amazon looking to make a big splash in India, plans to add 1 million jobs there by 2025. This comes a day after the country's trade minister said that Amazon would invest $1 billion as well. This is all happening as Amazon and Walmart face criticism from smaller retailers in the area for unfair business practices. Well, coming up here on The First Trade, another company getting into the meatless burger craze. We'll tell you who after this break.
Welcome back to The First Trade. Let's take a look at one of Yahoo Finance's trending tickers right now. It's Sysco Corp. Shares of Sysco are moving after the global food service distribution company announced the launch of its Sysco Simply Plant-Based Meatless Burger. Sysco jumping on that fake meat bandwagon. The patty is a vegan, gluten-free, non-GMO soy patty with 18 grams of plant-based protein per serving. Shauna, what do you think? Not Sysco,
it makes sense.
The tech company, Sysco, the fake meat
It makes sense.
pusher.
We hear all the time from a lot of these big bangs from the analysts that this is a huge total addressable market.
Yeah, they like
JP Morgan
it.
alone saying that it could grow to $100 billion in 15 years. Barclays saying $140 billion in 10 years. So to me, it makes sense for these companies to try and jump on here and make some money off of it.
It's funny, when this first started, and it was only, a year ago that all this kind of erupted, it started to feel like every new announcement was just someone getting into the gimmick. Now it feels like a necessity. Like, if you ain't doing fake meat, what are you doing?
Yeah, you're missing out. And I guess I'm potential money there. So, all right, guys, time to move on because we only have a little bit left. Microsoft taking aim at Slack. The tech giant is running a new ad for its work messaging service Teams. Yahoo Finance's Dan Halley is back with us. And Dan, do you think this makes sense? And how big of a threat is this to Slack?
Oh, this is a huge threat to Slack. Teams, it was interesting in the run-up to Slack's IPO that everyone was so hot about it because Teams is built into Office 365.
And it's bigger, isn't it? Doesn't it have more users?
It's much bigger, yeah. So this is a big deal. I think Microsoft is really now working to get the name recognition of teams out there. And I think once that starts to really kind of take over, it's going to be an even bigger issue for Slack. Slack is hot among the younger set, I would say, people who are in development and media for whatever reason. We got into it. And yeah, we use Slack. And, you know, I like Slack.
And was the biggest proponent of Slack.
Yeah, well, we were using, you know, something else
we
before.
had something else, and I said, we got to get on Slack.
It was not
I got to ask you, though, you know, some people think that Microsoft Teams is such a problem for Slack that it could be like a Slack killer. Could we see something really shocking like Slack, even though it went public through a direct listing, sell?
That would, I mean, see, I don't even know if they would want to sell. I don't know if Microsoft would want to buy, or they could potentially sell to someone else entirely.
Right.
Perhaps maybe even someone like Google, because Google's messaging service isn't all that great compared to what you have from the competition. So
Hangouts?
that would, that would make a lot more sense for someone like Google. But Microsoft, you know, they already have this built out. This works with Skype. You get all your Office stuff in the app itself. So if someone sends you an Office document, you can open it within Teams and then edit it together.
See?
So this is
interoperability.
Yeah, this is, I think for Slack, this is their biggest existential threat.
All right, Hallie, thanks so much for joining this morning. Well, that's it for the first trade. I'm Shauna Smith.
And I'm Dan Roberts. And before we go, let's get one more check of the markets with Inez Ferre. She's live on the floor of the NYSE.
Dan, Shauna, record highs for the markets this morning, and we're looking at Dave & Buster's up more than 13% this morning after an activist stake from KKR, with KKR reporting that it now has a 6.3% stake in Dave & Buster's, that it has held talks with management, and it's considering further talks with management. So Dave & Buster's this morning really seeing a pop on the heels of that news. And then we're watching Alphabet, the parent company of Google, after it joined the Four Commas Club, joining Apple and Microsoft as a $1 trillion market cap company. Amazon was also a $1 trillion market cap company, and then dipped a bit below that line. Right now, we're looking at the Dow that's up more than 30 points. The S&P and the NASDAQ are also higher. We've got most of the sectors that are in the green, with financials leading the gains, as well as communication services. Those are also higher today. Make sure to stay with us, because On the Move is next. They'll be discussing these record highs. Stick around.
It is 10 a.m. here in New York City. We're about 30 minutes into the trading day. Stocks are rising. You know what that means. records yet again. We'll be talking about it. Trade takes its toll. China's newly minted Phase 1 trade deal with the U.S. does not come soon enough as the country sees its slowest economic growth in nearly 30 years. $1 trillion club. Alphabet becomes the latest big name to hit the valuation, joining the likes of Apple, Amazon, and Microsoft. And change of plans. Gap shares are now falling. They had been rising after the company cancels plans to spin off Old Navy. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We're going to head to the floor of the New York Stock Exchange. Yahoo Finance's Inez Ferrer is standing by. And you're looking at shares of CSX. Tell us about this.
Adam, CSX is off fractionally right now. In pre-market, it was down about 2%. This is after they beat on earnings, but the company missed on revenue, citing a softer industrial economy and also some coal headwinds with lower coal volumes. Looking into 2020, the company says that it took a while for the industrial economy to slow down, and it will take a while for it to heat back up. And looking at a full year revenue for the company, they're saying that they're expecting it to come in flat to down 2%. Meanwhile, we're also this morning watching Schlumberger. This is after their fourth quarter earnings, beating on the top and the bottom line. Their North American revenue was down 13%, the only area where revenue was really down. And of course, this is expected. Schlumberger had warned about this back last year, saying that U.S. drilling in the U.S. would see a slowdown. For 2019, full year North American revenue was down 10%, and international revenue was up 7%. And looking into 2020, the company says it's expecting international revenue to increase at the same pace or even a higher pace. Adam, Julie.
Thanks, Inez. Let's hone in on the markets a bit more, as it is a record week for U.S. stocks, which are trading higher, as we just talked about. Sentiment getting a boost from overall positive earnings news as major banks showed off results, as well as the initial U.S.-China trade deal, of course, being signed. Let's bring in our panel for the next 90 minutes to talk about what has been going on with stocks. Yahoo Finance's Jared Blickry is with us, and Julian Emanuel is BTIG Managing Director and Chief Equity and Derivatives Strategist. We've had these periods of time before. We had it last fall as well, where it seems like day after day after day, stocks are just going to records, the so-called melt-up, as a lot of people have called it. What can freeze the melt-up, though? I mean, are we going to keep going?
Well, look, if you think about the context of the last sort of 30 to 60 days, the market is overbought in the near term. And by that token, you know, bad news could, in fact, be bad news for the first time in some while. I mean, you know, we are about to go into a much more volatile political season with the impeachment trial on full display, and then the primaries starting up. Obviously, there's still a bit of overhang in the Middle East, no matter what anyone may think. That's not resolved. So the market is potentially vulnerable near term. But longer term, the fact that we could actually get to this level of overbought, and if you think about the reasons why, essentially a turn in sentiment, the bond markets sending the signal that the world is not likely to have a recession in 2020, and the Fed completely getting behind the markets by steepening the yield curve, by re-expanding the balance sheet. The backdrop is really quite favorable for stocks, even from here.
Okay, so this question is for retail investors. Help us understand. A lot of this is driven by institutional money, and we are susceptible, if you're a retail investor, almost as if we're following that trend. And if we're overvalued right now or overbought, how does a retail investor make a decision going forward? Because that makes me nervous. Now, I'm not as skilled at this as you are, but if I'm an individual out there, what do I do to placate that fear? Because I don't want to lose my money.
So the retail investors really should have a very long time frame in terms of their considerations. Essentially, we have said the entire course of this rally that you want to have stock holdings such that if you get a 10 to 15% pullback, which have actually been normal course of business over these last 11 years, you want to envision yourself as a buyer and not a seller or a hedger. So from that perspective, you look at your portfolio, you think about how that might unfold. If you've got a little bit too much stock, trim. If you feel like you're underinvested, you don't get to your weighting on day one, you try and be disciplined about it. And to the extent that there are dips, a little bit more aggressive in the dips.
I want to turn to Jared on this. Jared,
Yeah.
I know you look at market technicals a lot and indicators.
Love them.
I've been watching the transports, right? The Dow transports, which have been rocketing up along with the rest of the market. But you have some stuff that's maybe not such great news. CSX disappointing today. That stock is down. A couple of the logistics companies, Expeditors and J.B. Hunt, disappointing, heading down. Is there any reason for concern on that front?
Well, I was talking to Sarge about this. He was on our last show, First Trade this morning, and he said he really dug into these reports. He said, don't worry about the headlines in a couple days. See what they do on the close today, and also consider that this is options expiration. Some funny things can go on with individual stocks and the indices, which expired. Those options expired on the open. But you were talking about a potential 10% correction. That would only take us down to the October highs, and that would be perfectly normal. That would be perfectly fine. The markets are kind of approaching a crossroads right here, and I'm going to be talking about this at the touch screen. The VIX is consolidating, the 10-year T-note yield, that's consolidating. Things are going to break out, and whatever the direction is going to determine whichever groups of stocks, the sectors and the factors outperform over the following months.
Okay, a lot of people are going to be looking for that in just the next few minutes, but right now we want to talk about China. The nation's officials say that its economy expanded last year by 6.1%. And that is well within the government's target range of 6% to 6.5%, but it marks the lowest level of expansion in nearly 3 decades. So, Julian, this comes after China signs the trade truce with the United States. Can China reignite the spectacular growth it had in years past, or have they reached that point where this is going to be their, I hate the term, new normal, and maybe even at some point 5% growth?
So the challenge with China, the old reignition of the old growth, 6, 7, 8, 9, 10%, that's not happening. I mean, that would be saying that, you know, the U.S. could start growing at 5 or 6% once more. That's not happening. But the point here is that China, thus far, is making I wouldn't say successful because there's a long way to go, but is so far doing a reasonable job of making this transition from an industrial-led economy to a consumer-led economy. And what sort of may be obscured in this morning's figures is the fact that actually auto sales increased for the first time in quite some time. It wasn't a huge increase, but it was an increase nonetheless. And that tells you that the consumer is starting to be the focus, that the Chinese stimulus measures are directed toward the consumer, and importantly, and very much missed since trade tensions started coming, ratcheting down, the Chinese currency has appreciated rather materially. No one's really talking about it or paying attention to it, but that's actually a benefit for the consumer.
Yeah, I would agree with that. And I've focused not only on the currency, but what the PBOC is doing over there. They've been easing in a number of ways, not only lowering the reserve requirement for banks, but they also changed the benchmark interest rate, would actually amounted to a de facto rate cut. You throw in what the government is doing, cutting taxes, trying to encourage lending. They're putting a lot of fuel on this fire. And still they haven't been able to get the Shanghai Composite above its previous peak. But you have stocks like Alibaba, Tencent, some of the big guys finally breaking out. And this could be a big turnaround for them. Is it sustainable? Is it bubble-like? Well, that's a problem they might have to deal with in the future because they've had to deal with that before. But they're doing everything they can to encourage growth right now on all fronts.
Yeah, so we'll see what happens with phase 2 as well. Let's turn to big tech and then there were 4. Google's parent company Alphabet has become the latest company to hit a market cap of $1 trillion. It follows tech rivals Apple, Amazon, and Microsoft, although Amazon is not there right now. Of course, we've seen this long rally that's been going on in FANG stocks. Amazon now, I think it's around $800 billion in its market cap. Google reached its latest numerical milestone as it's facing some of its biggest tests, including stricter regulatory scrutiny, both in the U.S. and around the globe. But nonetheless, it hasn't really slowed it down much. Jared, when you look at the FANGs and their importance in the overall market, I mean, there's been a lot of talk about them falling in importance, but in reality,
no,
they haven't diminished too much.
Every time they're counted out, they make a huge comeback. Whenever the market is powering higher, they're generally a big part of that. And when they aren't, the market tends to languish. The only one that, and you mentioned Amazon, around about $800 billion or so.
Only 800
Only.
billion.
Yeah. That's the only stock that's really been lagging. It kind of broke out a few weeks ago, but And it has some headwinds in terms of having to spend money. And I think once it gets over that hump in the next few quarters, it's probably going to have another good run. But one by one, they've taken their turn. They don't necessarily move as a group anymore. The one that's been kind of down and out is Netflix. I think it's underappreciated right now, and Disney has got, everybody thought Disney got the huge leg up on it. I wouldn't be surprised for it to have a nice earnings announcement. I believe it's next week. So
Monday.
Yeah, we'll see.
Just to put it in context, I mean, Tesla's only 83 billion in market cap, and they're the largest automaker in history of the United States. But is it fair to ask the question, I don't know if you can address this one dead on, Julian, but who might be the next member of the $1 trillion club?
We'd rather not speculate, although I would say that, to what Jared just said, you may have a return trip for one of the members of FANG. But more importantly, what the issue is it's nice that we're actually being somewhat blasé about the $1 trillion club, because there are multiple members, and it just really points to the overall strength in the market. And the fact is that not only FANG, but technology's reacceleration over the last several months tells you that people were petrified for a while about buying growth late summer and early fall because of the turn in interest rates, putting a compression on high multiple stocks. That's no longer the case, because even though rates are likely to head higher, it's a gentle thing, not a spike.
Interesting. And I should mention Netflix, by the way, is Tuesday, not Monday. I misspoke.
Okay. No problem. Let's talk about Gap, because that company announced it's calling off plans to split Old Navy into a separate public company. The company also announced President and CEO of the Gap brand, Neil Fiske, is stepping down. In a press release, interim CEO Robert Fisher said the change of plans come after the company realized, and this is a quote, "The cost and complexity of splitting into two companies limited our ability to create appropriate value from separation." Real quick, maybe, when we talk about retail being dead, there was Old Navy actually was doing well compared to some of the other Gap brands. Is there a way to keep all of this, they obviously think there is, as one, and then grow it the way maybe a Target has done it or the way a Lululemon's done it?
I think that they've said they're looking for an operator in a CEO. I think that's a big problem, because that means they're not going to be innovating as much. They want to squeeze the juice out of these companies, unlock a little bit of value. That kind of incremental thinking is not going to save this company. Even Old Navy, which is supposed to be the crown jewel, has negative comps right now. That's one of the big reasons why they're not selling it off or spinning it off. I question their long-term strategy right now. Fisher is the interim CEO. He's the son of the founders. He might be just a little bit too close to this to make a rational decision for the company.
I mean, if you look at, speaking as a consumer and also as somebody who's covered retail, really Gap's issues are manifest. And if you look at them versus other retailers, it sort of throws it into relief. If you walk into a namesake Gap store, try and find somebody to help you. Okay, it's not easy.
They were the pioneers, I think, of saying hello to you. So.
Yes, and they're not adequately staffed versus someplace like a Lululemon. And it's really a fashion issue as well, and that has been an issue for a while. So when they say they want to get somebody in who's an operator, if you're not making clothes that are on trend that people want to buy,
wasn't it 20 years ago they had those hip ads where you'd see people in chinos and black T-shirts dancing?
Dancing, yeah.
That was, but that's my generation, and that's 20 years ago.
Yeah, there's so much competition at that price level, and that's another reason why Old Navy is kind of a spin-off candidate, because it is such a different business. I question the long-term strategy. It's going to depend on who they pick as the next CEO. Unless they can innovate and get into digital in a big way, I think, and really get some product enhancements that people are excited about, nothing's going to happen. They're just going to end up closing more stores.
All right. Well, coming up, playing the stock market granny style, our next guest has some off-kilter picks that can score big returns, he says. Plus, before we go to break, let's take a quick look at some of the biggest winners in the Dow today as it pushes higher. Home Depot is on the rise once again.
Another day of record highs. It's 8 in a row for the Dow and also actually the S&P 500 and the NASDAQ. Welcome back to On the Move. I'm Jared Blickery. We got the Dow up only 25 points, 9 basis points, but it's enough for another record. S&P 500 up 15 basis points and the NASDAQ up about the same amount. So we're going to take a look at a chart and let's turn this into a candlestick. This is a 3-month chart. Again, we have some support down here. If we do take a downturn in the markets, that comes in at about 32.15 or so. Right now, we're at 33.25, so that's over 100 points to the downside in the S&P 500. It is OPEX day. Typically, we do tend to see lower volatility in these days in the indices, but going forward, we might have a little bit more because we have some Dealer Gamma positions rolling off. Let's take a look at the VIX because this is a key chart that we've been tracking, and we're going to go to a 6-month, and so we can see that it's been consolidating ever since we have this big trend line down here, and to the bottom we have this support line down here around 11, 12, and eventually there's going to be a squeeze. And I think when we break out, we're finally going to see that top in equities, and finding the bottom, well, that's going to be a matter of how high it actually does go, but we'll have to wait for that. 10-year T-note yield, that is up today, up 3 basis points. This is another market that's been consolidating over the last 5 months or so, threatened to go to the downside a couple days ago, and where it finds itself when it finally breaks out of this is going to probably determine what sectors, what factors outperform over the coming months. Will it be momentum and growth, or will it be value and cyclicals? Stick around because we're going to be back in 1 minute.
Our next guest is looking at markets through the lens of basketball. Tom Lee, Fundstrat Global Advisors Managing Partner and Head of Research, says granny shots, you know those underhanded free throws, well, they may not look good, but they score big points. So tell us what your granny shot stock picks are. And I have to tell you, when I heard the term the first time, I was thinking of, senior citizens who are women actually doing Jell-O shots. So set me right.
That would be amazing.
Yeah, that might be a better, visual. Yeah, so granny shots are thematic-based stock picks. So we have 3 general thematic views about the next few years. One is millennials, another's on AI, another's around automation and asset heavy. And then we have some tactical portfolios. And what Granny Shots is doing is taking stocks that appear in multiple lists. So we think it's improving your chances of picking outperforming stocks. That's why it's not cool, because we're not using like one cool model, but it's higher risk reward opportunities. Higher reward risk opportunities.
So basically you want to increase the chances that the stock is going to do well. And the analogy you used, you were looking at Rick Barry, who was a player who threw like basically underhanded, right? Versus other players who don't have, like a Shaquille O'Neal, who wasn't a great free throw thrower.
Yeah, so it doesn't look great. So Rick Barry, so mechanically the best type of free throw to do is underhanded, because it's the best way to do it from a physics perspective, and he is, one of the best free thrower percentage in history, and he doesn't look cool when he does it.
Right.
When he did it.
You can tell I'm not big on my basketball.
Help us make sure we get this, and I'm going to try and put this into simpleton terms for those of us who want to use this kind of thing. But when you talk about the equity risk premium, essentially what you're saying is your risk is at a metric that's perhaps better than playing the safe game, and usually that metric is 1.9%, but you're identifying perhaps stocks or sectors where that risk premium is actually 3.5%, so it's a better bet.
Yeah, that's right. It's basically saying you're paid to take the risk because you've got a cushion against a loss. And that's why when risk premia is high, it means stocks are essentially better bets than bonds.
You're going to ask you who?
Yeah, I mean, it's interesting when you look at this list, if you think that some of these are not cool. I mean, some of them are sort of the commonly held names, like an Alphabet or an Apple, but then you've got Ameriprise Financial on there, which is not necessarily Brown-Forman. That's one that sticks out to me. So what are the themes that converge for some of these names that you wouldn't necessarily think of?
Yeah, so an example would be like Ameriprise. It's actually a good way to play what will likely happen with millennials, because millennials are going to become quite credit intensive over the next 20 years. You know, part of it is, you know, because they're going to start buying cars, houses, they're going to inherit $68 trillion. And so companies that are, you know, is volume sensitive in credit will actually do quite well. So that's why Ameriprise on there, I think JP Morgan and a few others. But there's also a tactical element. So some of these, you know, I know that Brown-Forman is what we consider a 6-month holding, meaning in the next 6 months, the sector that it's in tends to outperform. So we do tactical plus thematic.
Cool.
Hey, let me ask you about Bitcoin here, because it's kind of broken to the upside. I'm just wondering if you have any blockchain companies in there, fintech plays, and what are your thoughts on Bitcoin right now?
You know, Bitcoin had a good year last year, even though it didn't recover its highs. It was the best performing asset, right?
About 100% or so?
Yeah, so it had 3 times the return of the S&P. But in 2020, and we just published our outlook, we think the return of Bitcoin will be even better. So I think this is a setup where the geopolitical tensions that are pretty elevated this year, plus this thing called the halvening, which is the block reward for miners getting cut in half, plus what I think is improving institutional interest, is a real setup for Bitcoin to do great this year. And I think if someone's trying to find equities to play this or through the traditional markets, companies like Square aren't a bad way to get exposure. But there's also a publicly listed investment vehicle called GBTC by Grayscale Investments. And for many U.S. investors, they can actually access that.
Tom, you talked about the millennials getting ready to inherit, you know, basically the greatest wealth transfer in the history of mankind. When you think about that, talk about how that affects your thinking about markets and stocks over the long run, and are there any names on your lists that might be, you know, outperformers on that basis?
Yes. Yes, and clearly this is going to have a big influence on equities, because you have to remember $68 trillion transferring from one single 20-year generation is equal to the wealth of the entire country of China and Japan combined. So it's monstrous amounts of money. And it's at a time when their consumption profile is growing. So I think the odds of equity returns being better in the next 10 years than the last 10 are quite high. So in other words, we had a great move from 2009 to 2019. I think stocks from 2020 to 2030 could do even better.
Can I ask you a little off topic, but this wealth transfer is a fascinating concept. At a time when you would think millennials are listening to a political message of raise taxes, are they going to continue to perhaps follow that if they're about to inherit a great amount of wealth? Is that perhaps...
Yeah. It's a fair question. I mean, let's say taxes are uncertainty that they raise taxes in the next 10 years, and it's likely. The return on bonds is going to look even worse. And so you want to own something that will outperform the tax hit plus inflation plus growth, and that is basically stocks, or real assets like real estate. So I think heavy assets plus equities will be real standouts in the next decade.
So people buying real stuff.
Real things, yeah. And, you know, even real businesses, you know, in some strange way, I know people think when they think of private markets, they think of private equity, but you know that small businesses today might be the value play. You know, you can buy a restaurant for 4 times its profits, or an MRI center for 3 times. So if you're an enterprising individual and you don't want to buy healthcare stocks, you could buy an MRI center for a low multiple.
All right.
All right, Tom Lee, managing partner and head of research at Fundstrat Global Advisors, with how some people can make a living, and not a bad one at that. Thank you very much.
Thanks, Tom. Good to see you. President Trump announced his picks for the Federal Reserve Board. St. Louis Fed economist Christopher Waller and former Trump transition economic advisor Judy Shelton, they've been tapped to fill the board vacancies. Joining us now with more is Brian Cheung. And Brian, so he had already talked about these folks, but hadn't officially nominated them. So now here's the official nomination. Some of the others had come up against some resistance. Will these two?
Yeah, well, this is President Trump's third attempt at trying to fill the last two remaining seats at the Board of Governors of the Federal Reserve System. This is in Washington, D.C. These are big roles, but as you'll recall, he nominated the likes of Steve Moore and also Herman Cain in the past, but this is his latest pair that he would like to get nominated to the Fed. That's Chris Waller. He's a St. Louis Fed economist, and then former Trump transition economic advisor Judy Shelton. Both of these individuals are names that he had already announced via Twitter in July of last year, but the actual nominations weren't formally sent to the Senate until last night, which means that this will officially kick off the process to get them nominated. A few things worth noting, though. First is that the Senate is obviously tied up with a number of other things right now, like the impeachment hearings, and then there's also the fact that this Senate will adjourn at the end of this particular Congress, with the election coming up in November. So not much time for the Senate to actually do this. The Federal Reserve has floated by with a number of vacancies before, but there's also a weird technicality that could trip both Waller and Shelton up. There's a map that I believe we have of the Federal Reserve districts. There's 12 of them around the country, and there's a weird rule that says that no two governors on the board at any one time can actually be serving from the same district. So Judy Shelton, who's noted as being from Virginia, would conflict with Lael Brainerd, who currently is representing the Richmond district, which covers that state. Then there's also Chris Waller, who is from St. Louis, although Missouri is currently covered under the current Fed Governor Mickey Bowman. So it's unclear about whether or not both of these individuals can make it to the Fed confirmation on those merits. However, it is worth noting that Randy Quarles, who is currently a Fed governor, had to actually change his residency to Colorado, moving from the 12th district to the 10th district to get nominated. So this is all extremely confusing, but there are some statutory roadblocks for both of these nominees to get through the Senate.
Brian, I want to shift gears from the Fed to the Treasury Department because what's old is new again. We're talking about 20-year bonds. Help us understand why Treasury is going to issue these and what it means.
Well, this is really all about the voracious appetite for U.S. government debt. As we've seen the U.S. debt continue to balloon, the Treasury has seen that maybe there's a strong demand to create new bonds that hadn't existed for quite some time. Hence is why the U.S. Treasury would like to issue a 20-year bond beginning in by around the first half of 2020. Now, this is not a new thing per se. They did have a 20-year bond, but they did discontinue it in 1986. But by creating this new category, the U.S. Treasury hopes that it can really capitalize off of that strong interest in U.S. government debt. Keep in mind, the Treasury at one point also thought about a 100-year bond, although it's unsure if they're actually going to pursue that going forward.
And in 1986, the top song was from Berlin, Take My Breath Away. That's how long
Some
ago
time
this
ago.
was. Yes. Brian Cheung, thank you very much. Coming up, streaming wars heat up. NBC reveals details about its new Peacock streaming platform, plus global disorder. Why a new report predicts 40% of the world's countries will experience civil unrest this year. Hallelujah, it's Friday, just a little after 10:30 in New York City, an hour into the trading day, and stocks are trading higher. Oil, by the way, has also been trading down, $58.47 a barrel for West Texas Intermediate. Stream it like you mean it. NBC reveals count them, three ways to pay for its new streaming service, and one of them won't cost you a penny. Breaking ground, new data shows home construction hit a 13-year high in December. And drama at the Grammys, why that organization's CEO was placed on leave just a few days before the big Grammy Awards show. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Let's get to the floor of the New York Stock Exchange. Yahoo Finance's Inez Ferre is there. And Inez, you're looking at shares of J.B. Hunt.
Julie, J.B. Hunt is off its session lows. It had been down about 4% earlier. Now it's down around 2%. This is after their quarterly earnings, missing on the top and the bottom line, citing some of their segments, with their truck segment revenue down 20% in the fourth quarter. Also revenue for JBI, that's JB Intermodal, that revenue was flat. The company cited an increase in rental expenses and IT expenses as some of its drags. And then looking at Dave & Buster's, that stock is seeing a big pop today. This is after a private equity firm, KKR, reported in a regulatory filing that it has increased its stake in Dave & Buster's to 6.3%. That's up from 2.6%, saying it held talks with Dave & Buster's management about strategy, and it probably will hold further talks. Now, Dave & Buster's in its last earnings report had beat on earnings, but it had missed on revenue with same-store sales, which were down more than what Wall Street had been expecting. So certainly this activist stake in the company from KKR, investors really liking this. Right now, we're looking at the Dow that's up more than 70 points. The S&P and the NASDAQ also higher, as we're seeing record highs again today. Julie, Adam?
NBC's unveiling new details about its new streaming service, Peacock, which is expected to become available in July of this year. One of the biggest takeaways from the announcement is that NBC has decided to offer a free, ad-supported version of the platform. Users will also have the option to pay $4.99 for Peacock Premium and $9.99 for the ad-free package. So to break all of this down, let's start with Jared. As I understand it, Premium gets you live events, kind of like sporting, a sporting package, or is that the Premium? Because the free is all the stuff like Saturday Night Live and the whole library of content.
Right, and I think that makes a lot of sense too. I would sign up for that just because it's free, and they expect to be able to monetize at $5 per user, so they're getting at least $5 per user on any of these three options here. And you know, I've said this many times, I think we're approaching peak content, but if you already have an extensive library, this is kind of an incremental step for them as opposed to a leapfrog like Apple, which has to start from scratch. Makes a lot of sense for them. I think they're rolling it out the right way, kind of pulling back their licenses from Netflix. People expected that to happen. So I think it's going to be a winner for them.
Julian, how do you think about streaming as an investment theme, or do you? I mean, in other words, now that sort of you have such a big basket of different companies that are doing it, do you buy the basket, or are you looking elsewhere for more innovation?
Well, you look at the last several companies to announce streaming, the most of which is the amusement park company, let's say, with the mouse ears. We can't say individual stocks, but
understood.
You know, and that has been an absolute home run. But I think there will come a time, perhaps it's not in 2020, and maybe it's not in 2021, when you get to that sort of Ben and Jerry's moment where there are so many choices and so many mix-ins that you've reached satiety. So we'd be careful in thinking about how one invests.
But the plan for this is they expect to be profitable. I think it's 2024, maybe 2025. They expect 20+ million subscribers as they head out. They believe the free will attract people in. At the end of the day, are all of us willing to pay for or to watch the 10-second to 30-second ad because we're going to limit ad time to 5 minutes for a show? in order to get it for free?
That could get old pretty quickly. So I think that would only encourage people to upgrade to one of the other options, especially something if you don't have to sit there and watch the commercials. But to the broader point of when are people going to start paring back on their cord cutting decision or on their streaming decisions instead of adding to them as everybody seems to be now, that's probably a couple years away, and that's when the rubber's going to hit the road here. And it's really up to some of the outside players like Apple to prove themselves in this new mix. They have the resources to do it. They have more cash than most companies are worth. Yeah, it's going to be interesting to see how this shakes out. I don't know that you can. Disney's a great play, in my opinion, right now, just on a technical basis. I don't think it's been overhyped yet. I think they're going to surprise to the upside in subs in their next announcement. So.
There's also the question of how it fits into the overall business for these various companies, right? If you look at something like Peacock, it's going to be a line item, right? And if you're looking at how it fits into the overall business, I mean, when you look at Disney, there is such an integration of content there between the movies, the amusement parks, the merchandise, et cetera. Whereas at Comcast with NBC Universal and Peacock, you don't necessarily have that same value proposition for the company and how it's going to the halo effect, if you will.
They're iterating right now. And what's interesting about how some of these players are going about this, and you mentioned Disney integrating, it's funny that NBC and that they're getting into this live sports, that they're offering this, because live sports is actually one of the few things that makes sense for TV, the traditional linear model, as does news. I don't know that that's going to be as a hook as much as some of their other content, even The Late Show, for instance, and some of these.
Although you can watch The Late Show early. Yes, if you do one of these subscription models and you go to bed earlier and you don't want to stay up for Fallon, you can watch it, I think, at 8 p.m.
I miss that, but I don't watch
That's kind of a cool thing. That's like the one thing that caught my eye.
Okay, that's what says we all go to bed around 9 o'clock to get here at 5:30 and 6. Coming up, it turns out 11 U.S. soldiers were injured in those Iranian attacks on military bases in Iraq. We have the latest on that. Plus, 98.6 has been the accepted normal body temperature for people for more than 100 years. It appears, though, we are all a bit cooler than first thought. A U.S. military spokesman says 11 soldiers were injured during the Iranian missile strike on 2 bases in Iraq earlier this month. The U.S. soldiers suffered concussions and were airlifted to a U.S. medical center in Germany. The Trump administration first reported no soldiers injured during those attacks. The military says the symptoms actually emerged a few days later. It turns out the state of emergency declared in Virginia was based on the arrest of 3 neo-Nazis who had purchased guns and were planning to travel to Richmond for a pro-gun rally. Virginia's governor banned guns and weapons on the grounds of the state capitol. Several armed militia and white supremacist groups plan to rally there next week. Recording Academy CEO Deborah Dugan was placed on administrative leave less than 2 weeks before the Grammy Awards. Variety obtained an internal memo from the Academy's Board of Trustees saying it has hired a third-party investigator to look into complaints which include a formal allegation of misconduct. For years, the accepted normal human body temperature was 98.6 degrees, but the next time someone takes your temperature, don't worry if you measure a bit cooler. A new scientific analysis of thousands of people shows the new normal is actually 97.5 degrees. Doctors aren't sure why all of us are getting cooler, but suspect better health and constant ambient indoor temperature from heating and cooling systems may help explain it.
According to a new study, nearly 1 in 4 countries saw a rise in civil unrest and protests in 2019, and that number is set to rise in 2020. Countries like Chile, Nigeria, Sudan, Haiti, and Lebanon were also considered to be some of the world's riskiest locations. This is, by the way, according to a report from Verisk, one of their various arms. That's a global risk analytics firm. So if we're looking at global risks, you know, it seems like, at least to that extent, it's not necessarily touching the developed world, but it is to some extent, right? So when you think about investing right now, how do you factor in that aspect?
Well, those types of risks, and obviously, you know, what people have talked about, you know, the spread between the 1 and the 99, the rise of nationalism and populism, and so on and so forth. Those are trends which, in our view, you know, essentially are going to you have to think about in terms of applying, you know, what you think about in terms of valuations. Those are valuation discounting ideas in a broader scope. And they're also, you know, part of the story as to why even in a year like 2020, where we expect international markets to really do quite well, relative playing catch up to the U.S., that there are still maybe geographies one wishes to avoid as an investor.
How much of this, though, is when you think about protests in France, for instance, they're trying to reform the pension system and you're getting some civil unrest in France. But then you get a place like Haiti, which is impoverished. And I'm not so sure it's an income inequality thing. So do we have any sense of what is behind some of these civil unrest issues? Is it income inequality? Is it extreme poverty and governments which have never been able to move their people out of poverty?
Well, I think that's a good example. Governments that have been, or nations that have been poor, extremely poor for a long time, especially exposed in an increasingly connected world to other places like the U.S., where there's extreme wealth, even among some of the lower echelons. I'm not surprised to see that, but you know, you look at some idiosyncratic situations like France with the yellow vests, as you've been saying. These kinds of things don't matter to the economic or to the financial markets until they do. We saw Italy last year, or maybe it was late in the year before, just kind of not matter, but all of a sudden it did. At one point, the Turkish lira was the topic du jour. So you never know when this is going to bubble up to the surface in terms of the things that get on our radars as investors, but it's important to have a handle on what these black swans could potentially be.
And I think one of them as well, and again, this is sort of outside probability, but you know, you wonder about the possibility of some kind of larger structural reform to the system, whether it be in the United States or elsewhere, to address some of that wealth inequality that you were talking about. I mean, do we get more dramatic changes to the tax structure in the United States? Do we get more dramatic changes to the healthcare sector and how we're all covered in the United States? I mean, I don't know how high a probability you put on that stuff, but...
Well, it's certainly central to the debate around the U.S. election this year, particularly on the progressive side of the Democratic Party. And those are part of the calculations that, again, as good as the market is right now, and as much as the multiple is starting to creep higher, those actually are headwinds for valuation.
All right. The Commerce Department released housing data today with U.S. homes hitting their highest level in December since 2006. Home starts. The strength of the job market and low mortgage rates could help to continue to support existing home sales in 2020, but will the scarcity of affordable housing cause a rise in mortgage rates? George Raitu is the senior economist with Realtor.com, joining us from D.C. with a lot more. How do you interpret for all of us those numbers that we got this morning? What is the real signal it's telling us?
Excellent question, Adam. The truth is we are, as you pointed out, starting 2020 with inventory at a 2-year low. And this comes at a time when we have close to 5 million Americans who are going to turn 30 years old this year alone, part of the broader millennial wave, which has, much to many people's surprise, embraced home ownership as they've gotten older. So the new construction numbers, from my perspective, are good news. In fact, they are much needed good news, partly because what we've seen is, in terms of new supply, most of it over this past decade has been aimed at the upper end of the market, which is pretty saturated and where we are already seeing signs of softening. So from my perspective, the fact that starts were up 40% from a year ago and completions almost 20% from a year ago is really good news. I'd like to see a lot more new construction aimed at the affordable price range, right? Somewhere in the $200,000 to $400,000.
Similarly, when you talk about where on the price range homes need to be built, there's also, of course, where geographically they need to be built. So is that happening? Are we seeing not only new construction at the price point where it needs to be, but also where it needs to be in the country?
Indeed, as we look, to your point, Julie, at the migration patterns of Americans over this cycle, we're seeing a lot of movement towards southern states. So we have the baby boomers who have built careers on the coast and are looking for lower cost living in sunnier locales. So the South is seeing a huge influx of them. But at the same time, because of the affordability challenge, we're seeing young people, the very millennials, who have moved to the big cities in search of jobs, who are now looking to mid-sized cities around the Midwest, the South, the Southwest, looking for family-friendly lifestyle and, just as importantly, for affordability. And so a lot of the construction boost we saw in this latest numbers were up in the Northeast and also in the South and, to some extent, the West. Northeast being a slightly smaller area, but clearly with the South and West seeing bumps on a year-over-year basis, construction is moving where people are also moving.
So, just curious, turning back to the millennials for a moment, there's been talk of this potential surge in household formations for a number of years now, based on the idea that millennials who sort of are on the vanguard of return home for, into their late 20s and early 30s. Have we started to see that?
Absolutely. In fact, that's one of the myth versus reality debate we've been having for a while. We all expected, right, as we've heard, that all millennials are going to live in downtown condos and never want to own much of anything. The oldest millennial this year is going to be 39 years old. I mean, they're approaching middle age by any standard. They have kids, they have families. And one of the first questions, right, anyone with kids asks is, where are the good schools? And so what we've seen is millennials embracing the suburbs and embracing homes in the suburbs, partly due to affordability, but just as importantly, to the presence of schools and the lifestyle. And the only note I have to that, we're seeing the suburbs themselves undergo a renaissance. If you look at the suburbs of today, you'll see much more higher density, mixed-use development, condos, apartments above retail stores. Very different landscape than 10, 15 years ago.
George Raitu is the senior economist with Realtor.com. Thank you for being here on The Move.
And coming up, why Jillian says the conditions are right for greater animal spirits in the stock market. Plus, before we go to break, let's take a quick look at some of the top trending tickers on Yahoo Finance today. Alphabet up there with its $1 trillion valuation. Let's take a look at two big movers here this morning. One of them is Tailored Brands. Now, it's the owner of Men's Warehouse and Joseph A. Bank. Remember, it is also, though, the owner of Joseph Abboud, and it is selling the rights to that brand to a company called WHP for $115 million. As part of that, the namesake designer is also going to be exiting to pursue another opportunity. By the way, Tailored Brands bought Abboud for less than $100 million, around $95 million back in 2013. And then we're looking at Dave & Buster's as well. That chain is trading sharply higher after KKR disclosed a 6.3% stake in Dave & Buster's and said it was going to be having discussions with the company about how to improve its business. So we'll see what those discussions yield. And in the meantime, people are buying that stock. We won't be right back. Now we're going to do this.
Time for Word on the Street. We're going to check in with the panelists and find out what they are watching. And Julian, you say conditions are right for greater animal spirits in the stock market. I've got weekend on the mind. I already told you. I'm thinking liquor, but that's not what you're talking about.
Well, no, we're talking stocks. If you look at it, we're 11 years into this bull market almost. And what happens usually towards the end phases of any bull market is greater public participation. We've never seen it this entire cycle. And in fact, there have been outflows consistently out of stocks for the last 5 years. So we asked ourselves, what are the catalysts for something like that to occur? Importantly for us, we think there was a bottom in global interest rates at the end of the summer, and we think a move higher in yields is likely, and that will cause the rotation. But more than that, there actually, and this came from, developed our thinking when we were with you earlier at the end of last year on Yahoo Finance with Chuck Schwab.
He was sitting there right there.
He was sitting there, unbelievable, had taken the red eye in, came right to your studio, 10 in the morning, phenomenal. And his passion for the democratization of investing and basically the pessimists are looking at zero-fee online trading as something they had to move to in order to stay competitive. Well, we look at it along with fractional share ownership, which is something that's relatively new as well, as just further enabling the public to easily own stocks. And if you look at the account opening data, it's been very, very robust at a number of the discount brokers. And that's the type of thing that, particularly when interest rates start creeping up and the public sees that they're in danger of losing on their bond funds, animal spirits rise.
To give you just a little, more evidence of what you've just said, we were at about 54% of the public, according to Gallup, owning stock. It's now at 55%, still, though, below the 62% we saw going into the Great Recession.
Yeah, we'll see if it ticks back up. Jared, I mentioned transports earlier. You're watching them and also small caps right now. They've been outperforming over the past couple days, right?
Yeah, well, they've been outperforming over the last 3 months, and specifically yesterday, they both broke to the upside to new 52-week highs, which is good to see. A lot of people have pointed to the fact that they lagged most of last year until the very end, and even the year before that, as something that would hold the market back. Of course, it didn't hold the market back. The market has rallied 10% from those October highs right now, just a little bit over that. And usually when we have a long period of consolidation, and essentially that's what we had for about 20 months or so, we rally 30%. So there could be another 20% to go here. Doesn't mean that things aren't a little bit overextended now. Sentiment and positioning getting a little bit extreme, seeing some greed indicators kind of light up here. So we could definitely pull back, but I see significantly higher highs in the future, and people who think that the market is going to imminently roll over, I'm just not seeing the evidence for that right now.
All right. Well, coming up, Facebook plays defense, how competitors are trying to force founder Mark Zuckerberg to give up control of the company. Plus, make sure to tune into Yahoo Finance beginning Tuesday, January 21st. We're going to bring you live all-day coverage of the World Economic Forum in Davos, Switzerland. We'll be speaking to some of the biggest names in the world of business.
We're streaming at you a little bit after 11 a.m. in New York City, and 90 minutes into the trading day, stocks are trading higher. Take a look, too, at the 10-year Treasury yield, which was climbing this morning and continues to go up, 1.85% on the 10-year yield. Challenging Zuck rivals sue Facebook in an effort to challenge Mark Zuckerberg's controlling stake. A massive investment. Amazon CEO Jeff Bezos promises to bring 1 million jobs to India. And like they were never here, the details behind Microsoft's big plans to erase their entire carbon footprint all the way back to their founding in 1975. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. Well, Facebook is indeed facing a lawsuit. 4 potential competitors have asked that Mark Zuckerberg give up majority control. They say the company is guilty of anti-competitive practices, calling the social media giant, quote, one of the largest unlawful monopolies ever seen in the United States. And joining us now is Dan Howley. Dan, I've never heard of any of these companies that are filing this lawsuit. Is there any, is it just to get us to talk about it?
That is a good strategy. These are companies really that it looks as though they were attached to Facebook when Facebook was allowing companies to kind of siphon off data. And they were doing that through APIs. And then eventually Facebook kind of just shut off that faucet. And it really hurt companies like these 4. And so what they're doing is hewing very closely to what the regulators are thinking of doing to Facebook, which is to basically break up Instagram and WhatsApp from Facebook. And they say they don't want to see Facebook's backend integrated, which is exactly what the company is doing. Part of the reason they're doing that, it's suspected, is to inoculate themselves from the potential of being broken up through some kind of antitrust effort. So that's part of the equation here. And the other side is they also want Zuckerberg to lose his controlling stake in the company, because really it's his company. What he says goes, and we've seen that evidence through the political ads controversy and things along those lines. So that's really where this situation kind of stands. Whether or not this comes through, I don't think it will, but I think it's smart of them to lean on what regulators are into.
Is there I'm trying to think, is there an example in history where this kind of action led to that kind of result? And I can't come up. We know the government against Standard Oil, that's one thing.
Right.
But that's hardly
the government against Microsoft, although they didn't break it up.
Alphabet came along and they replaced their browsers to #1 and kind of mooted the whole issue. So I don't know that there is a precedent for this, but it just raises the attention level once again. I think Facebook's biggest problem right now, or one of their biggest problems, is WhatsApp, because they need to monetize it, spend $20 billion on it, not imminently, but they're going to have to make a profit on it someday. And the more they try to do that, the more the privacy, I guess advocates are going to be stepping up and saying, well, this is just another example of how they're trying to turn a buck. We're losing our privacy. They're monitoring what we're saying. One of the features that takes people to it, one of the reasons I use it, is the fact that it does seem to be private. I don't know if there's a back door or not. I hope there's not. Right. But if they're sending me advertisements, it's going to be a big problem.
Yeah, I want to ask Julian, too, when you're looking, earlier in the show we were talking about all these big tech companies and the fact that, Alphabet's at $1 trillion, which we'll talk more about. But how much of a risk is the regulatory risk, whether it's from the government or from lawsuits, for example, when you're investing in these companies?
They're definitely a risk. And
the market, they're not trading like it's a big risk, right?
They aren't. But again, a lot of that is due to this sort of resurgence of animal spirits. But we're actually neutral on the technology sector, and we are particularly concerned, being in an election year, that type of regulatory scrutiny, has the potential to really cause headwinds at some point.
All right.
Snap shares higher this morning after an upgrade from UBS and S4A on the floor of the New York Stock Exchange. Tell us more about it.
Adam, UBS upgraded Snap to a buy, saying that the momentum in 2020 is expected to continue when it comes to revenue, ad revenue, and also user growth. Now, this stock is up more than 20% in the past month, and a lot of it has to do with analyst upgrades being very bullish, especially on user growth and international user growth for Snap. And then if we take a look at Twitter, UBS downgraded that stock to neutral from buy, saying that 2020 is a year when Twitter can capitalize from Olympic ads, from the European Football Championship, but the management is expected to spend more, to invest more in safety and security, and this could eat into its bottom line. And then finally, just looking at Amazon, UBS put out a note about Amazon increasing its price target on Amazon to $23.05 from $21.00. The analysts note very bullish on the investments that Amazon has made into one-day prime shipping, saying that this will lead to more purchases for the company. Adam, Julie.
Thanks, Inez. Another story we're watching about Amazon. It sparked controversy during its search for the company's second headquarters. And it turns out the Amazon plan was actually even more ambitious than originally revealed. In addition to the billions in economic incentives, the company also looked to get another $1 billion for other real estate projects. Let's turn to the panel for the thoughts on this. And Dan Howley, who covers tech, is still with us. So effectively what they were doing is looking for other types of investment around the country, but also ways to sort of take advantage of tax breaks and things like that. I mean, it's a really interesting strategy that they eventually abandoned.
Right.
But what does it tell us about how Amazon operates?
I mean, they operate as any other company does. They're trying to take advantage of the tax incentives that are offered to them. And I think, you know, for the situation in New York that played out where they eventually were, they didn't necessarily get booted, but they left under, I would say, duress. I think that was kind of an interesting issue because there's always been these kind of reports saying that people in the area wanted them to stay and then politicians didn't
Not
want them to
AOC.
stay. No, and
Alexandra Ocasio-Cortez was quite vocal.
She was the one who was very much against it. And, you know, I mean, I'll be totally open. I live about 5 subway stops away from where they would have built the buildings. And, you know, it's interesting to see. You would have originally seen real estate prices start to fall a little bit in that area. I mean, now they're jacked straight up again because it's all luxury towers. But, you know, this would have been something that would have impacted the community, but they weren't doing anything illegal. That was the big thing.
Sure.
To us, this discussion really dramatizes the whole evolution of corporate governance and the importance of, which had been, for the most part, for many years, you know, maximizing shareholder value versus maximizing stakeholder value. And whether you think of the public at large, the residents of Queens or whatever, as potential stakeholders in issues like this, it's really a very thorny issue. And obviously going into this whole ESG type initiative and thinking about how to think about stocks in a portfolio. But it's an ongoing debate that we don't see clearing up anytime soon.
The stakeholders in India might have something to say about this because Amazon is facing backlash there despite the company's announcement that it plans to create 1 million jobs in India. Small brick and mortar retailers in that country say Amazon is violating Indian law by racking up debt to offer deep discounts and drive smaller sellers out of business. Walmart's Flipkart is also being targeted by the Indian, I don't want to say the consumers, but it would look like the Indian small store owners. Is this a legitimate threat that these companies need to pay attention to?
I think if they're doing business in any kind of foreign country, then yes, you know, you have to appease more so, I would think, than operating in the U.S. And don't forget, this was something that Walmart was accused of doing here as well, right? They faced this backlash.
Main Street.
Right,
and Amazon.
And Amazon, yeah. Now it's Amazon. But I remember specifically when Walmart had its huge expansions, and we saw that in China, they also took heat for that as well. I think this is going to be an ongoing issue no matter where they build out. But for India in particular, they don't want to, you know, kind of rock the boat too much because that's seen for a lot of these tech companies as the next China, the next major market to jump into.
And there's also a rising nationalist tide in India,
Yes.
so that's something they need to keep an eye on. We want to take a look at some live video right now because President Trump is welcoming college football champions, the LSU Tigers, to the White House. LSU defeated Clemson in the championship game in New Orleans Monday night, clinching an undefeated season behind Heisman Trophy winner Joe Burrow. You see there, the president is standing right in front of Burrow as he's making comments there, greeting the team. So
maybe his remarks will be a little bit shorter than the hour and 15 minutes they got at the China trade deal phase 1.
You never
Doesn't
know.
have as many people to thank.
There you go, or to call out. Remember all the CEOs. Thank you. Microsoft plans to become carbon neutral by 2030, eventually removing more carbon, they say, from the environment than they emit. The company will also reduce its emissions to zero across its entire supply chain. So we're going to get reaction. This looks like it would be harder to do than just to say what you're going to do. They're going to plant trees at one point. Their data centers will be, I guess, solar powered. But how do you get the supply chain to comply?
That's going to be a big one. Fast forward to 20 years, 30 years in the future, I think we're going to see a lot more of this. ESG was a breakout year in 2019 in terms of investing. Whether you agree with it as a strategy or not, it's clear that there's money being allocated to it. Companies want to be carbon neutral, and my thing is that these are all based on back-of-the-envelope calculations and assumptions. We've heard of financial engineering. I think we're going to see a lot more ESG engineering. Take these numbers and these goals with a grain of salt. But in the long run, there's going to be a lot less fossil fuel emission. I think we know that. We're marching towards that. And this is a nice publicity for Microsoft. I can't really say anything more than that.
Yeah, I mean, it's the whole stakeholder capitalism idea that Julian was just talking about, that companies are feeling more pressure, I think both internally from employees and externally from customers and the public to make these kind of moves. The question is whether they will be real moves, to Jared's point.
There's no question about that, but I would say this. If you look at the last 3 or 4 years, if Satya Nadella puts his mind to something, he's probably going to achieve it.
Dan, let me ask you this. When we talk about these data centers, which are huge, I guess, carbon emitters based on electricity, but then you look at, for instance, solar power farms or solar farms in the desert. First Solar just got approval to build a huge, I think 450 megawatt facility in the Nevada desert, but that's just enough to power 117,000 homes. It's a start, but is that the kind of thing, I mean, it will have to be ginormous, which I don't even know if it's a word, to do what Microsoft is looking to do.
Yeah, I mean, these data centers, not only do they need to be powered,
and cooled.
They need to be cooled, and that's the big thing. So some companies, Microsoft, Google, Facebook, they started to locate these in colder climates. I think it was Microsoft that tried to anchor one in the ocean and just have a data center sit there in the water and have it passively cooled that way. These are some of the things that these companies are going to need to continue to try to innovate on. Now, going back to 75 from when the companies first started, like Jared said, that's back of the envelope stuff. Grain of salt, I don't think they're going to be able to do that. They're talking about planting trees and then maybe blasting carbon into the earth and figuring out how to deposit in that way. It's a good move on their part, but really, you look at something like Amazon, where Jeff Bezos had recently said that climate change is a major issue. They still didn't give a kind of climate layout for what they were going to do with their data centers, I think up until recently. So this is something that these companies need to focus on if they want to continue to operate in Silicon Valley and believe themselves to be this utopian.
I mean, if Amazon was serious, they would. Look at how much they move around the country. All that stuff is still gasoline
look at the
powered.
Stuff how many
it's not electric powered.
Box?
Exactly. So I don't know. I'm skeptical.
Battery powered drones.
There you go.
What do we do with the batteries then? How do we charge the batteries? It's all,
Stop being so logical, Dan.
Well, and by the way, disposal of the batteries is a whole nightmare.
Right.
We'll do a segment on this, but right now, Dan, we have to say adios.
See you later.
Thank you very much.
Coming up, IPO, let's go. We dig into the tech IPOs coming down the pipeline in 2020. Plus, before we go to break, let's take a quick look at some of the most actively traded stocks by volume on Yahoo Finance Day. Speaking of electric vehicles, look at number 1 there. It's NIO, the Chinese electric car maker.
More record highs. Welcome back to On the Move. I'm Jared Blickery. Dow is up a whopping 18 points or 6 basis points. S&P 500 up 12 basis points and the NASDAQ down just 6. So it has lost ground over the last hour, but all three have been at record highs. Also 7 of the 11 S&P 500 sectors, those have hit record highs as well. Here is the intraday price action for the S&P. We can see we gapped up to about 33.24, 33.25 was an options expiration area that we were interested in. That has passed now. We're seeing the index fall off a little bit here, but nothing too major. Now the Russell 2000 once again outperforming. It is up 1.13%, and that follows several days of outperformance. It's only about 1.5 points away from its record high. We're also going to take a look at the 10-year T-note yield. That is up 3 basis points today. And let's take a longer-term look. We're going to look at 6 months here and go to a bar chart, and we can see this consolidation, still waiting to see what happens, but really the upper bound is about 1.95 to 2%, and to the downside, the recent low is about 1.87%. Any break of this range could portend something big for the next few months, as we have been consolidating in this pennant formation for about the last 4 or 5 months. Then we're also going to take a look at the US dollar index, the Dixie. That is up today, and this is set for the highest close that we've seen in several weeks here. This has important implications because we have been in this downtrend, and it looks like we're just kind of peaking above. Now, we could have a false breakout to the upside, but again, the dollar has important ramifications for not only the international markets, but also emerging markets as well. So let's take a look at our heat map. And this is the Dow, and we can see kind of a mixed picture now. So we have given up some of the gains that we had earlier. Microsoft now in the red after reaching a record high. Not any big movers. We are seeing Visa to the upside at 0.8%. That's another record high for them. And then Boeing, that big stock is down about 0.7%. United Health, the lowest at 1% off here. Stick around. We're going to be back in 1 minute.
Big tech is bigger than ever. Alphabet just became the 4th U.S. technology company to top $1 trillion in market value. Technology companies now account for over 17% of the S&P 500, according to FactSet. Joining us now is Quad Group Chief Strategist Peter Borish. And Peter, I was asking retail investor-related questions this morning. I want to ask you, as a retail investor, when I see a metric like that, should I be concerned? Should I not be concerned? What does that mean? Because it can skew what I'm actually looking at in the index.
Well, it's great to be here, and I have to say I'm overly concerned because the NASDAQ is down 7 basis points today, and I thought that like it was every day it's supposed to go. So we need to go check the entire system and see if it's broken. But seriously, math works. That's the one thing I know I keep saying. These stocks cannot compound at the same rate of speed. We have the largest tech stocks as the largest market weight relative to the next 95 stocks in history. They can't compound at the same rate of speed. So they may be great companies, but they're not inherently great stocks to invest in right now because their price appreciation has gotten too far above the rest of the group.
So you sent us a great graphic which looks at the past several decades. and which companies sort of dominated. Now, as you're saying, the last decade was dominated by these internet stocks, which did compound at an incredible rate of speed for much of the decade. And so if we can bring that other one up, I think it was Japan in the 90s, I guess it was, or the 80s.
And to 89, yep.
Yeah.
And it's still 40% below its peak.
So
Japan.
if you look at these various themes that we have watched over the past several decades, I guess then the question is, okay, if it's not going to be tech compounding at the same rate of speed, something is going to be dominant. It's just a matter of figuring out what that something is.
So let's go back. If you take the top 10 market stocks from 1979 through now, which we don't know, following the next 10 years, on average, 2 of the 10 stocks that were in the top market cap were in the top market cap a decade later. If you're batting 200, except being on the Mets, you're probably not going to be a major league fan. I say that because I'm a huge Mets fan, and only the Mets would deal with what happened here with Carlos Beltran. But so now we look at the top 10 stocks.
Yeah.
And here they're all tech. Only 2 of them were in at the end of 09. So the likelihood, if history is a guide, and that's all we have to go on, is history, that there's going to be entirely new companies. I don't know. But if we think about the history of GE, we think about the history of Intel, we think about the history of Cisco. How about Eastman Kodak as a company that was a leader in photography, and we think about where all that has gone.
Polaroid.
Yes, exactly. So I don't know. Is it going to be healthcare? Is it going to be, so you have digital monitoring of all your things? Is it going to be a new green company, ESG? So it's going to be some combination of things that we know are on the surface. Maybe it's going to be some medical cannabis. I don't know. I'm not that smart because I'm more of a trader. We're sort of, 3 months or less time frame in terms of my crystal ball, which gets really foggy really quickly. So I can't necessarily say a 10-year horizon. I just know if history's a guide, right, 2 of these 10 companies may be in the top market cap 10 years from now.
Well, let me ask you about the concentration issue. A lot of people are saying that the FANG stocks and some of the other big caps like Microsoft have dominated so much, become such a large percentage of the gains that we're seeing, it's not sustainable. I'm just wondering about the broader implications for the market over a time period you'd have more comfort opining over, maybe 6 months to a year. Are you worried about a lack of leadership elsewhere, even though we have seen financials kind of come alive, healthcare come alive over the last few months? Do we have enough broad-based leadership to sustain higher highs, or is that a problem?
So in this business, the only constant is you're always worrying. Right? That's the one thing you have to do because that's what risk management is all about. So there's a couple of options. These stocks could go down, and that changes their market weightings. They could go sideways, other stocks go up, and so the index continues to rise as the other stocks get a higher weighting. Or they could all go down, and in which case those that have the highest weighting probably go down more quickly because they came up. So trading in our world is always sort of a second derivative. It's not so much the level, it's the rate of speed. So we've seen this compression in volatility. It's very slow. Does it pick up? And we don't need to get into the political, economic, you were talking just before about the uncertainty in the world. All those things have potential implications.
All right. Well, if you're worried, we have chamomile tea in the green room, and that's good to calm people down. Quad Group Chief Strategist Peter Boris, thank you for being here.
Thank you.
After much hype, 2019 was a mixed bag for IPOs, but 2020 is poised to bring a brand new crop of tech companies to the public market. Let's get a check on what the tech IPO pipeline is looking like. Yahoo Finance's Melody Hum has the details for us from the West Coast. Melody, so far we got Casper's S1. Who's up next?
Yeah, and as we know, it's not looking so pretty for that mattress company, for the business of sleep, if you will. And I have to point out that CB Insights, a research firm that does a lot of analysis, that's been pretty accurate in predicting a lot of the IPOs to come in 2019, kind of delineated 5 different companies that we should be looking at. And, your conversation just now really teed this up, being like, okay, what are the future companies that we should be curious about? And I need to point out, guys, it's not consumer-facing. Surprise, surprise. highs. These are higher margin software as services businesses, and GitLab is a big one. It's a DevOps platform where folks can share code with one another. There are free private repositories for open source coding. As we know, not to be confused with GitHub, which was acquired by Microsoft last year. Snowflake is a cloud-based storage and analytics company, kind of adjacent and complementary to the AWSs of the world and Microsoft Azure. Credit Karma, in our wheelhouse, trying to become the one-stop shop for personal finance, as well as even filing your taxes, right? And then we have Unity, which is a game developer, and then Procore, which is a construction management software service. And the common theme that I'm seeing is that these are on the path to profitability, if not profitable, with some of their disclosures so far. And according to folks that I've been speaking with here on the West Coast, especially working at these startups, they just want an exit plan, right? They saw what happened with Uber. They saw what happened with Lyft. We've seen folks like Derek Khosrowshahi come in and kind of steer the ship right? However, they ultimately want to be able to have security, knowing that it's not just the appeal of a sexy startup anymore. They want to be able to have that exit plan. And I think these are the companies that we should all be looking out for to potentially go public this year over the next couple of months.
Melody, thanks for the rundown. The exit plan only works well if people buy the exit plan, right? And we saw this year that in some cases they didn't, or in one very high-profile case, you didn't even get there, right? So what is the appetite like out there right now for these IPOs after the 2019 that we just had?
Well, we're tiptoeing cautiously back. What we learned in 2019 is that you absolutely must have some sort of path to profitability, okay? It doesn't matter that it's not year one or year two, but you need it as part of something that investors are going to hear on the roadshow and believe in. Yet, as we look at it, the IPO index has actually come back very nicely over the last 3 or 4 months, along with this rise in animal spirits, and that tells us we're likely to have another round of companies coming public here.
Well, when I think it was the interview yesterday that Alexis had with the head of the NYSE.
Stacey Cunningham.
Yeah, right, with the New York Stock Exchange, talking about we might see more direct listings in this year. That doesn't necessarily protect me as an investor from doing the work I've got to do, for these companies. I mean, it does. There's this perception, perhaps, that that's part of what's driving the fear with IPOs is how many people got burned, but you can still get burned if it's direct.
Yeah. Well, you can still buy into it in the open market, and yes, you can get burned. I think a lot of companies considering the direct listing option, if they don't necessarily need the money, they're seeing it as kind of a backdoor way to get one over on the investors in terms of governance because there's not as much scrutiny. You're not raising money from the public per se, even though the public can buy shares. You're not raising additional money, and so you don't have the same level of scrutiny. I think it's a very important point that you made, Julian, that the Renaissance IPO ETF just made a record high today. Hadn't made a record high since August, I think, of last year. And it really has come back over the last 3 or 4 months. I think there's a lot of animal spirits in the market. I think there's a lot of appetite for risk because where else are you going to go? So that's going to translate into what I believe is going to be a healthy year for capital markets. But there has to be that plan for profitability. And I think direct listing is just kind of a backdoor way to avoid some of the scrutiny on this.
All right. Julian, it's always good to see you. Thank you for being here. Jared, we see you every day, but it's still good to see you. Thank you as well. Coming up, baseball fans get hit by a curveball, what the MLB cheating scandal means for the future of the sport. Plus, let's take a quick look at the markets, trading at record highs all week long. A little bit mixed right now. We'll be right back.
11:30 here in New York City, 2 hours into the trading day. Stocks are now mixed. Really little changed across the board. The Nasdaq in the red by about 2 points. Let's take a look at the 10-year Treasury yield as well, because the yields have been moving higher. That gain, though, has moderated a little bit, now up 3 basis points to 1.84%. More fallout from the Astros cheating scandal. Should the World Series be vacated? We'll ask an all-star pitcher right after this. And tuning into the latest IPO, we'll speak to the CFO of audio entertainment platform Lizhe straight ahead. Turning to the auto industry as well, the Gooding Company auctions this weekend. We've got the price tag of this 1948 Tucker. It's a beauty. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Chinese interactive audio entertainment platform Lizhe is making its debut as a public company today. That app is home to a wide range of podcasts and audio entertainment, including live streaming and interactive products. We're joined by today's panel, Granite Share CEO Will Rind and Yahoo Finance's Brian Chung. And joining us from the NASDAQ is Lizhe CFO Catherine Chen. Congratulations on the IPO, and thank you for being here with us. So give us an idea. This is a platform in China, not in the United States, but what appeals to the Chinese consumer when it comes to a podcast? What kinds of things are resonating with them?
So we are the largest user-generated content community in China, with a mission to enable everyone to showcase their local talents. So everybody can create and share and become a host on Lizhe platform. So that appeals to the Chinese, like young people especially. A variety of the content creators form their own community on our platform.
And Catherine, when you look at the podcast communities here in the United States, there are really two main revenue streams, right? There's advertising and there's subscriptions in some cases. How does Lizhe work on that front? What's the business model, basically?
So we generate our revenue mainly from interactions, because, like for radio programs, the most popular one are hotline programs. And with the ideas of that, we began to launch the live channels for our podcasters, and it's become extremely welcomed among the young people and Chinese youth. And then we were able to generate virtual gifting revenues through interactions. And the more interaction we have, and the more engaged our community is.
Hey, Brian Chung here. So I'm just wondering, in terms of your capital raise here, what do you plan on using the proceeds for in terms of your business strategy going forward?
So AI is extremely important for us. So we are investing a lot in AI technologies to empower content creation, distribution, and consumption. And we are also developing for new products that aiming for the IoT world.
So what does that mean, Catherine? Because when you think about podcasts, I think about humans recording stuff and so that other people can listen to it. So what role will AI play in all of this?
So because we have massive amount of people who are content creators, you can be anyone that create their content on our platform. We're able to analyze them, give them feedback, what kind of program they should be using. And for the long tail content creators, we are able to distribute their contents right to the audiences that attract to them.
All right. Lizhe CFO Catherine Chen, congratulations again on the IPO.
Thank you so much.
Volkswagen accelerates its push into electric vehicles. The German automaker plans to take a 20% stake in the Chinese battery maker Guozhong. Yahoo Finance's Oscar Williams-Groot joins me now from London for more on this. So tell us, what does this mean for VW, and how does it rank them among the competition?
Well, Adam, this deal is basically all about helping Volkswagen push more into the Chinese market and also into the future of what mobility is going to look like. Reuters first reported that they are talking about taking this 20% stake in Guozhong, which would be worth around $560 million. Neither company are actually commenting on this at the moment, but according to Reuters, the talks are in advanced stages, and investors certainly seem to believe it. Shares in Guozhong, which is listed in Shenzhen, jumped 10% this morning on news of this potential deal. And as I said at the top there, this is really about helping Volkswagen push into China. They have a target of selling 1.5 million of what it calls new energy vehicles in China by 2025. And so having a local electric battery maker in the country will help them to achieve that. They've already built a $2.5 billion factory in the market to help them produce locally. And this is another key component. Of course, competitors in the market, chief among them are going to be Tesla, who are also planning a $2 billion factory in China. So this will remain to be seen how this arms race plays out. It's a very early days for this. As I said at the top, this deal hasn't even been confirmed, but I'm sure we're going to see a rapid competition in the Chinese market to see who can sell the most electric vehicles.
Oscar, we're going to shift from electric vehicles to good old gasoline combustible engines. We want to kick it into high gear. This 1948 Tucker can be yours, but it might break the bank. It's up for sale at Gooding & Company's Scottsdale auction this weekend. Gooding Company founder, president, and CEO David Gooding joins us now live from Scottsdale, Arizona, with the 48 Tucker. And this is a unique car, David. First of all, it's always good to see you. But this is a one-of-a-kind because it's so close to original, right?
That's correct, yes. It is considered one of the most original Tuckers there is. It has a completely original interior. It's been beautifully preserved. It has only about 6,000 miles on it from new. It's just in fantastic condition. The paint has been redone, but the interior, as you can see, I'll open it up here. The interior is spectacular and original, and that's quite rare for these cars because oftentimes they got neglected and sort of abused over the years, and this car has been beautifully preserved, and it's one of the few that does have its original interior. The other nice thing about this Tucker is that it has been driven. It runs and drives. We've got great video of it driving. So it's one of the few Tuckers that is actually a drivable car. So we're quite excited. We've had a lot of interest in it. These are rare cars.
It's number 34 of the ones that were, assembled before the Tucker went out of business in '48. It was sold at auction, the bankruptcy auction in 1950. What kind of price tag do you see this going for? Because I know Tuckers can command 7 figures.
Yes, so many have sold for over $2 million. We are being conservative in our estimate on this car. It's 1.75 to 2.2. So we will see. This car goes up tomorrow. Our sale is today, starting at 11 at Scottsdale time. But we will see how it does.
I wish I had the money for it. What about the 37 BMW? This was actually, it was a U.S. Army commander who bought it after World War II in Germany and brought it back to the States. It's been in one family since then. Tell me about this, because it seems more affordable at $350K.
Yeah, well, you've got great taste. Our estimate is $350 to $450, but we're expecting that car will really outperform its estimate. It's been in the same family for 75 years. So this Army captain got it when he was in the Army in Germany during the war, and the family's had it since then, and they're selling it. We're going to be auctioning that car off today.
David, Scottsdale Auto Week is underway, Barrett-Jackson and all the other houses, but you're one of the premier auction houses in the country. I think you had somewhere between 40 and 50 million in sales last year. Is the industry that you're in still generating that kind of revenue? Are we going to see perhaps a record this year?
Oh, there certainly are going to be records in segments. Pebble Beach prices were down, but still very strong, and I think we feel very good about today's sale. We will see. The proof is in the pudding. The great thing about the auctions is none of us really know how they will do. The proof will be when the cars cross the block and what they sell for. But the BMW and the Tucker will be very interesting to watch because those are two bellwethers.
You and I have had, and I've had the good fortune of having these discussions with you about how you find these cars, whether they truly are in a barn and hidden for years. This car was in a basement for 18 years. Yeah. What's it like when you come across something so rare like that Tucker you're standing in front of?
Oh, well, yeah. I mean, it's exciting. That is one of the great joys of our business. That's what we love doing is searching out these cars. We travel the world, and when we can find a treasure hidden away in a basement or in a barn, or somebody's locked away in their garage, that's what we enjoy doing and bringing them out to market. I mean, sometimes these are cars that we've known of for years. This car we've chased. I've sold it once before. I've known of this car for years. The BMW that we have, I of course know of the model, but never knew that that car existed. So it's fun when you can discover them and share them with other car enthusiasts.
David Gooding is the founder, president, and CEO of Gooding & Company. We wish you all the best during the auction this weekend. It's good to see you, David.
Thank you very much. Wish you were here.
I wish I had the budget to be there. See you, David. Coming up, the battle for streaming, what Peacock needs to do to stand out in the crowded field. Plus, the MLB scandal continues. We're going to talk to an all-star pitcher right after this. Let's take a look at some stocks that are winners and losers today. 47 Inc. This is a healthcare biotech company. They develop drugs that fight cancer, and they have had some promising clinical results with a phase, they're in phase 1B, the data phase of trials, for a drug that they've got that will treat what I guess you would call pre-leukemia symptoms, essentially anemia as well as leukemia. Their 52-week range has been between, 42 and $46. Where are they trading right now? Well, they're trading higher today. And again, the 52-week range has been between, on this company, between $5 at one point, it was pretty low, and now $46, so at the higher end of that 52 weeks. Now let's take a look at a loser. You've got Expeditors International. They have warned in advance of their earnings report that'll come out on February 18th about fourth quarter profit and revenue. They've guided earnings per share to be between 78 cents and 81 cents. They were expecting, at least the street was, 94 cents. The CEO, Jeffrey Musser, has said that slow global demand has been a problem. This is a logistics company. And he said, quote, "We've seen impacts throughout the year from these market conditions." So again, they are trading down today based on their revised guidance. But they're off the lows that they were at earlier in the morning.
The pro baseball cheating scandal is escalating. Another baseball manager was dismissed yesterday when the New York Mets fired Carlos Beltran, and now there are new allegations that Astros batters wore buzzers at the plate to indicate which pitch was coming next. MLB says there's no evidence to support that, though. Yahoo Finance's Dan Roberts has more in this week's Business Blitz. Dan?
Thank you, Julie. Yes, for the Blitz this week, I've got MLB All-Star Cincinnati Reds pitcher Trevor Bauer in studio. Trevor, thanks for coming on.
Yeah, thanks for having me.
So let's start actually with when the report came out, before the latest, because yesterday was just like a wild circus on Twitter of new allegations.
Yeah.
Did Manfred originally, with the original 9-page report and the punishments that happened for those three, well, at first for Luhnow and Hinch, did he get it right? Because even before the new allegations, people were saying that maybe Manfred should have punished more of the players. Obviously, at first, the league said, we're not going to punish players.
Yeah, there's a lot of moving parts to this. Some things that people may not understand is Manfred is basically voted in by the owners. So if you hammer the Houston Astros organization, then that makes their organization worth less, makes everybody's organization worth less. It's not good for the business side for all the owners, right? So there's that part of it. The players side, it's really hard to prove who used what, when, to what extent, or like, if I'm a hitter and I go up there and I don't want anything to do with this, but someone's banging on the trash can anyway, then am I now involved in it? Do I give? It's a really slippery slope. I actually think he's done a pretty good job of walking a middle ground. I think that, you know, there's going to be people on both sides that say it's too harsh, it's not enough, but I think he's done a decent job balancing the whole thing.
I've heard a lot of people say that in terms of how damaging this is for the sport, it's the worst scandal for Major League Baseball since the steroid era. But I think arguably in some ways it's worse than the steroid era, because that was individual players. This was a coordinated effort by a lot of people on one team, players, also at the employee level, although Manfred's note says lower level employees. I mean, I think this is the worst thing since the Chicago Black Sox, you know, in 1919. But how damaging is this for the sport? Because regardless of what additional punishments or firings come, people are going to remember this for years to come, and there's an issue of fan trust.
No doubt about that. It's a huge black eye for the sport, and I would tend to agree with you that it's worse than the steroid era. Look, you got an individual, or many individuals that are on steroids perhaps, but you still have to compete and hit the ball. You still have, you don't know exactly what's coming. Perhaps the pitcher's on steroids and the hitter's on steroids. Now it's in some ways a fair playing field in that specific matchup, you know. So, but this is just, you know, it's a big black eye. I think it's definitely like up there with the Black Sox scandal. And yeah, hopefully we can just get it all come out now. Let's get it all out, clean the game up, and then we can move on, because fan trust is an issue that MLB struggles with.
Yeah, you know, all the blood is coming out for sure right now. And last night you were already being very vocal on Twitter. You're a very outspoken player. I know that people say, well, sign stealing has always been an issue in baseball, and it's kind of rampant. But there's obviously a difference between kind of casual sign stealing that maybe happens all the time. And, you know, even in football, people try to read the coaches, what they're saying. There's a difference between that and having a coordinated effort involving cameras and, you know, banging on a trash can. And now the new allegations of buzzers. I mean, where is that line? And what do you make of the newest allegations, the buzzers? Because MLB has already responded to that, but not a lot of people buy it.
Yeah, so I'll start there. I've heard I have to preface it by saying I don't have any inside knowledge directly of the situation. I've never played for the Astros, but I've heard from 3 independent people that don't know each other that this is a real thing, that it happened. So that's the extent to which I know of. I've been hearing about this for 2 years. Other players that I've talked to have heard similar things. So it's this kind of like inside baseball rumor that's been going around. And so that's what I know on that aspect. I think it's certainly within the realm of possibility technologically. Now whether it happened or not, I'm not sure. I'm not positive. But it's, yeah. So there's that part of it.
And then in terms of the line.
Yeah, in terms of the line, sign stealing has been going on for a long time in baseball. From the simplest stage of you get a runner on second base, if the catcher puts down one sign, the hitter might look one way or the other way to signal, or like put his hands on his knees, or only one hand or something like that. That's generally accepted, and it's on the catcher, hey, switch up your signs. Then, you know, we started getting replay review, and we started being able to see live feeds of the game. And so you would have people down there watching the game, and they would notice certain things. Maybe they see that the pitcher's hands are higher or lower. That's a form of it, right? And so this is all just trying to gain an advantage. And I think the conversation really comes down to what do you think is the biggest misstep here? Is it the time by which you can relay the signs? Is it the method of relaying the signs? Is it the fact that you're relaying signs in general? I don't think anyone in baseball is sitting here being upset with the fact that signs are being relayed. That's been part of the game forever, right? But how quickly can you get those signs? Do you have an external? Do you have a technology? Maybe you have some sort of computer decoding system that you input the signals to, and so you can actually decode what the catcher is giving the pitcher. Is that crossing the line? I think it depends on what certain technology you decide is illegal or should be illegal or whatever, and then you can kind of decide on the line from there.
Depending on what now comes out, where do you stand on people calling for the World Series titles to be vacated? Something MLB doesn't really do. NCAA has done it. A lot of people don't believe in it. It's just a symbolic effort. And then, if you do vacate a World Series title, that punishes some players who presumably didn't cheat.
No doubt. I think that's the slippery slope there. I'm personally not in favor of vacating a title because you don't know how it would have turned out, on a fair playing field. I think that that's one of the reasons I say that Manfred's done a decent job of kind of finding that middle ground. A lot of people are calling for it. Some people aren't calling for it. It's a tricky situation. It's a really tricky situation. So I don't have a strong opinion on it. I'm more so on the side of don't vacate it. It happened. We're going to punish people how we punish them, and let's move on.
Yeah, Manfred's definitely got his biggest test of his time as commissioner now. Let's shift gears and talk about you and your career. You recently made waves when you left Wasserman, your traditional agency. Now you're working with Rachel Luba.
Yes.
That is your agent. Tell us a little bit about that relationship. She's really interesting in the sport.
Yeah, so I met Rachel actually back in college. We had a class together, became really good friends. She came up as a gymnast. She was a gymnast her entire life, was a UCLA gymnast, and then when gymnastics career ended, she taught herself the baseball industry, hung out with a lot of the baseball guys, and kind of was good friends with everybody there at UCLA, and so has done a really good job of actually teaching herself an industry that, obviously she didn't play growing up, so doesn't really have that advantage of some people in that walk of life, but done a really good job, went to law school, passed the bar, all this different stuff, and has amassed an amazing amount of knowledge in a short amount of time. And also, so one of my best friends, but also a very innovative thinker in the way she goes about doing things and the way she sees the industry. I think sometimes having a fresh view of it, having not been in it, having not played, having not come out kind of in the traditional way, gives you a fresh look at things where you can look at certain problems and say, why is this done this way? And you just question it and you don't find a good answer sometimes. And you're like, okay, well, I'm just not going to do it that way. And it gives a really fresh perspective, and it's something that I try to do in all areas of life. In my baseball career, I try to look and say, okay, why do we train this way? Why do we pitch this way? And so I'm always asking that question. I have this kind of inquisitive mind of, I want to understand why things work the way they do. And if there's not a good answer, well, let's do it in a way that does have a good answer. Mm-hmm. And I really vibe with what Rachel and Luba Sports is doing in that standpoint. Just looking at the industry in a fresh way and trying to find ways to maximize player value and the player's career, both on and off the field.
Awesome. We are definitely seeing more women in the men's pro leagues in agent roles and in coaching roles, so only a good thing. Trevor, thanks for joining us.
Yeah, thank you.
Good stuff. That was The Blitz. Julie and Adam, back to you guys.
Dan, thank you. Coming up, the streaming battle continues. Comcast officially unveils Peacock. But what does the service need to do to stand out? Plus, before we go to break, let's take a look at some of the losers on the Dow right now.
Let's take a look at some of the trending tickers from yahoofinance.com. I'm looking at a teeny tiny company called iMedia Brands that is up 33% today and is on your watch list. It has to do with Shaquille O'Neal. Now, this is a company that owns various shopping networks. I think most of them are online, but they signed a partnership with Shaq. He's going to do a live show for them starting in March of 2020, and he's also going to develop a line of watches, apparently, linked to this deal. So something to keep an eye on. We're also watching Qualcomm today. That's after Citigroup upgraded that stock to a buy. The price target going from 89 to 108. You can see it's trading at 95.70 right now. This has to do with the prospects for 5G adoption and Qualcomm's connection to that. Also, increased royalties for the company. You can see the shares up 75% over the past year. We're also watching Schlumberger, the oil services giant. Those shares haven't done so well over the past year, but today they're up just about 1%. That's after its earnings and revenue beat estimates. The company also says it plans to further shrink its shale business. Interesting there. It has a big international exposure as well. So keep watching Schlumberger as well as we continue to see quite a bit of volatility in oil as of late. Adam?
We've been talking a lot about stocks on the move. We want to highlight one of the day's analyst calls. We're looking at Comcast. That company just announced the details of its streaming platform, Peacock. Comcast will offer a free ad-supported version of the platform, but much more. Wedbush's Dan Ives says the advertising approach is a smart move. He joins us now on the phone from Vietnam. I'm glad you had a safe trip, Dan. It's good to have you here. So why is advertising going to work for Comcast and Peacock?
Look, I think it's a watershed event in terms on the advertising model. I think the tiered structure is really the right way for them to go. I mean, I think they have the content, they have the distribution, and if you look at it today, 20 to 30% of TV viewership is streaming. Only 3% ad dollars are focused on that. That's what they're going after, and I continue to think that their sub-guidance is way conservative relative to how we see it playing out.
Hi, Dan. Will Rind here. Question for me is, we've got most people, I guess, in the market have some kind of streaming service that they're currently using, whether it be Netflix, whether it be, any one of the big ones. We've seen Disney enter the market very recently. Do we see, at what point do we start seeing signs of streaming fatigue here? And really, what's the value prop for somebody to start streaming this new service from NBC?
Yeah, I think you are starting to see some fatigue, but I think it also comes down to numbers. We think today the average consumer household, $35 are spending on streaming. We believe there's capacity for $55 per month. And I do think Disney is obviously a home run in terms of that coming out of the gate. But when I look at NBC, it's the content. And I think if you look at what they bring in terms of not just the shows, but on sports in particular, and I think especially going into the Olympics later this year, that's going to be a catalyst. So they have the library, they have the content, they have the footprint, but for them, they need to do a balancing act. And that's why the advertising model is key for how they're going to go after and maybe following the Who's lead.
Hey, Dan, I want to follow up on the advertising bit. The interesting twist to their advertising model is that they're actually going to limit the actual amount of ad time to 5 minutes per hour watched. Does that put an unnecessary cap on the type of advertising revenue they can get, or is that a strategic play to try to lure people away from the other streaming services?
Yeah, it's a great question. I mean, you just nailed it on the head, because I think they need to make sure that consumers go onto the platform, attracted to it, and then ultimately over time they can increase that advertising per hour. I think that's a smart move, sort of the balancing act in terms of what you want to see. But I think over time you could see more ads as they have more content. And right now they have to price it aggressively. And we continue to think this, combined with Disney, combined with Apple, HBO coming out in the spring, is going to put pressure on 10% of Netflix's install base from a sub perspective in terms of disruption. And that's why I think finally there's there's other shows in town, and I think specifically with Disney, that's a disruption for Netflix.
And just I want to reiterate a metric you gave us. You still think there's room to get to $55 for each household to spend on streaming, correct?
Yeah, so that's why if you look at it, going from 35 to 55, still capacity. Definitely fatigue out there, But if you look right now, especially the HBO coming in the spring, there's going to be some winners and losers. But as of right now, we think Peacock's a winner in terms of the way that strategically they launched it.
Dan Ives from Wedbush, thank you for being here on The Move. Coming up, big tech gets even bigger. Alphabet just joined the $1 trillion club, which includes the likes of Apple, Amazon, and Microsoft, plus staying together. Gap cancels their Old Navy split. We're going to bring you the details straight ahead. It is 12 o'clock here in New York City. We are 2.5 hours into the trading day, and stocks are trading higher. Oil was falling earlier today. It continues its trajectory. However, it's reversed. It's higher, $58.55. I reversed in my saying of that. Trade takes its toll. China's newly minted Phase 1 trade deal with the U.S. doesn't come soon enough as the country sees its slowest economic growth in nearly 30 years. $1 trillion club. Alphabet becomes the latest big name to hit the valuation, joining the likes of Apple, Amazon, and Microsoft. And change of plan. Gap shares are falling right now. That's after the company canceled plans to spin off Old Navy. Welcome back to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. Let's get to the floor of the New York Stock Exchange. Yahoo Finance's Inez Ferre standing by as we see this mixed picture now. You're looking at shares of Qualcomm, Inez.
Julie, Qualcomm actually hit a 52-week high today after being upgraded to a buy at Citi, with the analyst note saying that Qualcomm is one of the most exposed stocks to 5G, saying that Qualcomm will benefit from the 5G upgrade cycle. Also taking a look at Western Digital, that stock is not moving too much, even though it was upgraded at Wedbush to outperform with a price target increase there. And then just taking a look at JB Hunt being the worst performer on the NASDAQ right now at its session lows. This is after missing on earnings for the fourth quarter. The truck segment revenue for the fourth quarter was down 20%. In part, the company says that the results were impacted by higher building expenses related to the final mile network, which it's building, also technology spend on applications, and also some higher costs related to driver costs. Adam, Julie.
Inez, thank you. And then there were four. Google's parent company, Alphabet, has become the latest company to hit a market cap of $1 trillion following tech rivals Apple, Microsoft, and Amazon. By the way, Amazon no longer has that $1 trillion market cap. This, of course, comes amid a long rally in FANG stock. Google reached its latest numerical milestone as it is facing some of its biggest tests, including stricter regulatory scrutiny both in the U.S. and around the globe. With us now to discuss this is Tom Forte, D.A. Davidson Senior Research Analyst. And are they well positioned, do you think, to deal with the regulatory headwinds they face globally to maintain their valuation, or at least their market cap, at $1 trillion plus?
Sure. So first off, Adam and Julie, thanks for having me on. The way that I think about it is this is a tremendous accomplishment. So when you think about Google's history from search to mobile with Android, and then the emergence of YouTube, I think it's an amazing accomplishment. But Adam, I really like your question because I've been thinking a lot about this. I talk about the four horsemen of big tech: Amazon, Apple, Google, and Facebook. And I think global regulators are realizing and coming to terms with the notion that they have too much influence on consumers' lives. And I anticipate that you'll see more regulations on a global basis to address that. So you had GDPR in 2019, and then more recently of California with their privacy laws taking into effect in January of this year. And I think that's going to pose challenges to a couple of your $1 trillion club there on sustaining that valuation, including Google.
I'm also curious with Google specifically, when you're looking, aside from regulatory challenges, there was a narrative for a while that Alphabet had to diversify in terms of getting more diverse revenue streams. And it hasn't really done that, has it? And it hasn't really mattered, has it?
Well, the diversification, I think, comes from YouTube. But I think you point out something excellent, which is I've been talking a lot about Amazon and breaking up duopolies. And I think Amazon has an opportunity to break up the duopoly in shipping, that is FedEx and UPS. And Amazon has an opportunity to break up the duopoly in digital advertising, which is Facebook and Google. So to me, the diversification for Google has been, again, the emergence of YouTube, but they're still heavily dependent on search, and they're still heavily dependent on advertising in general.
Tom, I think everyone has talked a lot and focused a lot about the risks to Alphabet share price and the risks to the business. But maybe riffing a little bit off the last question, what do you think are the opportunities here for investors in Alphabet, specifically, in areas such as autonomous vehicles, where they have been one of the leading companies in that field? What do you think are the opportunities or the bright spots for the company?
So two things. One observation on what is the commonality other than tech for the 4 trillion or near trillion market caps, and it's cloud. And you see that with AWS for Amazon, Azure for Microsoft, and Google Cloud for Google. So they're clearly starting to do better in cloud computing, and that's clearly a large opportunity with sustained growth and profitability. On the autonomous driving, you bring up an excellent point. So having just attended the Consumer Electronics Show, I think you just talked about Qualcomm and 5G. So one of the benefits for 5G in general is the ability for advancing autonomous driving, and Google's certainly been an early adopter there, as they've also been an early adopter in drone delivery, beating Amazon to be the first to do a commercial delivery in the U.S. via drone for Walgreens. So I do think that autonomous driving is an interesting opportunity for Google in the future, but those companies, the $1 trillion club, they're doing an amazing job leveraging cloud computing as well.
Hey Tom, Brian Chung here. Can we talk about the pending acquisition of Fitbit? Does this signal maybe further away from Google, and how does that represent maybe their future trajectory as a company that might actually be trying to get into wearables and take on the likes of Apple?
Yep, so excellent question. And normally I wear both my Apple Watch and my Fitbit watch. Currently my Fitbit watch is charging. But I look at that acquisition and I look at it as Google realizing that they were behind Apple in healthcare data. Because we could talk about it being a hardware play with Fitbit's devices, but I really think it's more of a data play. Google wants to have the healthcare data, wants to know when consumers are on the move, wants to know how active they are and things of that nature. And I do wonder if it'll face more regulatory scrutiny given my prior comment. But I thought that was an amazing acquisition by Google from a healthcare data standpoint.
So potentially another opportunity. Thank you, Tom. Tom Forte, D.A. Davidson, Senior Research Analyst. Always good to see you. Thanks.
Looking now to China, the nation's officials say its economy expanded last year by 6.1%. That's well within the government's target range, 6% to 6.5%, but it marks the lowest level in nearly 3 decades. This comes after China signed that trade truce with the United States. Will, I want to start with you. So much talk is that all of this was priced into the market. Did the market price in what has to happen next?
In some respects, yes. I mean, I think, some people will look at the 6% figure and say, oh my goodness, China's economy shrinking. This is the lowest level in so long. But in relative context, 6% growth is still roughly 3 times that of the US. So this is an economy that's still growing pretty quickly. I think people will obviously focus on the bad spots, such as some of the non-performing loans, the state-owned enterprises, and there are a lot of risks which are very hard to quantify. But I still think that this number shows that the Chinese economy is still growing strong, and that, from a relative perspective, this is still an economy that is very much in growth mode.
And there's no way to really know how much it would have grown if there hadn't been a trade war. I mean, maybe it still would have been the same amount.
And another thing, too, is when you bring that up, what the alternative would have been if there wasn't a trade war. What we do know is that China had its own capital measures in place before Trump was even president that kind of underscore the concerns that China has with its own economic pace of growth. I mean, I actually just published a story recently from Los Angeles describing how the lack of foreign direct investment from Chinese investors in the United States was really spurred as a result of the Chinese efforts to try to lock down Chinese investment from going abroad. That's a separate issue from the trade war, but what we see is that even if the trade war winds do subside, if there were to be a phase 2 deal signing, there's still that negative aspect to a lot of U.S. businesses saying, look, we're still not getting investment from Chinese companies.
And the global economy is so dependent upon both of us growing, but there's this term that you keep reading about, middle class trap with China. Can they get back to above 6%, or will they continue slowly to fall below it because of that fact that they've kind of reached the peak with their middle class?
Yeah, in some respects, as the law of large numbers are constrained in many ways by the size of the population and obviously bringing so many people into the middle class kind of already. But I think the scope for growth is obviously going to get more challenging, as the years go on, because they're having to put more leverage into the economy in order to try and achieve that. But certainly the economy is growing, and I think it is possible, although it's going to become harder and harder.
And there's also been the argument that this trade deal would be good for China. And we already saw some early examples, right? I believe it's Goldman Sachs has now said it's going to be getting into, pretty much right after the deal was signed, we had an announcement that Goldman Sachs was going to be getting into business there. So one would think there would be more of that coming.
Yeah, definitely. I think the phase 1 trade deal by all standards is a step in the right direction, but a lot of people wonder if it's the new normal to continue to have the 25% tariff on the $250 billion of goods, which I think a lot of people might not be aware is still in place after the phase 1 deal signing. So you still have that in place. You still have questions about whether or not the forced intellectual property and the forced technology transfers will actually be enforced under this deal. So there's a lot of looming questions. It's not like all of those problems have been solved with the signing this week.
Right.
All right. So, yes, some of us did have the chinos from Gap with the black T-shirt. That was so 1990s. Take a look at Gap shares right now, because today, in the here and now, the company has announced that it's calling off plans to split Old Navy into a separate public company. The company also announced President and CEO of the Gap brand, Neil Fiske, is going to step down. In a press release, interim CEO Robert Fisher said the change of plans come after the company realized that, and this is a quote, the cost and complexity of splitting into 2 companies limited our ability to create appropriate value from separation. Brian, how complex is it really to split a company?
It's complex to split a company. It's even more complex to say you're going to split a company and then psych, you're not. So, and we need to keep in mind, too, that the management is something to watch here, too. It's an interim CEO that's at the head of the company. That's Robert Fisher. So, it's tough to speculate. I don't want to say for sure if this is the case, but you do wonder if the internal rumblings of the people shifting musical chairs within the company is the reason for why you have this flip-flop on what the strategy is.
Oh, definitely, because Art Peck was the CEO. Exactly. This was what he was going to do under his tenure. What's also interesting here is Gap, for many years, when it was doing better, was talked about as a potential target for private equity, but because it's family controlled, Robert Fisher being the son of the founders, it wasn't something that was viewed as likely to come to fruition. So, you have to wonder if the family's now saying, maybe we should have sold it.
Right. So, it seems like it's the great screenplay for maybe a TV show like Succession or something like that. But what we do know from a business standpoint is that Old Navy was one of the bright spots of this business line. You walk into any Gap store, And it's a mess. But you go into any Old Navy store and it's always bustling with people. I live nearby one in Brooklyn. It's always packed to the brim. But the thing is, when it comes to the business of spinning off your business lines, picking the best of your brightest and then deciding to spin that off is an interesting strategy. And I wonder to what degree they decided and looked at the numbers again and said, maybe we should be divesting the other business lines.
Well, and the problem is when the best and brightest aren't always the same. It waxes and wanes, right?
The brands within the Gap family are Gap, Banana Republic,
Athleta, Hill City, which is a men's athleisure brand.
Okay, so we've seen what you just described via Sears. Sears sold off its profit, you know, what was it, the Die Hard.
Tools and
Kenmore, all of that has been sold off. In the grander scope of things, retailers of this scale and size, what do they do? I mean, they're in
That's
a
great
world,
question.
you know, that...
I think as to what Brian was saying, I think it's a little bit of stronger together because you have the Old Navy business, which has been performing well, as Brian says. You know, stores are packed, and particularly popular with, you know, families that have children, but the Gap business not performing as well, and then I think, you know, potentially there's a decision to say, well, the family's stronger by keeping everything together rather than getting rid of potentially the best asset.
And as Will was saying, I mean, the trend of divestment has actually been the name of the game for a lot of these large companies. When you think about Kraft Heinz, when you think about even XPO Logistics, right? Yesterday announcing that they'd be spinning off some of their business lines. DuPont. But they held on, XPO in their case, they're holding on to what they see as a really bright spot of their business. That's the North American trucking. So again, it might be tempting to sell the brightest part of your portfolio because you can get an attractive multiple for it, an attractive valuation for it. But then guess what? That leaves the rest of the company, the shell of the company, with the assets that are the reason why you've had to spin it off in the first place. So it's a question of management. There's a financial attractiveness to maybe spinning it off, but from a strategic standpoint, it really is a question of whether or not it's viable in the long run.
Okay, so here's my quick informal survey. Has anyone here in the last, I don't know, 3 months been inside one of a Gap branded store, either Gap, Old Navy, Banana Republic? I've been in Athleta.
Yes.
Buy anything, though.
Yes, and here's why, Banana Republic. But it's what we talked about an hour and a half ago. They always have a 40% off sale. So you can get a sweater that they always say is $75, and you get it for almost 50% off.
That's not good from a branding standpoint.
No, it's not good at all.
But it's good for Adam.
It's great. Look, I like Banana Republic, but I'm the generation. I will gladly point out that chinos and a T-shirt is not hip. I mean, your generation, that's not what you wear.
I have one T-shirt from the Gap, but that's it.
You know,
all right.
Yeah.
I'm the generation that wears chinos and lines up in front of the fairway.
Coming up, have you ever heard of a stock being too expensive? How's that measured exactly? We're going to break down the price to earnings ratio in this week's Yahoo You. Plus, before we go to break, let's take a look at the winners on the Dow right now.
Record highs, but losing a little bit of steam here. Welcome back to On the Move. I'm Jared Blickery. We got the Dow up 53 points, or up 18 basis points. Let's take a look at the price action here, and we can see that we briefly dipped in the red, but have now rebounded nicely. Maybe going to test those session highs again. Here's the S&P 500. Managed to avoid the red the entire day, still holding above 33.25, an important strike level earlier this morning, as we did have options expiration on the open for the index options. Let's take a look at the VIX here. That is holding above 12, but that is still a very low level. We've been tracking some of the longer-term charts we did in previous segments. Not going to rehash that, but we want to keep an eye in case it breaks out over the coming days or weeks. And here's a 10-year T-note yield. It's now up only 2 basis points up, was up about 3 basis points a little bit earlier, and we're seeing financials outperforming as the 2s10 yield curve has expanded by about 4 basis points or so to 26 basis points total. Let's also take a look at the U.S. dollar index, because that's another one we've been keeping our eye on. That has been rallying throughout the morning on a 2-day up streak, and it's poised to close at the highest level in a couple weeks. We want to keep an eye on that because that has important ramifications for the global markets and emerging markets and whatnot. And then finally, gold futures here, they are holding above 1550. Nice rally in gold over the last few weeks, although we are definitely off the highs, those spike highs that we saw last week. Here's a NASDAQ 100 heat map. Mixed picture in terms of the big caps there. We have Alphabet, trillion-dollar company, that's up 1%. Apple up 0.5%, but Microsoft now dipping in the red along with Amazon and Facebook. If we sort by performance here, we see Qualcomm is the leader, up 4%. Some other chip stocks doing nicely. The SOX, by the way, at a record high. To the downside, JB Hunt down 5%. NetApp is down almost 5% as well, and then Kraft Heinz. Stick around, guys. We're going to be back in a minute.
Let's switch gears. How is stock valuation measured? You may have heard of price to earnings ratios, but how should we interpret them? It's time for Yahoo You. Brian Chung is here with this week's lesson.
Hey guys, you ever go to a store and you look at all the different types of wine and you try to figure out, well, what's expensive and what's not? I mean, sure, the $2 Chuck might be great, or maybe it's that old vintage Pinot Noir that was expensive, but you know what? It was worth it. Well, the same kind of thing exists with stocks. So class is in session, and today we're talking about one way to measure the relative expensiveness or cheapness of a stock. That's price to earnings ratios, or PE ratios. Now, you've probably seen it before. So here's what you might see if you pulled up the Amazon stock on Yahoo Finance. So the PE ratio will be right here, right? PE ratio TTM, at the time that we were looking at it, it was around 83. But is this high or is this low? And what does TTM mean? So let's unpack it. And as the name suggests, the price to earnings is the price of the stock divided by the earnings per share that the stock delivers. So in this case, we measure it as earnings per share delivered over the trailing 12 months, which is the TTM on the page that I just referred to. So if you break down the actual Amazon PE ratio, guys, does anyone have the current price of Amazon? Because that was a screenshot from earlier.
Yes.
Julie, it is at
1867.63.
1867.
I don't know if you want to round.
No, we're going to get the whole thing. So 1867.63. So that would be the numerator in this case. Now, does anyone know what the earnings that it delivered over the last 12 months is?
$22.57.
$22.57, that is correct. So I am going to pop that into the denominator here, $22.57. Now I am going to punch this into a calculator because I don't want to quiz you guys any further. So that is 1867.63 divided by 22.
Live math, ladies and gentlemen.
Live math right here. Now it's actually decreased since the time that I showed you that screenshot to 82.75. So that is the current PE ratio. Now, this is the number, again, that we will be measuring, but is that expensive or is that low? Well, you'll recall that earnings per share is actually a measure of how much each shareholder would receive if the company's net profits were carved up and distributed evenly. But owning a share comes with a price, so the price to earnings ratio should, in theory, represent the return of a business against how much it costs you to buy a share of that company. So put another way, if you invest $1 into Amazon, you're investing in about $82 of earnings. So that's why PE ratios are often called multiples. It represents the multiples of earnings that you're buying when you invest in a stock. So what I'm showing you next here is a historical chart from macrotrends.net that maps out the PE ratio over the last 40 years for the S&P 500. So right now we're trading at a PE of around 21. So companies trading above that, like Amazon, well above that at 80 something, may be considered more expensive than the market or trading at a higher multiple. Now, those that are trading under 21 may be considered cheaper than the market. But is 21 itself expensive by the S&P 500 by historical standards? I mean, you'll notice that it was really nowhere near where it was in the dot-com bubble. And then you'll notice that the great financial crisis, it literally was off the charts. It was about 122 in early 2009. We didn't want to expand the y-axis that far. So this makes sense, though, right? During the financial crisis, company earnings contracted. In some cases, they were even negative, which means that the denominator of the PE ratio that I just showed you falls sharply. And that jacks up the PE ratios on S&P 500 companies as profitability gets crushed. Now, as you may have noticed, the PE ratio that I showed you is actually backwards looking because it measures a company's price against earnings that it already reported. But there's another kind of PE ratio that I want to show you, and it's called the forward PE ratio. It's the same general idea, but instead of earnings per share TTM or trailing 12 months, it's actually the earnings in the next 12 months. And analysts and companies will often project their earnings in the future, and that gives investors an idea of where the company is growing. A forward PE ratio that's higher than the current PE ratio may suggest that the company may be overvalued right now. Now, conversely, a lower forward PE ratio may suggest the company is a cheap buy. Again, just suggests. So here's a chart now of the forward PE ratio for S&P 500 companies since 2004. And this particular chart comes from Goldman Sachs. You'll recall that the backwards-looking PE ratio right now is about 21. But the forward PE ratio, according to this chart, is 18.8, close to 19, with Goldman suggesting that the baseline expectation for future forward PE is a tick down at 18.6. Now, does this suggest that the expectation is for earnings to increase? Does it suggest that there are buying opportunities in the market? Well, before you decide, remember that forward PE ratios have a lot of moving parts. So first, how do you know that the earnings forecasts are correct? And secondly, how will the price itself move over time, especially if it's a high volatility stock? So guys, just like going to the store and buying wine, how cheap or expensive it is really quite subjective, but the PE ratio is at least maybe one way to baseline that.
Yes, and we talk about it quite a bit.
All right, our next guest remains positive on the state of the global economy and the strength of equity markets in 2020. Tim Chubb, CIO at Gerard, joins us now on the phone from King of Prussia, Pennsylvania, with more on this. And I don't know if you were just listening or able to see Brian's explanation of earnings multiples. But given what he's just told us, I'm going to ask you the question that I think some people are looking at. Right now, do you consider equities to be overpriced or are they underpriced, given what you expect to happen in the coming year?
Yeah, and thanks for the great summary. That was Valuation 101 and really helpful, I think, for watchers. And yeah, I think the market right now is fairly valued to overvalued. We're trying, as always, as investors, to be forward-looking and estimating as best as we can what future cash flow and revenue and earnings growth looks like for these companies. And so when you look at an S&P 500 multiple right around 18.5 to 19 times forward earnings, it's definitely above the elevated levels that we've seen in the last 5 years, or right around 17 times. And part of that is a function of how low interest rates are. So as we saw if you look at the chart and look over the course of time, when we've had a higher interest rates and a higher bond yields in an environment where growth has been much more stronger than where we've currently been at, the S&P 500 multiple is going to be a little bit lower. And so for where we're at right now, while the market looks overvalued or fairly valued by historical standards, just looking at the multiple alone, it looks a lot more attractive relative to bond yields right now.
And in particular, when you're looking at the groups that maybe are attractive here, I know you're looking at technology, healthcare, and industrials. Within those, certainly technology valuations have stood out as being higher than historical. But it sounds like you still think growth is going to be attractive, even amidst this whole debate over growth versus value.
We do. I think technology offers a lot for investors. There's certainly growth, but a lot of these companies can be anything they want to be. They've got a tremendous amount of cash on their balance sheet. They have very low debt. And they're really in a space where there's a tremendous amount of innovation taking place. And so when you look for the next year, 5, 10 years, the amount of spending that's going to take place on cloud computing, on automation, in the healthcare space, on gene sequencing, and really these secular growth trends offer a tremendous amount of growth that, if you're a long-term investor, it's a fantastic time to take advantage of. And sometimes you have to hold your nose and buy some of these companies at a little bit of a higher multiple to experience that wave of secular growth. But industrials offers some opportunity as well. It was a sector that underperformed a little bit last year as we saw weakening manufacturing data across the globe. And PMIs has seemingly stabilized in recent months. And so I think if we see tariffs eliminated or further reduced, definitely a firming of global growth and spending within businesses and CapEx and inventories, I think industrials stand to benefit from some of the growth that we could see in the global economy in 2020.
Tim, Will Rind here. Just a quick question for you. Obviously, 220 outlook from yourself. What do you think is the biggest risk in your mind to the market this year?
I think beyond the obvious and very hard to predict and compensate for being geopolitical, especially as we're in an election year. I think one of the larger risks is finally starting to see more accelerated wage growth and then ultimately inflation. This ageless U.S. business cycle has really benefited from a lot of structural disinflationary pressure within the global economy. And at some point, as the U.S. consumer continues to get stronger, the competitiveness within the job market continues to put pressure on wages higher, I could see maybe some of the margin expansion that's going to go into that earnings on the denominator of the PE multiple come under pressure. And so if profit margins do not expand to the 2018 highs that we saw just a year and a half ago, I think that could be something that could cause the market to be volatile in the short term and just put pressure on earnings expectations throughout the rest of the year.
Tim Chubb, thank you for joining us on The Move.
Coming up, meeting of the minds. Elon Musk gave Jack Dorsey advice about what he can do better for Twitter. Plus, before we go to break, let's check on FANG stocks as we've been watching them. A lot of tech news today, and we're seeing a mixed picture for them. is about 12:30 here in New York City. 3 hours into the trading day, stocks have now ticked back into the green, although the Nasdaq just barely. And we've been watching the 10-year Treasury yield as well because it's been coming back up a little bit. We've seen some selling going on in the Treasury market. It's up just 2 basis points right now, 1.83%. Meeting of the mind. Jack Dorsey asked Elon Musk to help him fix Twitter. We'll tell you the pointers that Musk gave him. A driver's point of view. A new camera shows what the driver sees in front of the vehicle and behind the wheel. Welcome back to On the Move. I'm Julie Hyman, and turning to females in finance. 100 Women in Finance is a nonprofit operating with the goal of achieving a 30% female occupancy in investment and executive leadership roles in 2040, by 2040. 100 Women in Finance Chief Marketing Officer and founder Sarah Dyer joins us now for this week's Women and Money segment brought to you by USAA.
Thank you.
What could be more women in money than this? 100 Women in Finance. You guys have 15,000 members.
It's a bit of a misnomer at this point. But
yeah.
In our early days, it was an accurate
it was 100 women. So, I mean,
women.
so that sort of speaks to the progress that has been made.
Certainly does.
But to the point of your goal of getting more women in executive positions, that speaks perhaps to how far we still have to go.
Still have a ways to go there, yeah, but the trend is positive. We'd like to see it accelerate. We'd like to see more women on investment teams as analysts, as portfolio managers, knowing that in the traditional and even in the alternative segments of the finance industry, those are important pathways to the executive suite. So we spend a lot of time encouraging the pipeline in that direction and women to aspire and aim high.
And how do you do that exactly?
Yeah, there's no one magic way to do it. The first way is to support the women who are already there, to give them a strong peer network, to give them educational opportunities, opportunities to be visible, to expand their personal profiles. We think that's really important. But in order to achieve our goals, we really have to think much earlier. And our organization has really adopted, or has recently adopted, a plan to promote the finance industry to pre-career young women, teenage girls. And we're doing that globally with a lot of exciting programs and program partners around the world. And we think that's going to help grow the front end of the pipeline so that there are just more women in these spaces and eligible for the executive positions.
When do you think that we will see a woman running a major Wall Street bank?
Oh, I mean,
we feel a little overdue.
Yeah, but I think that there are, you know, certainly people on the cusp of that now. So I hope it is an inevitability, and I certainly know an organization of 15,000 members will be very pleased to celebrate that when it does happen. So,
you know, we hear a lot from the banks that they want this, right? They want more diversity. They have these goals. Are you finding them to be a real partner? In other words, you know, we talk a lot about whether it's, you know, we've been talking a lot about climate change and ESG. We talk a lot about diversity, and we talk a lot about sometimes a disconnect between what companies say and what they do. Do you find that they're following through on their promises and goals?
Yeah. Julie, I do. I mean, I think that some of the challenges are systemic and societal. We have an opportunity to see, you know, the way many organizations work, their internal programs and priorities to help encourage this type of thing. One of the biggest hurdles is getting women through the mid-career phase. And it's challenging for all the reasons that everyone knows. But we think that if that nut can be cracked, the corporations are, for the most part, really excited to welcome the executive women who will come through that phase of the career and put them in those leadership positions.
So we talked about teenagers, we talked about people in mid-career and in career. The chunk in the middle of all of that is education, is higher education, right? So what do you feel like universities are doing in terms of fostering financial careers for women?
Yeah, well, we see a lot of schools have have investment clubs, have programs to help nurture and encourage, inspire young women in that direction. The nonprofit sector is also pretty active in that space. There are terrific organizations like Girls Who Invest, Portfolios with Partners, Portfolios with Purpose rather, and many others who are looking to cultivate that new cohort, not only among women, but among more diverse candidates for investment roles, which I think is a really exciting development and something to watch.
All right, well, we'll be checking with you to see how all of this is going. Sarah Dyer of 100 Women in Finance.
Thank you so much. Yeah, it's a pleasure to be here.
Thanks. Coming up, the camera showing up in your Ubers. The Lytx CEO joins us next. Plus, from one CEO to another, Jack Dorsey asks Elon Musk how he can fix Twitter. We'll have his answer next.
Take a look at the top trending stories on Yahoo Finance right now. A Texas school district was scammed out of $2.3 million in a phishing email scheme. Back in November, an employee at the school district authorized 3 payments to an unidentified vendor. The employee did not notice the change in the bank account information. Local officials say they have strong leads, but they have yet to find a culprit. A new study says adults in the U.S. who binge drink are drinking even more. CDC researchers discovered that the number of adults who excessively drink jumped from 472 people in 2011 to 529 in 2017. The study also noted binge drinking increased among those with lower education levels and household incomes. Louis Vuitton acquired some new bling. The world's second largest rough diamond is a 1,758 carat Sewelô, and it's Botswana's largest diamond. The rock has been around since 1905 and was recovered last April. Louis Vuitton plans to work with Lucara Diamond Corporation to turn that diamond into a collection of fine jewelry.
Well, a driver's point of view. This drive cam made by Lytx records what a driver sees in front of the vehicle in addition to footage of the actual driver behind the wheel. But drivers aren't the only ones who are using this new technology. The investor world is too, and they're getting involved. European private equity firm Permira just announced that it is acquiring a majority stake in Lytx, which brings its valuation to an excess of $2.5 billion. Lytx CEO Brandon Nixon is joining us now from San Diego. So there's been a lot of interest in this kind of technology as of late. What makes a driver camera different from other cameras? In other words, what kind of unique technology does it have to have?
So one of the more interesting trends in our industry is that the cameras used to be used just to record video. But 3 or 4 years ago, we've been able to embed machine vision and artificial intelligence into the camera. And so it can see by itself. So pointing out the windscreen, it can see other vehicles. It can see how congested the roadways are. It can see pedestrians, scooters, bicyclists, wildlife, any of that. And then the camera pointing on the driver, it can detect when they're drowsy or when they're distracted or if they're not wearing a seatbelt. And all this information is available back to the driver as well as the fleet manager. The way we look at it, it really is an extra set of eyes on the roadway for the benefit, and everyone needs a co-pilot.
Brandon, I don't know if you can see me or if you'll get to see the clip, but we're doppelgangers, so I just got to get that out of the way. I think we're looking at each other. This technology, there's a huge growth potential for cameras in vehicles in this way. Is there any likelihood that insurance companies might start requiring these kinds of devices in the cars that we drive?
Yeah, so our focus is really on the commercial fleets, and the commercial insurance providers are already involved. So they actually subsidize the use of the program for the companies that they insure. And really the reason for that is our technology has been associated with a reduction in frequency as well as severity of collisions anywhere from 50 to 80%. And so there's massive benefit, not just to the insurance company, but also the fleet companies as well, and then society as well. There's thousands of people on this earth because our technology enabled our clients to prevent the collisions that they would have gotten into.
Brandon, talk to me about how this fits into driverless technologies. One would imagine that cameras are a very important part of driverless vehicles, but are those companies developing their own technologies on that front, or are they using your cameras?
So we see ourselves as sort of the link between the drivered vehicles and the autonomous vehicles. The autonomous vehicle is a very, very hard problem to solve. And going point to point through, just think about a fuel hauling vehicle going through Manhattan and all the complexities there. So given the scale that we have 700,000 vehicles deployed with the largest cloud-connected camera network in the world by far. Our machine vision is monitoring about 1 billion miles every 10 days. To put that in perspective for your audience, that's 10 trips to the moon and back every hour. And all of that information is provided back into the neural nets to continue to help them learn, as well as deliver insights back to our clients.
Brandon, separately from what your business does, I got to ask you, because this has been such a big topic of conversation, about the fact that you're now a $2.5 billion company and you're a private $2.5 billion company. We've had so many unicorns and so much money in the private markets. From your perspective, why has it been attractive to remain private, and what would convince you to do otherwise and come public?
Yeah, well, the valuation on this transaction at $2.5 billion is an astounding number to me. If you look back 10 years ago, our company was valued at $35 million. So the increase in value over that decade is 70 times. But as excited as we are about what we've accomplished over the last decade, we're far more excited about what's out in front of us. There's 125 million commercial vehicles in the world, and we're sitting at 700,000. So there's a long way to go. We're always looking at the public markets and whether that's an option for us. We certainly are the size and the growth rate and the profitability. And then we'll continue to monitor that and see if it's an option we want to execute.
If you do execute that option, I hope you will consider coming here first to make that announcement, because we would like to continue telling your story. I got it. My brother from another mother. I am telling you, it's just like we are doppelgangers. Lytx CEO Brandon Nixon, good to meet you, and all the best to you.
My pleasure.
Jack Dorsey is reportedly asking Elon Musk for help with Twitter. In the past year, we've seen shares of Tesla rise nearly 50%, while shares of Twitter were only up about 4%. I'd like to bring on Yahoo Finance's tech editor, Dan Howley. What did Elon Musk have to say?
Really, it was kind of an off-the-cuff conversation. This was at an employee event. Dorsey's on stage, and Elon Musk is kind of video conferencing in. And he goes, "What would you do if you ran Twitter?" And then he jokingly said, "Do you want to run Twitter?" And Musk's response was, I want there to be a way to differentiate between real people and bots or botnets or bot armies. And that's a big deal for Musk because he obviously faces a lot of trolls on Twitter. That comes part and parcel with his personality because he is very active on the platform. So it makes sense that he would want something along those lines. And it's something that people really do want and would be a benefit to the service. The problem is when Twitter does something like this, when they go out and they kind of eliminate these bots and these bot armies or these huge collections, their user numbers plummet. And as a result, when they get their quarterly earnings, they see there's a drop in users and the earnings drop, or the stock drops.
What happens to Twitter after President Trump is no longer the fixture he is, whether it's this year or in 4 years? Eventually, President Trump is no longer president. He'll keep tweeting, but I mean, he has been a plus for this platform, don't you think? Or
no, absolutely. Probably the most high-profile user, arguably. But I think going back to what you were saying, Dan, I mean, it's incredibly difficult to differentiate in the platform between real and fake. And another thing with all these fake users or bot armies is the moment that they get rid of whatever particular segment they're talking about, another lot just crop up again. And it's this sort of, it's almost like whack-a-mole, isn't it, in terms of trying to get rid of these kind of bad actors. But I'm not sure there's an easy way to eliminate that.
No.
To be continued. Coming up, the governor of California is taking on homelessness. What he's planning to use for shelters is coming up next. Time for the buzzer beater round. 3 stories, 1 minute each. We will start with California's homelessness crisis at an all-time high. State Governor Gavin Newsom plans to use 100 FEMA trailers as emergency homeless shelters. Is this the right move? Because it's not a permanent solution, but these kind of trailers have been used for all kinds of things.
I mean, this is definitely a temporary solution. There are many other structural things that result in the high levels of homelessness in California, job retraining, food stamp programs, all of those types of things. So this is temporary, but I think it is hopefully a right step in the meantime to get some of those at least in some form of shelter.
Yeah, and that's kind of how they played it. They said, this is not a long-term situation here. Do you go out to California much? I mean, it does seem to be a big problem.
Not a lot, but yeah, I mean, I guess it's just an indication of how bad it's gotten, that you've got to draft in these trailers in order to try and, help with this issue. It's obviously getting to such proportion that, you're taking a radical measure.
Should the tech firms step up, maybe pay for some construction of some kind of housing or shelters?
Yeah, I mean, this is certainly a good question in Silicon Valley and San Francisco area, where actually a lot of developments from these large companies have driven out a lot of people to areas that they can't afford.
And they are, donating some money in some cases. All right, Silicon Valley startup Mojo Vision, it's in the works to create a smart contact lens. The eyewear will allow users to project images onto their retina, as well as help repair a person's poor vision. So effectively like a Google Glass, or what are they called, spectacles, but on contact lenses. It's not, I mean, they haven't actually made the thing yet, but I mean, you're not a contact lens wearer, but is this something that you think would take off?
Well, I wouldn't wear contact lenses for the sake of wearing contact lenses. And I'll ask you, because 2 glasses wearers, 1 contact lens wearers, my understanding of why most people wear glasses is because they hate contact lenses. So.
Yes.
Well, I guess there'll be glasses that will let you project things.
I have no problem inherently putting something on my eyeballs. I like the contacts. I like the issues of not having to have something physically on my face. But I love that video. It was like showing the constellations. That's the last thing I would ever care to want to.
Here's the problem, though, with this. If you're having a conversation, you're going to be so distracted.
Yeah, well, we're already distracted.
You'll be even more distracted.
Even more distracted.
Yeah.
This year, talent agency WME will serve a plant-based menu at its pre-Oscar party. The vegan dishes are in support of actors like Joaquin Phoenix, who is a longtime vegan and supporter of the animal rights movement. The reason I gave that a raspberry was that's all they're serving. You don't get a choice. I mean, they get to choose.
I mean, sure. Look, I eat meat. I'm not one of those like far meat people that's like, oh, there needs to be meat available at every function I attend. It's fine, as long as it tastes good. I've had plenty of vegan dishes that taste fine.
I think this is, it was almost sounded like a Ricky Gervais joke from the Golden Globes. They had a vegan menu for that, didn't they?
I think they may have, actually.
I don't think we can retell the joke right now, but for anyone that hasn't watched it, the opening monologue, I would definitely recommend having a view.
I mean, the Joaquin Phoenix at the Golden Globes, he's called out his fellow Hollywood community for taking jets and things like that, and so I guess he's gone vegan in part for environmental reasons.
Wasn't it? It wasn't for health reasons. It was for environmental reasons.
Yes. So, I mean, whatever. Let them eat vegetables. Let's take one last look at the market before we let you go. We have seen stocks kind of waver a little bit today, but still right now in the green. I want to thank Brian Chung for being here and Will Rind as well.
Thank you for being here as well, because we are heading into the next hour of trading, and Wi-Fi PM is going to steer you through it.
It is 1 p.m. in New York City, and the major indices are trading slightly higher to close out a week that saw new record highs each consecutive day. On tap for today, new data revealing China's growth continues to slow, sagging to its slowest expansion since 1990. Plus, housing starts back here in the U.S. come roaring back as new home building surges to a 14-year high. We'll chat what's behind that, and the WNBA scoring its biggest collective bargaining agreement in years, while the new agreement is helping close the gender pay gap among the best basketball players in the world. We'll chat with the treasurer of the WNBA Players Association and Las Vegas Aces center, Carolyn Swords, for what the deal just won, including paid maternity leave. All that and more. This is Wi-Fi PM. Good afternoon, everybody. Happy Friday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Brian Cheung, along with the co-founder and former CEO of Netflix and author of the book That Will Never Work, Marc Randolph, joins us back again in studio. Good to see you again, Marc.
Pleasure to be here.
That book, by the way, made our best business books of 2019 list, so still just as good of a read in 2020 as I would say. But we're checking the market action right now, and as I said, green across the board. You can see the Dow up 27 points, the S&P and the NASDAQ in the green as well. But first, what we're chatting, the world's second largest economy reporting new annual growth numbers, and it's the weakest we've seen in 29 years. Chinese officials say the country's economy expanded 6.1% in 2019, and we should note this was within the government's target range of expectations. And it comes after a phase one deal between the U.S. and China was finalized earlier this week, but the country is still grappling with the impact of that trade war, along with rising debt and slowing domestic demand as well. I mean, Brian, 6.1% would be a growth rate that a lot of people would be
It's double that of the U.S.
For. Yeah, no. So, I mean, there's that to put in perspective here. But nonetheless, I mean, clear that China is slowing.
Yeah, China's been slowing, and it's not necessarily just a function of the U.S. trade war. It's kind of hard to imagine what that growth rate would be like in absence of the China trade war. But, look, there's a lot of capital flows leaving China. China has put in a number of statutory rules in place to try to stop foreign direct investment from going abroad. One example being just the amount of cash that overseas Chinese can withdraw from Chinese bank accounts. That is not related at all to the U.S.-China trade deal, but basically they don't want consumers coming to the United States and working on these huge commercial real estate projects when they could be investing it back in the Chinese government to re-expand Chinese GDP growth. So I think that in the absence of the U.S.-China trade war, there are still structural questions in place about whether or not China can keep these crazy numbers going in terms of GDP growth, but definitely worth watching as it's kind of plateaued so far.
And we've seen that shift over the last couple of years to focus on more of a consumption-driven economy there in China, too, as they grow and expand into a more mature economy, too. That's been part of the plan under Xi Jinping to kind of have that be built out and kind of shift more into a U.S.-based kind of model, which they've come a long way. I mean, if you're growing that fast, that quickly, I mean, that's kind of where he wants to see things go. But Q4 numbers were 6%. And we saw that would be obviously slower than 6.1%, not the trend that people want to see continuing.
Yeah, absolutely. And I mean, this was the theme that we saw even at the beginning of 2019. People were saying the exact same thing when we started getting GDP numbers at the beginning of last year. I remember in Davos, you had Chinese state officials basically saying, yes, we acknowledge that our economy is slowing. That's not a bad thing. I mean, no country is meant to be growing at a 10% pace for perpetuity, right? But the question is, as it kind of slows down at 6%, still impressive, how do you continue to really fuel an economy that by population is still continuing to expand rapidly and hopefully is trying to grow its middle class at the same time? So it's not a question of what's the headline number in terms of growth. It's how are you capitalizing on that growth to make sure that it's actually helping the majority of the citizens.
Yeah, no, absolutely. And we're seeing that now. They're trying to do that with the trade war. That at least resolved phase one deal. We'll see if that can rebound. Of course, as we highlighted earlier in the week, China's consumer confidence numbers took a bigger hit than the ones here in the U.S., but we'll see how that plays out as we move along with a supposed phase two trade agreement in the pipeline. Well, back here at home, December housing starts soared to a 13-year high, jumping 16.9% last month to a seasonally adjusted annual rate of over 1.6 million units. It appears real estate is gaining momentum again amid low mortgage rates and the Fed cutting rates 3 times back last year. But I mean, the housing market, clearly, that's a hot rate. A lot of reasons to discuss why. Marc, even on the West Coast, I mean, we've talked about how crazy real estate prices are over there. That's another region that saw pretty significant growth.
You know, it's true. I keep expecting things to slow down, and each successive month, it seems like things are going hotter and hotter and hotter. I mean, I just wonder how long this can last.
Yeah, I mean, no one ever wants to really think back to the housing crisis that we saw back in 2008. Some of these numbers, though, are going back there. I mean, when we look at housing starts, it was 14 years ago where we saw numbers like this.
Yeah, absolutely. And, you know, you don't want to conflate exactly 14 years ago as saying, you know, we're headed into another financial crisis. But, you know, we have seen this, Mark, the anecdotes that you just point out in a lot of these major cities and a lot of corners of the country, even in the South, you're seeing valuations go, you know, basically skyrocket on a lot of properties. And a lot of that is probably because of the supply, which is why I think you see a lot of these housing starts, right? New production. It's because the inventory appears to be quite tight right now. A lot of people are racing and bidding on the same properties. So maybe you need to build more homes to try to occupy that supply. Now, of course, you don't want to overdo it, as we saw in the exuberance leading up to 2008, 2009. But I think this does show that we are still part of this expansionary process right now. Interest rates have definitely played into that as well.
Yeah, and a survey out on Monday showed confidence among home builders dipped in January, but remained pretty much near levels not seen since the mid-1990s. So even though that's going on, mid-1999, I should say. Builders, though, to your point, Brian, when you're talking about that, they did say they continue to grapple with a shortage of lots and labor, while buyers are frustrated by a lack of inventory, particularly among starter homes. So that may be part of the reason why if it's not out there, got to build these things, and that's what we're seeing. At least that's the trend right now. But we talked about the Fed cutting interest rates 3 times last year. The central bank also in focus in 2020 as President Trump announces his picks for the 2 remaining Fed governor seats. And Brian, you've been looking into who he's tapped for that, and again, not without controversy.
Yeah, well, does this news sound kind of familiar? It's because we actually heard it already. The nominations for both these individuals, St. Louis Fed economist Chris Waller and former Trump transition advisor Judy Shelton, were nominated back in July by the president via Twitter. It actually wasn't formalized and sent to the Senate until last night. So this is formally beginning the process of their nominations. These are for the 2 remaining board seats at the Federal Reserve based out of Washington, D.C. A few questions. First of all, is the Senate really going to take this up in an election year where they're also kind of dealing with, I mean, the last year of a Senate or any Congress is usually a lame duck year. But then secondly, they're also dealing with an impeachment trial right now. So whether or not they have the bandwidth to get these 2 kind of in place is a separate question. Judy Shelton appears to be a more contentious, kind of polarizing character. Yeah. She was someone that was part of the Trump team, so it might seem like the optics of getting someone that sympathizes with Trump's call for lower interest rates, trying to get that individual onto the Fed board.
See, yeah, that's what I was going to ask about too, though, right? Because obviously the Fed likes to talk up their independence from politics and all of that, but you get further and you move further and further along in this, and pretty soon, I mean, you're looking at him installing 6 of the Fed's 7 governors if these 2 get through. At what point is that out the window when you can't say you're independent anymore if Trump has put all these people in power, including Powell?
This is the thing. Everyone says the central bank is independent, but how independent is it when structurally everyone that sits on that board is appointed by the president? But I do want to note that the existing nominees from the president have appeared to be relatively neutrally perceived in Washington. You have Randy Quarles, you have Richard Clarida, Mickey Bowman. You know, these are all individuals who were nominated by Trump, but they had no history of a relationship with him. They were not part of the administration or of the transition team or his campaign in any capacity. They were well-respected businessmen and scholars in the community. These 2 appointees are completely different. I mean, Judy Shelton is definitely someone that was part of the Trump team, part of that circle. Chris Waller, a more conventional candidate, he is perceived to be quite neutral as well. The pairing of both of them together might seem like an effort from the Trump administration to try to kind of, hey, it's a package deal.
Yeah,
we'll give you one. We'll get another one.
Yeah, we'll give you one, we get ours. Everyone walks away happy, supposedly, so that's the plan, but we'll see. I mean, you're right, the Senate very busy right now with things going on. We'll see what happens with these decisions. But the Treasury Department is also giving us some new news to talk about when it comes to financial piping. It says it plans to issue a new 20-year bond in the first half of 2020. That's something that's kind of an interesting thing since we haven't seen that back since the 80s, right?
1986 was the last time we had
so it's been a while since we've seen a 20-year note. They also floated the idea of a longer-term note as well, but 20 seems to be what they're going with here.
Yeah, and by the way, 20 is not the longest-term bond that's available. There's a 30-year bond as well, but this just shows the voracious appetite for U.S. government debt. I mean, through the Trump administration, but administrations past, Democratic and Republican, we've seen the U.S. debt continue to rise and rise and rise, and that shows that people are willing to take on and buy U.S. government debt. A lot of that interest has been coming from abroad, where why would you invest in a Japanese government bond, a German government bond, when it actually has negative yields? So you're looking at the United States. It seems like it's just attractive. So that's why the U.S. government, I think, might be trying to capitalize off of this by introducing this category yet again. Yeah. As you mentioned, they might be interested in a 100-year bond. That would be structurally very interesting. That's never existed before. Other countries have implemented it, but it seems like the appetite for that might not be as attractive.
Yeah, they floated that idea. It looks like it didn't work out, and so they're going with 20 instead. It's a little bit more chewable, I would say. Not too much to chew on the 20-year, but we'll see what happens with that. Coming up, though, NBC finally unveiling its Peacock streaming service, including a free ad-supported option. How its launch will impact both Disney Plus and Netflix. Plus, California's trucking industry scoring a big win in its battle against the state's push to eliminate freelancers. More on that right after this. Welcome back. California truck drivers scored a very significant win yesterday after a federal judge temporarily blocked enforcement of AB 5 against their industry. Of course, AB 5 is a state law that went into effect on January 1st in California that forces companies to reclassify independent contractors as employees. And joining us now is Sean Yaden. He's CEO at California Trucking Association. And Sean, this law was aimed at gig companies like Uber and Lyft, but what sort of challenges does this law pose to your industry, since a lot of people actually are running these trucking businesses on their own?
Yes, thank you, Zach. It's good to be with you. The impact on trucking from this particular legislation, now law, as you stated, is really complete devastation to the industry. It's really obliterating a long-standing business model within trucking. And that's the business model for independent owner-operators, as we call them, the independent truckers, folks who have basically built their own businesses, investing, in many cases, their life savings to purchase a truck and really go into an entrepreneurial business model for themselves. Mm-hmm. And these folks have been doing this line of business for many decades. So it's a tried and true, tested business model and a major part of trucking that has been really put in a point of devastation by this statute.
Yeah, because it seems like a very complicated issue because you have those people who have invested in these trucks and are building it out as their own business, but you also have people who are who are underwater really in terms of funding these things and these operations who might be short-time freelancers as well. So it's not all the people that you're describing, right? There's also a mix of other people who might be freelancers who might be wanting AB5 because then they get some benefits here. So how's that mix break down? What are the percentages of people on both of those sides?
Sure. Now, within trucking, I think the best way I can answer that is there are thousands and thousands of employee trucking jobs out there today, and there actually has been a truck driver shortage for a number of years. So I would say that anybody with a commercial driver's license who is a truck driver really has the golden ticket. They can be employees if they so choose, and those jobs are out there. In most cases, many if not most cases, the independent truckers, the independent owner-operators, have been employees in the past. And through the course of the years, they've decided to go ahead and strike out on their own to build their own business. And in those situations, they go out and acquire a truck and go ahead and set forth to build that business. So there's that distinction between employee driving opportunities and independent contractor driving opportunities. And the good news for drivers, there are actually abundant opportunities in both scenarios.
Sean, Brian Chung here. What's interesting about the law when it was first implemented was that it affected so many different types of industries. It wasn't just trucking. Obviously, ride sharing seemed to be a target, but then it also affects the media industry. So when it came to the exemption that you guys had made a case for, what was it that's unique about the trucking industry that ultimately helped you make that case and then ultimately win the exemption?
Sure. No, that's a great question. So Congress back in 1994 passed the Federal Aviation Administration Authorization Act, also known as the F4A. And in that piece of federal legislation, part of it, they made very clear that when it comes to the movement of goods, they envisioned or wanted to make sure there would not be a patchwork of state laws across the country that would disrupt the flow of commerce. So they made it very clear that in any situation that could impact the rates, routes, and services as they pertain to trucking, anything doing that from a state level that would have a serious impact on those areas would not be permitted, that it's a federal jurisdiction, a federal oversight, a federal preemption. So for us, when the legislation was coming through and we saw how tight that test would be, and the fact that it would actually take away the opportunity for individuals to have that choice, to be able to be independent, we knew right then that we had a case that needed to be filed, and we followed through on that.
All right, well, there you go. And now, after that preliminary injunction, we'll have to wait and see how the case challenging AB5 as unconstitutional moves forward, as that will be the end answer here and how it might impact the trucking industry and industries beyond. But Sean Yaden, thank you so much for joining us. Appreciate it.
Thank you, Zach.
All right, well, there's a new member in the $1 trillion club. Google parent company Alphabet has surpassed a $1 trillion market cap, with the stock touching a fresh high earlier today. The tech giant joins the ranks of Amazon, Apple, and Microsoft in that prestigious $1 trillion club. But I mean, it's a long way that Alphabet has come, Google has come, in terms of getting into that club as well.
I'm not impressed. I want to see the first quadrillion. I want to see the first quadrillion company.
Yeah.
Which one's it going to be?
I don't know, man.
Uber?
I know. No, I don't think so.
You need a catchy name for it. I think is what, it can't be unicorn. That's passé.
Yeah, like mega unicorn. No, that exists too. So.
Well, yeah, the decacorns. You got decacorns every time you get over 10 billion. But I mean, it's a big club to be in. I'm not sure if any of those names particularly stand out, and the biggest one, the best chance to get there, because at some point they kind of are all meshing together and merging industries. You even got Apple into the streaming business now too. So it's kind of hard to predict.
Well, I think what's happening is these companies are not specialized anymore. They're becoming really large, multifaceted companies. And I think these prices is showing that people have confidence, not that they're doing well now, but they're going to do well in the future. This is in some ways a model of how people are going to receive tech services.
Yeah.
And I think something that's kind of buried underneath the bull case for a lot of these companies is these government contracts. It's become increasingly a big deal. It's been catching a lot of headlines, especially with the JEDI contract, for example, all the jockeying between the large cloud service providers over who was going to get that big Department of Defense contract. We like to think about all the cool consumer goods that these companies provide, but I think those government contracts are really going to be the big name of the game. Yeah. Think about the defense industry, the Northrop Grummans, you know, the ATKs of the world. I mean, those are all continue to be massive companies. That's going to be the name of the game for these tech companies going forward.
Especially if you're locking out all the other international companies as well. If China's tech companies become national security threats, then where else do you turn but some of these big names that can actually get the job done? But that's a really good point as we move forward, too. Mark, we just touched on Apple moving into the streaming business and the streaming wars. It's good to have you here because they continue to heat up. NBC Universal unveiled the pricing of its new streaming service Peacock yesterday to investors. The company will offer a free version with ads along with 2 other subscription tiers starting at just under $5 and $10 a month respectively. So offering customers variety there with a free option. What's your take?
So first of all, I think it's great that Peacock's been announced. We've known this is coming. Yep. We know, of course, HBO Max will be coming out later in the spring. And I think in some ways, having this assortment of services is a great thing for consumers. I mean, we have, 700 scripted shows now. There's actually almost 250 streaming services.
That's a lot. Yeah.
I mean, but it's choice for all of us. But there's actually, I think, 2 other things. I mean, one is, in some ways, Peacock and eventually HBO Max is a validation that this is the way that people are going to be consuming television. You know, Netflix has been doing this since 2003, and they were in the wilderness for many, many years. And all of a sudden now it's being embraced. And I think that's somewhat validating. But the other thing that I like about Peacock coming in and HBO Max is it's going to keep the industry on its toes.
Yeah.
This is where innovation comes from. This is what ensures we don't have complacency. I mean, for example, Peacock, as I understand it, is going to have some more innovative things. It's going to be combining live TV. It's really trying to find this balance between time shifting to give people a reason, perhaps, to do something they can ultimately watch for free later.
But you mentioned choice, and that's the very interesting thing here, too, because having an ad-supported option, even some Netflix investors have been calling for a free ad-supported tier to be offered at Netflix. Do you think that move by Peacock adds pressure on Netflix to finally put out a free ad-supported tier?
I quite frankly don't think that Netflix feels threatened by any of these entries. I think they still continue to see their competition, not Disney and not HBO Max, not Peacock, but they see their competition as other forms of television consumption.
Yeah.
I mean, still more than half of TV now is consumed linearly, and all these companies will benefit from expanding into that category. I don't think they feel they need to respond to these small new entries coming in. It'll be a long while before that becomes any kind of a threat.
Yeah, I think everyone's still trying to figure out the ad revenue model. What's interesting about Peacock to me is that they say that they will cap ads to 5 minutes per hour consumed, per hour watched. I think that's an interesting model. You see the likes of Hulu, they have a reduced ad, but they never actually put a number on it. So it seems like this is one way to maybe attract consumers to come over to Peacock because it's like, hey, we don't have that many ads. But at the same time, you do worry about whether or not you're putting a cap on the possible revenue that you can make.
Well, then just realizing you can't binge, too, and then maybe wanting to buy a better tier, maybe forcing them down that path. We will get an update, though, because Netflix is set to report earnings next week, so we'll get the latest from the company. But in terms of what they'll be focusing on in their next quarter, Mark, as the co-founder, I mean, when you look at it, it seems like right now they've made a super big push when we talk about the records that they're setting in terms of award nominations. That's a big push, spending a lot of money. You got Scorsese going to be representing your name brand there. So that's big. But I mean, other than that, it does seem kind of more of a legacy approach when we think about a big studio and what they try to do. What do you think the next big thing for Netflix will be as we see so many entrants, as you've noted?
Well, first of all, I have to follow up and say you have to note here that Netflix won more Oscar nominations than any other studio, including the Hollywood studios. And that is such a dramatic thing to have a television streaming service win more Oscar nominations than anyone else. So that just can't pass without me being proud of that a little bit. But as to what comes next, I think you're going to continue to see just more of the same. When I say more, I mean more content. I mean, on a cash basis, I think in 2019, Netflix is probably in the $15 billion range. And I wouldn't be surprised if that ended up being $17 or $18 billion in this coming year. And that's dwarfing what other companies are spending.
Yeah.
I mean, they're announcing all their other competitors are in this $1 to $2 billion investment range. So maybe they can make a handful of $100 million bets. I mean, Netflix could do 15 to 20 $100 million bets without being too stressed on it.
Yeah.
And they see this not necessarily as a maturing. We still see, they still see it.
Yeah. It's still your baby. It's still your baby, though. That's the thing.
Exactly.
And
right.
your co-founder, actually, we should note, Reed Hastings was named Yahoo Finance's CEO of the decade. You and I have
deservedly so.
Well, you and I have spoken. You've been very open in your book. That will never work. You've been very open about the way that it ended when you got fired by Reed in a PowerPoint. Which was a very interesting anecdote. But in terms of his leadership style, you say it's very deserving. What about it is so deserving?
Reed is courageous and focused. So there's two things. Number one is the focus. The thing about ad-supported, extremely unlikely, only because Netflix does one thing and does one thing exceptionally well. But there's a courage thing here. I mean, I referenced before cash basis spending, and that's about 15 billion, but the P&L basis, the amortized spending is about 10 billion, which is a measurement of how they are investing today's content in tomorrow's customers. They're way out in front. They're doubling down. They are all in. And that comes from Reed being courageous, not about winning this year or next year. He's looking a long way in the future.
Yeah, well, one more note to add here in the streaming wars. Apple apparently has signed a multi-year overall deal with Julia Louis-Dreyfus, who will develop new projects exclusively for Apple TV Plus as both an executive producer and star, according to Bloomberg. This is her first overall deal with the streaming service. We've already seen Apple TV make some pretty big hires, right? And what we've seen. So another big push here is Apple TV kind of dipped their toe in the water, but it looks like they're really throwing their weight behind their streaming service now.
And I think they're going to play a game similar to what HBO played, which is they're not going to try and be all things to all people. They're going to try and have a limited number, high impact, high visibility, and I think probably high quality shows, trying to have a luster which runs over their entire line, that drives sales of their other products.
And for what it's worth, her last show on HBO, which was Veep, was a humongous hit. So those who maybe only know her as Elaine from Seinfeld might be surprised to say that she's still just coming out with absolutely smashing hits on TV. I think Apple TV needs a win. It seems like the morning show, although it had big names like Steve Carell, it didn't get the traction I don't think that maybe it hoped at first. But hopefully maybe Apple TV can leverage this for some.
And it wouldn't be surprising too if they followed the HBO playbook, because they got Richard Plepler too. So that would make a lot of sense. He was the one over there running everything, and part of the reason why Game of Thrones took off too.
But you do have to compete if you have a smaller budget you're prepared to spend on content. You've got to focus somewhere.
Yeah, and it sounds like they're going to go the HBO playbook on this one, at least based off those two hirings. Well, the streaming wars, we're talking about how hot they are. They can also be getting cold too, because Ben & Jerry's is out with a new ice cream flavor, and it's called Netflix and Chilled. That includes ingredients like peanut butter, salty pretzel swirls, and fudge brownie chunks. And guys, we have the ice cream on set here now.
Okay.
You know, Mark, you founded the company with Reed, what was it, 2 decades ago?
You know, when you're starting something, you're a dreamer, and you're kind of dreaming of someday I'll have lots of customers, someday maybe I'll be profitable, and someday maybe we can have an IPO. But I gotta say, you never imagine there's going to be a Netflix and Chilled ice cream. I mean, that is out of left field.
Yeah, I think, is this your moment in time, finally, when you're sitting there on the couch realizing you made it? Is this it?
The ice cream flavor, that's up there, I got to tell you. That and being a clue in the New York Times crossword puzzle.
Those are both.
Top two. Those are good highlights.
Yeah, those are good ones.
Jeez,
good.
I'm just happy just to be eating something right now.
Well, how was it?
It's fantastic. Was it pretzel in there?
Yes.
Right, there's pretzels, chocolate, caramel.
I'm not entirely sure what makes this Netflix and Chilled.
Yeah, I was going to say what.
Yeah, I'm not sure. You know, nutty maybe, or
rich.
I like that.
Rich. The one thing too, though, on this show on Wi-Fi PM, we never get away without giving it full rankings, because Heidi Chung and I get into conversations all the time. We got to have a standard. I say the standard's out of 5. I'd give this about a 4 out of 5.
There's a little saltiness in it too. You know, it represents the grit, I think, of the company.
Yep.
I'm stretching here, but I like this. I'm going to give it a 4.
Yeah, I'm going to come in probably at a 4. I would prefer to see something a little more focused. I think this is trying to be a lot of things. And being the entrepreneur, I'm always looking for, is there a real theme to this? And I think it's trying to be a few too many things.
Well, maybe that's it. They wanted to throw all the ingredients in, give the people their options to binge on whatever they want to eat.
There you go.
Rather than going the opposite route.
Metaphor's unstoppable here, guys.
Yeah, we got to wrap this up. We got to stop here before things get out of control.
Would you like to continue watching?
We're going straight to commercial here. Well, first came plant-based beef, then came plant-based chicken. Next, we're joined by the CEO and co-founder of the startup looking to perfect plant-based fish. How it tastes and why it could solve an even bigger problem when Wi-Fi PM returns. Welcome back to Wi-Fi PM. We are checking the market action to close out the week. The Dow is up 18 points. The S&P and the NASDAQ in the green as well. The S&P leading the way higher for now. We'll see what happens throughout the hour. Well, we're going beyond meat to plant-based seafood. Good Catch creates products that mimic tuna, crab cakes, and fish burgers by using ingredients like peas, chickpeas, and lentils. The brand just raised over $32 million in its Series B funding round and is backed by 301 Inc. That's the venture arm of General Mills. And joining us now to discuss is the maker of Good Catch Gathered Foods CEO and co-founder Chris Kerr with us in studio. Chris, good to see you, man.
Thanks for having me, and thanks for letting me follow ice cream.
Yeah, I think we're making a big jump here. We're following ice cream and going into plant-based tuna cakes or whatever. What did you bring? These are tuna burgers?
Well, these are just regular old tuna fish sandwiches, which is how people recognize tuna fish. So we try to put it in the most familiar form, make it simple, and there it is, yeah.
Yeah, I mean, when we talk about this, obviously it's been a craze. I mean, Beyond Meat was one of the hottest IPOs last year. Is it harder to do plant-based fish? Is it easier?
We eat between 200 and 300 different types of sea creatures. So in this case, we're making albacore tuna fish. So it's a very dry type of meat. It's very similar actually to white meat chicken.
Okay.
But it has the flavor of the ocean, which actually comes from algal oil, which is where tuna fish get their flavor as well. So it's not that it's impossible to make, so to speak. It's that how it is adapted to local environments, whether you're in Germany and you want it on a pizza, whether you're here in New York and you want it on a deli sandwich, what you want to do is let the culinary arts finish it. So the base protein is what you're looking for, mouthfeel, and that's what we focused on.
So something with a lot of the plant-based proteins is just familiarizing the consumer with this entirely new category. So when it comes to the marketing strategy that you employ to try to get people aware that a product like this exists, how do you do that?
Well, first of all, we try not to tell people how to eat it, right? So we don't necessarily put it in a form. In the grand scheme of things, when you buy tuna fish, it's coming in a pretty base form. The individual then gets to decide how to apply it to his or her palate. I happen to like mine. I'm a comfort food junkie, always have been. So I love a good tuna melt. That's what I go with. And I happen to like a lot of mayo. Some people just want oil. So ultimately what we want to do is give both consumers but also chefs the proteins that they need to work with and let them finish it right.
So you heard my comments perhaps a little while ago about how I believe that in the streaming wars, it's not a winner-take-all category. And you certainly have Impossible, and we have Beyond, and now we have seafood. Is each person going to stay in their lane? Eventually, is this all going to merge? Do you competing with each other, or are you competing against meat products?
Well, so in the food world, you're competing with share of stomach, right? So to one degree or another, if I decide to have a tuna fish today and a burger tomorrow, yes, you're competing with that. There is so much room here. I mean, we're talking about $1.3 trillion industry around the globe when you look at all proteins. So there is not just room for everybody, but we need more people in here. The best thing that happened to Beyond Meat was Impossible Burger. That little battle between the two of them, consumers won, the companies will win, and for the same reason that Cargill can coexist with Tyson, we can have lots of players in this space.
See, that's the interesting thing. The interesting thing too, though, because you're CIO at New Crop Capital, which is also a Beyond Meat investor. So I mean, to you, I guess you would want everyone to win because you're invested in everybody.
We are, and it's a really big world, right? So I could have a tuna fish that's doing really, really well here in the United States. A competitor comes in. I can also take that same business over to Thailand or anywhere else in the globe because tuna fish is consumed everywhere. Proteins are consumed everywhere. About 40% of the world's population relies on seafood in some form of core protein. Right, so there's lots of room for everybody. At the end of the day, innovation wins, consumers win, but also the oceans win, the fish win. So ultimately, we're trying to take them out of the equation.
These are the most attractive cutaway shots.
I was going to say, this is a really. I'm
things.
trying my best to eat this attractively. It tastes good, but I just.
No, it's hard to do. No, it is hard to do. I mean, the mouthfeel seems to be there for me.
Yeah, I mean, I just tried some of the plain tuna, which I feel that's the true taste test.
Yes, the true one.
That's actually not that's a Mediterranean blend. Now, if you take the tuna straight out of the sandwich there, you'll get that tight bite. So that's an albacore.
I see.
Yeah, so there's 3 types of tuna fish in our spectrum, right? We've got albacore at the high end, which is a very dry white meat tuna, yellowtail in the middle, and then skipjack's the low end. And we eat a blend of those.
I know a lot of people. I mean, I'm not exactly a fish connoisseur here, but it all tastes good to me. But when you look at it, I mean, Beyond Meat, Impossible Foods, you've talked about the partnerships with restaurants and how that kind of really has been the explosive growth for them. Do you have similar plans for Good Catch? How do you get this product into restaurants?
Yeah, again, we're trying to move proteins and let the restaurants decide how to put them in their best form. You know, my greatest fear, you wrote a book that was it'll never work. Mine is they'll never eat it, right? You have to have something that the consumers will recognize, right? And ultimately, chefs know how to do that the best. So if you look at who built the companies in my portfolio, surrounded by chefs. They're the ones who put the best foot forward every time. At the end of the day, you want a really good, very short-term consumer experience. Just like a movie, right? You want it very short-term. It's fleeting, and you got to get it right the first time, and then they come back.
Chris, what about the long term? You have a growth strategy. Is your game plan maybe to go public someday? What's your aspiration?
Well, before Beyond Meat, I would have never thought going public was even on the table. That's not typically how food companies work. So it's not really part of our strategy. Our strategy is to put our proteins everywhere. What I don't want to do is wait a decade for our proteins to leave the United States and move their way over to Europe or Asia. We don't have that much time, right? The oceans are in crisis. And so we want to parallel track this. So we actually have our group of investors is international, and they're influential in each parts of the globe. And our plan is to engage them in helping to move these products.
Yeah, I mean, you're right. It's a unique problem when it comes to seafood and sustainability. It's different than what we're seeing with chicken and beef as well. But the name, Good Catch, I love that too, because it's a little deceiving. It's a little deceiving because nothing was caught. But Chris Kerr, thank you so much for joining us. Appreciate it. And
Thanks for having me.
Congrats on everything too. Well, next on Wi-Fi PM, the WNBA finalizing its most substantial collective bargaining agreement in years. How it's almost tripling the maximum pay for players and even funding egg freezing and other fertility services. More on Wi-Fi PM right after this. Welcome back to Wi-Fi PM. We are checking the market action we're seeing right now. Still green across the board as the Dow pares its gains a bit, up just 16 points right now. We'll see what happens throughout the hour. But today, the WNBA and its players have celebrated for most of the week, reaching a contract deal earlier in the week that signals a historic shift in how professional female athletes are compensated. Pending ratification by the players and the league's Board of Governors, the tentative 8-year collective bargaining agreement will include a 53% increase in total cash compensation for its players, with a number of other benefits, including increases in cash bonuses for performance awards, better paid maternal leave, and progressive family planning benefits as well. So joining us now is Las Vegas Aces player and treasurer of the Women's National Basketball Players Association, Carolyn Swords. First off, congratulations is in order.
Thank
you were a key member.
Thank you so much.
Yeah, you were a key member of getting this deal passed. Is the agreement, though, what you wanted heading into this and what your peers were advocating? Because I think a lot gets lost in translation about people saying, oh, the women want to be paid equally with the men, but that's not what this was about.
What we're really thrilled about is that this deal was able to make strides in a number of areas. As you mentioned, cash compensation was huge. Having the salary cap increase by 30% ensures that not only are our top players being paid, but each player is seeing a rise and feeling that support. Progressive measures for mothers, full salary while on maternity leave, in addition to a stipend for childcare and family planning benefits. And then improvements in experience, things like travel, individual hotel rooms, extra leg room for all of our tall players. And, additionally, with health and safety, we have mental health network resources and, access to healthcare professionals who can tell us how certain things are affecting women specifically. So, we are always really excited with how things are going with our brothers in the NBA, and we always applaud their success and certainly view that as a partnership. And what we're trying to do is just look at our product and see how we can better support our athletes and the business of our league.
Hey, Carolyn, Brian Chung here. So I think this is a great story. We've heard so much about what the women's soccer national soccer team is trying to do. They unfortunately have to take it to court. So I guess I'm just wondering, in terms of your negotiations with the association, what was that like? Was it kind of difficult to explain the unique needs of the WNBA players in regards to, not just having the same types of benefits that you might see in a other type of for example, union contract?
Sure. I think we're all very proud with how negotiations went. It all began with the opt-out last fall, which really gave us time to sit down and have these conversations across the table about what we want this league to look like, and understanding that we did have common goals, and that was really exciting. And so the discussions then on how to get there, both sides pushed really hard, but I think we came up with a deal that we're something that we're proud of. It's a solid foundation moving forward, when we're really excited for people to really experience the greatness of the WNBA product.
It's Mark Randolph, and congratulations on the agreement. I think that's fantastic. I'm curious about your vision for the future here. I mean, certainly you've seen what's happening in, for example, women's tennis, where they've essentially achieved parity, at least at the major tournaments. And I'm wondering what you see as the future or the upside here for you.
I think we're excited for, just the growth in revenue in the league. We have a very competitive league at the moment, which creates exciting games. Every game matters. Something like the WNBA Changemakers is that opportunity for partners and new partnerships that the league is working on. I know that our union is excited to partner with other players associations to really look and be innovative with licensing deals for our players and the brand. So we're excited for the foundation that we've laid with this deal, really building on what has come before us, and really looking to innovate moving forward, making sure that next generation of women's basketball players has an exciting league to be part of. Yeah, because WNBA players are going to be featured in the new 2K video game. That's right. So that's going to be something interesting there. But I know that even you personally on the Aces, you and your Aces teammates struggled with kind of the problems that you guys had last year, or was it a year before, that you
missed a game because your flight got delayed and then canceled. So, I mean, those are the things, too, that people might not realize. It's pretty important if you line up all the scheduling to air a game just like you do in the NBA, but they fly charter, you guys fly coach. I mean, these are minor things from the outside looking in, but they're pretty important.
Exactly. I think, there are a lot of unpredictable commercial travel, and our season is very compressed and intense. And so things happen beyond your control. It was unfortunate that, we had some travel issues. We certainly aren't the only team to have dealt with that. And we are very happy that there have been measures here in this deal to start to address that and hope that that doesn't happen in the future.
All right. Well, a very big congrats on everything that you guys got done.
Thank
Very
you.
cool to see play out. A big bet on women as it's being heralded in the news. But congrats again. Carolyn Soares, thank you so much for joining us.
Thank you.
All right, well, coming up, the amazing impact Hollywood had on the top read Wikipedia articles of last year. Why it just goes to show it's not always just about box office numbers. Plus, Beyonce teaming up with Adidas. Why it could be bigger than that Kanye collab when Wi-Fi PM returns. Welcome back. Hollywood is showing its power over the internet in this week's Fame and Fortune. Yahoo Finance's Alexandra Canal joins us now, as always. And Alexandra, Wikipedia released its top read articles of 2019, and it's interesting to see what people were reading about last year.
Yes, so Hollywood seems to be inspiring a lot of what people are researching online, and specifically on Wikipedia. If we look at this top 10 list, we see Avengers Endgame coming in at #1. This should be no surprise. This was the #1 movie in the world. These Wikipedia articles really break down everything you could want to know about something. So it's not surprising that 44.2 million views on that one. Then we have deaths in 2019. Now, this is a little morbid, but it's basically an article about all the famous people who died in 2019. Ted Bundy, also morbid, but this is probably due to that Zac Efron Netflix movie, Extremely Wicked, Shockingly Evil, and Vile. I will admit I was part of that $29.4 million that went on and researched some Ted Bundy stuff after
Yeah.
watching this movie because I was appalled by it. So,
That's a lot.
So there you go with that. And then Freddie Mercury came in at number 4. Now remember Bohemian Rhapsody that was released last year that did really well at the Golden Globes, winning Best Picture. Rami Malek went on to win Best Actor for his portrayal of Freddie Mercury. So these lists just go on and on with other movies, actors, and artists here. And what I want to pick apart is the number 6 list of highest grossing films. This surprised me because in this age of Netflix and streaming, people still want to know what's doing well in the box office. And if you look at the total 2019 haul of the box office numbers, that came in at around $11.4 billion. Avengers Endgame, that number 1 Wikipedia article, contributed about $2.8 billion there.
Yeah, so a
lot
matching
of money, and a lot of money seems to equal clicks.
And that would also make us look at number, 9 on the list too, Billie Eilish, 20.9 million when it comes to how many people were reading that article, possibly because of what she's now doing in Hollywood.
Yes, so Billie Eilish, when I reached out to Wikipedia for comment on this, they specifically referenced her. Her star has just skyrocketed in 2019. She released her album last year, also reached number 1 on the Billboard Hot 100 list with their song Bad Guy. And then this week, it was announced that she will be recording the latest James Bond theme song for the film No Time to Die. This is significant because she is the youngest person to do this. We've seen how well these James Bond theme songs have done in the past, both Adele and Sam Smith winning Oscars for their renditions of these songs. So a lot of opportunity for Billie here. And then specifically how many eyes and ears are not only going to be on this movie, but this song. At the box office, James Bond just continues to kill it, raking in millions, if not billions of dollars. You're seeing right on your screen that Spectre, that brought in over 800 million, Skyfall with 1.1 billion, Casino Royale almost 610 million. And I think No Time to Die is going to do even better than this because Daniel Craig has said this is going to be his last James Bond film, and people love him in this character, and they're going to want to spend the money to see how he does.
Well, I got to say, I was one of the people who had to go to Wikipedia to see who Billie Eilish was. And
Okay.
I just might be in the wrong demographic for this. But the other thing that leapt out at me was how many of those were movies on that top 10. And I'm putting, of course, the Ted Bundy and Chernobyl, which I assume is driven by the Chernobyl HBO special. And it was really remarkable, and including one that says, what is the Marvel franchise?
Yes.
So people are looking up, what is Avengers, and then what's the rest of the franchise? And I think the ultimate thing, and maybe it's somewhat morbid, is that if you do want to be on that top 10, the key is you've either got to be a movie or you have to die.
I know, it is.
Or you do both. Or you make a movie.
Right, for the maximum SEO.
Yeah, and I thought it was interesting too that I think Hollywood is trying to find the stories that are happening in real life that are interesting. Normally people go to the movies to escape reality, but what we're seeing is that these real life stories are actually what's driving interest here.
And this is a good point. Like, I think you know the barometer of whether or not something has really captivated you after you consume content is if you kind of go home after you go to the theater or you wrap up, you turn off your TV and you go, I got to learn more about this thing because it's crazy. And I think nothing does that better than a lot of nonfiction. I think when we talk about Marvel, though, an exception because the universe was so big, right? There were, I think, over 20 movies that were part of that movie franchise. So it's 23. Kind of hard to remember exactly what happened and how they all tied together, which is why there's the whole, there's whole entire sections of Reddit, entire sections of Wiki that will have people trying to bring the threads all together. It's all part of, I think, that watching experience that actually exists after the movie or the show ends.
It's also that refresher course too, because there's so much time in between movies, and Wikipedia breaks down the summaries of the movies, every single actor that's in it, anything you could possibly want to know, it's in there.
Yeah, same thing with the Bond ones. Those are kind of hard, not only because they change the actor all the time and you got to keep up with that. I'm very
I love
confused.
Daniel Craig, I'm so sad.
Bond
He's
has
so
shrunk and risen over the years, so it's hard to keep up, but yes, we'll have that as the newest series to look forward to. But also in the space of entertainment and fashion and star power, Beyonce's new Ivy Park collection with Adidas officially launching tomorrow. What are the expectations for that partnership? Because Adidas has teamed up with Kanye in the past, and Brian Chung will be the first to tell you how much star power the Yeezys got.
Oh, yeah.
So what is Beyonce?
And honestly, this is expected to do even better. Those Yeezy sales, Forbes estimated that $1.5 billion resulted from that partnership, and analysts are saying this is going to do even better. Beyonce has certainly done her part in spreading the message of this collection. She actually gifted all her famous Hollywood friends these giant orange boxes with items from the collection in there, from Reese Witherspoon. You're seeing that now. And they all posted this on their Instagram page. So this was flooded in my Instagram. My friend actually came home and said, I can't go on Instagram right now because it's all Beyonce's collection. So it shows the power of social media here and how Beyonce is just a very smart businesswoman. It's getting that product in front of potential consumers and a lot of eyeballs because a lot of people have Instagram.
You didn't have to look up who Beyonce was, right? That one.
No, I didn't know her. And maybe I'd get the sneakers. I'm probably not going to get the purple cake.
I think it'll work for you. I think the sneakers will work for you.
It's unisex. Her line is unisex, so you could do it.
Yeah, we can all do it. There you go. Alexandra Canal, thank you so much for breaking that down in our Fame and Fortune. But after the break, new year, new you, new credit card. We're breaking down the best card rankings for you based on where you live and how you spend the potential $500 in annual savings right after this. Creditcards.com is out with a new breakdown that matches how Americans spend according to labor statistics data, with some cards offering nice rewards bonuses for you in 2020. Interestingly, people in Seattle are spending about 40% more on food at home compared to the national average, and our friends like Brian Chung here, who used to live in Washington, D.C., tend to spend more on eating out, 63% more on dining out. Well, no surprise, Los Angelinos are paying big at the pump. So if you similarly eat out or grocery shop just as often, Creditcards.com ran the numbers and found that the Capital One Saver card, with its $300 sign-up bonus and 4% back at restaurants / 2% back at grocery stores, could net you more than $550 in total rewards in year one. The annual fee after that is $95 a year. Another option is the American Express Blue Cash Preferred card with the $250 sign-up bonus and 6% cash back on up to $6,000 of annual grocery spend, totaling $545 in first-year savings, though, again, that one will cost you $95 a year after that. Guys, I have a card, a rewards card, that also offers some cash back. It's tricky, though, because you get locked in and then you keep paying for it down the line.
I mean, I think the big decision is really cash back versus points. It seems like there's a lot of travel cards, too, that offer you, instead of cash back, points that you can redeem with airlines or hotels. Yeah. That's the one that I've opted for, but it seems like a lot of these cash back cards are pretty lucrative as well. It's really all about the options. I mean, I don't think people have had more options than this, as a lot of these banks have fought for credit.
Yeah, what does the co-founder of Netflix prefer, cash back or points here?
I'm a points guy, but the real challenge here is they say, of course, that, you know, Angelinos spend more on eating out, San Francisco, New York, and so besides the points, you just better have a big credit balance.
Yeah, because you're going to be spending a lot regardless. You're going to be pushed for that. But the co-founder of Netflix, first CEO, Mark Randolph, thank you so much for being here again.
Pleasure.
Brian Chung, thanks to you as always. Happy Friday, guys. Coming up, Gap backs away from its plan to spin off Old Navy. The details, as the retailer is still on the hunt for a new CEO. The ticker is starts in 2.
Good afternoon. Welcome to the ticker on Yahoo Finance. I'm Shauna Smith. We are still seeing gains across the board with the Dow, the NASDAQ, and the S&P all trading to the upside. We can see the Dow up 24 points, so well off its highs of the day, but still obviously holding well above that 29,000 level. S&P also above 3,300. Boeing, though, is slumping. Now, this follows an ABC News report that there is another software concern for the 737 MAX. During a test last weekend, the model's 2 flight computers weren't talking to each other at startup. That stock is moving to the downside right now, off just around 2% at $325 a share. Let's talk about the markets overall here, with stocks on track to cap off another record-setting week as U.S. economic data and solid earnings continue to push the markets higher. Joining us now, we have Brian Levitt, global market strategist at Invesco. And Brian, when you take a look at the markets, it's another day, another record high. From your perspective, what do investors want to see this year?
So what we've been looking for is a stabilization in economic activity, and we're largely seeing that emerge out of some weakness in economic activity in the summer. And what they'll want to see is ongoing clarity around policy. So what you need to see in order for markets to do well is stabilizing or accelerating economic activity and policy that's going to be supportive of it. And the big story this year is signs of stabilization, policy is quite supportive, even on the trade front, some incremental improvements, and that's why markets continue to press higher.
Brian, we just had that report from ABC News about Boeing. The stock is off 2% today. There's been some calls out there that Boeing could shave as much as a half of a percentage point off of GDP. When you take a look at that and the news that's out today, what do you make of this?
So what you make is that it was going to be a slow economic environment anyway, and this only perpetuates the weak economic environment that we're in. And so in that type of an environment, investors, rather than bemoan the fact that economic growth is weak, they should rather accept the fact that policy is going to be supportive for far longer than I think a lot of people suspected. And so what do you do in that type of environment? You should expect interest rates to remain low. You should expect the yield curve to remain relatively flat, and you should pay up for growth wherever you can find it, because growth is not going to be accelerating significantly. So you look for U.S. large cap growth companies, and you look for companies around the world that are generating true top line revenue revenue growth.
Brian, what do you expect the Fed to do for the remainder of the year? Do you think it's going to hold rates steady? Do you think that we could see another rate cut or possibly a rate hike? Where do you stand?
Well, no, I wouldn't expect a rate hike. So it's a debate between whether they hold it steady or whether there's another deduction in interest rates. And I think it'll be data dependent. I mean, right now what you see is a general stabilization in inflation expectations, a general stabilization in the currency in the U.S. dollar. So that to me suggests they're probably on hold for now. And that's okay, because what they've done in backing off the 2018 rate hikes is they've eased financial conditions meaningfully. And by easing financial conditions, I mean the yield curve is no longer inverted and the dollar is relatively stable and high yield spreads are tight again, which means that they've accomplished largely what they set out to accomplish. And that's a good backdrop for risk assets.
Brian, we mentioned some of the policy uncertainty. We had that phase one trade deal with China this week. How big of a step forward is this? Is this even really a big step forward from your view?
It's probably a modest truce, or, you know, I like to think of it as the markets don't care about good or bad. They care about better or worse. And so that was a sign of things getting a little bit better. They're not good, right? And I think the U.S. and China will be fighting a trade war for a prolonged period of time. We're not going to solve this in the near term. But what you needed to see this year was a change in tone and some modest improvements in where we're heading. And that's what we got from that. We haven't solved any of the larger issues, and I suspect we won't solve those larger issues going forward. But what investors need to care about most is how are the markets responding to that? What's the shape of the yield curve? What are financial conditions? What's the currency doing? And all of that looks better than it did last summer.
Brian, what are your expectations for earnings growth this year? Because they were near zero coming off of 2019. Expectations is for growth this year in 2020. Are you on par with what the street's expecting?
Yeah, I mean, you expect modest earnings growth, so call it mid-single digits earnings growth. And I think investors continue to pay up for those that can generate earnings above that. And so I don't think equities are overly valued significantly in this type of a rate environment. So you could see some multiple expansion, some modest earnings growth. That means we probably don't see a 30% return in markets for a second consecutive year. But, you know, a sound return for markets should be expected.
Brian, from your view as it stands right now, what do you think is the biggest risk or what could halt this momentum to the upside that we have been seeing now for quite some time?
So the biggest risk in each part, we've had three significant deteriorations in growth in this elongated cycle. So one was the European debt crisis, one was the Fed rate hike in 2015, and one was the interest rate hikes in 2018. So what all of that tells you is we're in a slow growth, benign inflation world, and that'll exist for far longer than most people suspect unless we mess things up on a policy front. And so my view is this is a year of stabilizing growth and better policy. If we see a shift and a policy about face where we either get tighter on trade or we get tighter on the monetary front, then you could potentially see another correction and yields going down further and policymakers having to walk that back again. But to me, that's the biggest risk in this cycle, is a policy mistake somewhere in the world.
All right, Brian Levitt of Invesco, thanks so much for joining me today. All right, well, let's get to our big three tickers of the day. We have Gap stunning investors with new details about its spin-off plans for Old Navy. Apple scores two fresh price target hikes as its bull run shows little sign of letting up. And one major bank says 2020 is looking bright for shares of Snap. Well, first, let's get to the latest on Gap. Now, shares are slipping after the retailer said that it was scrapping plans to spin off its Old Navy brand, reversing a decision that was announced less than a year ago. Jared Blickery joins me now. And Jared, when you take a look at what Gap has decided, a lot of the reason here is because we've seen a little bit of a slowdown in sales from Old Navy. How is the street reacting, and in terms of what this could mean for Gap's next step forward?
Well, I'm not sure anybody knows what the next step forward is, including Gap. They're looking for a new CEO right now. They really need to turn things around. They've said before on their previous earnings call about 2 months ago in late November that they want to get they want somebody who is an operations specialist as CEO. That tells me that they're really not that interested in innovating. So making incremental marginal improvements to their product line only going to get you so far. Working on your margins only going to get you so far. They have their 3 flagship brands now with negative comps, and that's why they're not spinning Old Navy off right now. As much as it is a different company, and they have dis-synergies of maybe up to $200 million by operating this brand, nobody's going to want to take this on as a company that's shrinking and probably should be closing stores instead of expanding. They want to double their locations, which just seems kind of insane at the present time. So the stock spiked initially. I was watching in the aftermarket yesterday. yesterday on the news. It's heavily shorted, so I think that was just kind of the initial short covering squeeze that we saw didn't last. And if we look at the intraday price action today, we can see it opened up in positive territory, not a lot, but it quickly sunk into the red where it has stayed. If you look at the stock over a longer time frame, let's look at the 1-year chart right now, you can see it's kind of stabilized here above maybe $14, but that's the base. It still hasn't accelerated beyond that. Even with this latest catalyst, it hasn't been able to do that. And I think it's because of the indecision of the company right now. They need that new CEO. They need a vision. They need to start articulating how they're going to execute, much less how they're going to innovate.
All right, Jared Blickery, thank you. We are also watching Apple today after Morgan Stanley and Nomura raised their price targets on the tech giant. But Nomura, though, is still cautious that inflated iPhone 12 expectations, quote, may make the music stop. Dan Howley is here with me. And Dan, when you take a look at these two calls, Nomura's price target is well below where the stock is trading today. Do you think some of the bullish calls out there from the street are a little too optimistic at this point?
It could be, especially going forward when you think about the 5G, what they call a super cycle, and that's really what happens when a huge amount of people go out and buy new iPhones. They, see a new technology or they see a new feature from it, and they want to purchase them. That's really what they're thinking we're going to see with the 5G iPhone, which is expected. There's nothing confirmed, but expected to launch in the fall of 2020, later this year. So that's where a lot of analysts are coming from. Where Nomura is situated on this, though, is they don't see 5G being this huge game changer for smartphone buyers. And so far, that seems to be the most logical conclusion in this whole idea of where Apple will land. 5G right now for most consumers is a concept. It's not a reality. There's not enough network availability for many people to use it. And when you see things like our parent company Verizon talking about millimeter wave technology, that's very, very limited. That's not something that most consumers will even be able to get, especially outside of major cities. So what you're really going to see is a mid-range kind of 5G, and those are only being laid out right now. We're still talking about tens of cities, not thousands of cities like we have with 4G right now. So if someone were to think about upgrading to a 5G iPhone, they might end up paying more, which is what Nomura says is a prospect, between $40 and $80 more for a 5G iPhone. And we've seen that with other smartphones already from the likes of Samsung, that the 5G devices cost more. But then once you get them, you might not have a network to ride on, so why bother purchasing it? And that's really where this kind of fear of maybe this 5G super cycle is being overhyped.
Hey, Dan, not too long ago, Susquehanna was out with a call, and they basically said that 5G phones, that they weren't a sure thing. 5G iPhones were not a sure thing for 2019. At best case scenario, it's going to happen at the end of this year. And then they're saying that even their faster 5G iPhone could be pushed off into 2021. If that is the case, is that a risk to the downside here for Apple's stock?
I think in the short term, it would be at that point, once we hear about when the iPhone would be released, or the 5G iPhone would be released, and then that upgraded, that millimeter wave one, the one that we hear about 5G being advertised, these incredibly insane speeds, that's where you get that millimeter wave, that super high-end version. Then there would be a mid to low band version, it's called sub 6 gigahertz, where most of 5G will sit. And it's going to be admittedly faster than 4G, but not exactly what's been advertised in public in general. Now, if they do delay that millimeter wave iPhone, yes, there could be a downside for a short amount of time until they're finally released. But again, I think at this point, for smartphone buyers, it's still really a concept. And when you look at the real benefits right now for 5G, for a smartphone, you're only looking at increased download speed, or decreased download speeds rather, and lower latency, larger bandwidth. What we do right now on smartphones and 4G, we can stream things at 1080p on a small screen, which is more than enough without issue. So where is the real benefit for users for 5G on smartphones right now? It remains to be seen. Until we get apps that take advantage of it, that's when we'll start to see people really get hot about 5G. But I understand where Nomura is coming from, and this kind of being a little bit pensive about whether or not we would see this super cycle, because to be honest, 5G doesn't really seem that interesting for most consumers at the moment.
All right, Dan Howley, thank you. Well, oh snap, let's talk about this company here. The social media company is jumping. Now, this comes after UBS upgrades the stock to a buy, and you can see the shares up just around 4.5%. The firm noting that it expects positive business momentum to continue into 2020 and beyond. Dan Roberts is here with me. And Dan, this call comes after Snap has already tripled since its 2019 low.
Yep.
What is going to keep this momentum going? Because there's still a lot of questions around this company.
Well, first of all, I'm glad you mentioned the low, because what a story this stock has had in the last 12 months. It was down at $6 in December 2018. If you look at the chart, it is remarkable. And so it is funny to see it get an upgrade. And the analyst in this note recognizes that the stock has already been so much on a tear in the last 12 months. As you said, look at this, up more than 230%. Now, to argue that there's more room to run, I think is a little bold, because for a while, people wrote off Snap as dead. People said for a while, only, 2 years ago, this company should have sold when it had the chance. Remember way back when there was supposedly a $3 billion offer from Facebook to buy Snap, and Snap and Spiegel said no. But the argument in this upgrade is about user growth potential and also specifically ad sales. This analyst thinks that the ad sales will be even better in 2020 than Snap's own projection, which, if true, would be huge. But what's interesting to me is there's also a report out today that Pinterest now has more users than Snapchat. So yeah. Pinterest number 3 after Facebook and Instagram. And it's hard to sort of reconcile those two things, this bullish upgrade with that news about Pinterest. Pinterest stock up barely right now, less than 1%, and Snap up more than 4%. So maybe an upgrade is just a bigger boost to a stock than one of your biggest competitors getting big news and toppling you in terms of users.
Right, but they're two totally different companies. They serve different purposes, and they also are targeting two completely different demographics.
Well, arguably that's a weakness for Snapchat. I mean, some people point out Snapchat is growing so well with very, very young people. I mean, you and I are now out of the demographic. Is Snapchat on your phone right now?
Well, it's on my phone, but I don't check it.
Well, so we're old. I mean, we're ancient. People who are using Snapchat, it's not even like, oh, it's people in their early 20s. As I understand it, it's like teenagers. But Pinterest really has a wider age appeal. Now, Pinterest also battling its own demons, trying to get away from the reputation that Pinterest is for women. Pinterest is for pinning things for your wedding or your house or interior design. And we've had some Pinterest bulls on our live shows recently saying, no, you just wait. It's going to really open up its arms, and you're going to see men loving and using Pinterest. I haven't seen that yet, anecdotally.
You don't love it yet?
No, it's not for me yet. But if this is true about this report that Pinterest has more users than Snapchat, I think it's more of troubling news for Snapchat than it is good news for Pinterest. Pinterest kind of just growing along nicely. And Pin's one of those unicorn IPOs that at first looked very good. At first it looked like Pinterest had escaped and dodged the unicorn death march of Uber, Lyft, Peloton. But if you look at it now, I think it's just trading right about where its IPO price was.
Dan, do you think, circling back to Snap here, do you think we're going to start having the conversation once again that this could be an attractive buying opportunity for some of the other tech giants out there? I mean, they did reportedly turn down Facebook, but there's still not a clear, I don't think, sense of their future yet.
Right. It looks that way. It's certainly, you're hearing more analysts say the stock is a buy. But would Snap sell at this point? I don't know. I mean, some people think that now is the time for Slack to sell, with Microsoft looking scarier than ever. If Snap is doing well and growing nicely, especially ad revenue, why would it? Maybe it thinks it can get even bigger and expand into other things. I'll tell you, though, the spectacles gambit, that's stop doing that.
The stock up over 200% over the last year, so we'll leave it there. All right, Dan Roberts, thank you. Well, straight ahead, the U.S. Treasury is a new debt offering that could shake up the fixed income market. We've got more on that. Don't go away. Welcome back to the ticker. Philadelphia Fed President Patrick Harker says that the robust labor market is boosting consumer confidence and lifting the U.S. economy. Now, Harker noting that the economy is likely to grow by 2% this year and that inflation is on track to hit the Fed's 2% target. Joining us now is Mark Matson. He's the CEO of Matson Money. And Mark, when you take a look at what the Fed's Harker has been saying, economy looks pretty good, inflation on track for 2% target. What do you think about that?
Yeah, well, I think it's already baked into the price, and everybody knows the economy is doing extremely well. But my message for investors today is that they're getting massively focused on one asset category, and that's large U.S. stocks. And that is extremely dangerous. They've forgotten 2008 and the beginning of 2009 when large stocks lost 48% of all their value, and they've forgotten 2000 to 2009 where they made a negative 10% for a whole decade. And this happens anytime one asset category runs way up. People get excited, they herd up, they have confirmation bias, and then they have no idea how much real risk they're taking. And my big message for investors relative to this economy, yes, it's good, but that's already in the price. Avoid getting really sucked into one asset category.
So, Mark, is it time to get defensive then at this point?
Well, I wouldn't say defensive because market prices are random and unpredictable. However, that 48% loss could come at any time period. And what investors are doing, I watch it every day, they're taking their fixed income and they're doubling down on large stocks. They're taking small stocks and value stocks, and they're forgetting to stay diversified, and they're gambling and just putting all the chips on one, number. And that's the S&P. They made 31% last year. A diversified portfolio of U.S. stocks with small and value would be somewhere in the ballpark of 22%. But it's that greed and that fear of missing out that causes people to double down on one asset category. It's extremely dangerous.
Mark, we had some strong economic data out this week. We had retail sales that matched what the street was expecting. U.S. housing starts today, hitting the highest level in 13 years. When you take a look at this, do you think the fundamentals are strong at least?
Well, I would agree with that. And, Art Laffer is on our board of advisors. And, we discuss the economy quite often. And, to go take the economy to the next level, we believe you need additional people to get into the workforce. I mean, we're down at, virtually zero unemployment, structurally speaking. And if this thing is really going to continue to grow, we got to get people off the sidelines that are just waiting around and get them back into the market. Get them into a job. So I think that's where the real growth in the economy is going to come. But investor needs to look globally too, and not just the United States. They need to be looking at Europe, Asia, emerging markets, and a lot of them are selling out of emerging markets, selling out of international, and dumping it all in U.S. Bad mistake.
Mark, are you seeing opportunity in emerging markets right now?
Well, absolutely. Emerging markets is down relative to U.S. And historically, emerging markets have a very high volatility, but they also have a long-term high expected return. And that's the beautiful thing about modern portfolio theory. Harry Markowitz, who won the Nobel Prize for portfolio theory, found out that you could take an asset by itself, like the large U.S. stocks, add emerging markets that by itself looks volatile, but because those things have dissimilar price movement, you can increase the overall rate of return and reduce the overall volatility. So diversification in emerging markets, our international fund has about 15% in our international diversified portfolios. Most investors are missing that right now.
All right, Mark Matson, thanks for joining me.
My pleasure.
Well, coming up, the top 2020 ESG trends for investors to capitalize on. The author behind a new report joins us with details next. Welcome back to the ticker. Checking in on the markets, we are still seeing gains across the board. The Dow, though, well off its highs of the day, up just 24 points. S&P and NASDAQ also holding on to gains. Ines Ferre is on the floor of the New York Stock Exchange. Ines?
And Shauna, the worst performer on the Dow right now is Boeing. It moved to the lows of the session just a little while ago, down about 2%. This is after the company said that it's working on a new software issue that was discovered during a technical review last weekend. It says that it's addressing this issue, doing the necessary updates, and working with the FAA on submission of this change. Also, just taking a look at the NASDAQ, the best performer on the NASDAQ is Qualcomm, reaching a 52-week high. This is after Citi upgraded the stock to a buy, increasing its price target. Very bullish on 5G, saying that Qualcomm will benefit from the 5G upgrade cycle. And then just looking at JB Hunt, that stock is down under pressure. This is after they missed on earnings for the fourth quarter. Revenue coming roughly in line with expectations, but the transport stock has been under pressure throughout the day, Shauna.
All right, Inez, thanks so much. Well, investors and companies are rethinking their investment strategy as climate change tops the list of issues at the World Economic Forum. Now, this comes as MSCI is out with the top ESG trends of 2020, revealing how investors want to use technology to help solve the climate crisis. Joining us now is Linda Eling Lee, Global Head of ESG Research at MSCI. And Linda, it's a very thorough report, an extremely interesting report. When we see the increased focus on ESG and the importance of ESG investing, from what you found, what were the most interesting or most important trends right now?
Well, I think that investors are feeling a great deal of urgency to address climate risk in their portfolio. So those are really two of the top 5 trends that we're watching this year. And I think that one thing that we think that will really happen is that investors are really looking for solutions. And they're going to have to look for solutions to climate change that are not coming from just those few companies that today are offering green revenues and green technologies, sort of the renewable energy companies that you know about, or the Teslas, but they're going to have to look much more broadly to look at the companies that have very full R&D pipelines, where some of the inventions of the future are actually hidden in their R&D pipeline. So we looked at a database of patents, for example, and found that there are very large companies, more like the Toyotas and the Samsungs, that today actually have quite a lot of patents that are for low carbon technologies of the future.
Linda, we had the news this week. BlackRock is changing their investment strategy focused on ESG. How big of an impact do you think that will have for ESG investing, and then also just in terms of setting an example for other funds to follow?
Well, I think that the statement is really an example of how investors really are taking ESG considerations much more seriously. Climate, as we said, is very important. But I think in general, the fact that companies really should be taking a look at all of their stakeholders, for example, is another trend that we're watching. I think that is going to be very important for investors as companies start to address many of their practices and their conduct in terms of making a more inclusive economy.
Linda, what's interesting is a lot of times when you think of ESG, you'll think of technology companies, you'll think of oil and gas companies, kind of the bigger picture. The one thing that caught my eye in this report is its potential impact also on real estate investments, which isn't something that you necessarily would think about when you're thinking about ESG investing. How does this specifically impact this sector?
So I think that real estate investing is going to really change, really quite dramatically over the next decade. There are really 2 dimensions of risks to real estate investments. There are the physical risks that we can see. It's the wildfires and the floods that are much more directly impacting property values and insurance costs. But there's also the need to actually very quickly green the portfolios of buildings. What we know is that properties or buildings and the building sector actually contribute more than 1/3 of global emissions. And that means that a lot of big cities around the world where there are lots of high property value are actually putting in regulations to make sure that over the next decade or so that you start to have buildings that are decarbonizing. And so for a lot of real estate investors, they really need to get ahead of this, because you cannot change the energy efficiency of your building portfolio tomorrow. You really need to actually be on a path to decarbonize that property portfolio.
Linda, what's interesting, your climate change is driving a significant reallocation of capital. It's something that we have seen pick up really over the last several years. Do you think the financial markets are fully recognizing the magnitude and the speed at which this will happen?
I think they're only beginning to be aware. And I think they're only beginning to be aware because the tools and the analytical models are actually still relatively nascent. I think that there's a lot of attention to how to actually model how it is that you will have be able to price climate risk in your portfolios. But there's a lot of attention to this area, and we really see that there will be a lot of improvements, and so that investors are going to have a better tool to be able to look at different scenarios of how this might play out and impact their portfolios.
Do you think it's enough to go, or do you think it has gone, at least at this point, mainstream?
Oh, I think it's definitely, passing that kind of velocity, reaching that velocity speed. I mean, you really do see it dominating a lot of the conversations. I think you're going to see that a lot at Davos next week. And so, yeah, I think that this is where it is.
Certainly will. It's topping World Economic Forum's top risks is climate change. So certainly something that we will hear more from the global business leaders. Linda, thanks so much for joining me today.
Thank you.
Well, coming up here on the ticker, we have Elon Musk is advising Jack Dorsey on how to fix Twitter. More on that. Don't go away. Welcome back to the ticker. I'm Shauna Smith. Let's give you a quick recap of the tickers that we've covered in the show today. Our first was Gap. Now its board has decided not to move ahead with plans to spin off its Old Navy brand, explaining that doing so would prove too costly and complicated. Old Navy has also been hit by slowing sales in recent months. Our second was Apple. Morgan Stanley and Nomura are both raising their price targets on the stocks, with Morgan Stanley boosting it to $368 a share from $296. Nomura bumped its price target up to $280 from $225. Apple stock is up more than 100% over the past year. And our third ticker is Snap. It's rallying after UBS upgraded the stock to a buy from neutral. The bank saying that it expects Snap's improving growth and ad monetization to continue through 2020. We're checking in on the closing price of oil. Crude, a little change, but still moving to the downside today, off just 3 pennies, looks like, at $58.50 a barrel. Now it is little change as China's economic growth slows to a 29-year low. China is the world's largest oil and gas importer. Meanwhile, we are looking at Schlumberger today. The stock is slumping despite reporting fourth quarter earnings that beat on both the top and the bottom lines. It also posted a positive outlook saying that it sees improving oil demand this year, at least overseas. Jared Blickery is here with me. And Jared, the stock was popping earlier today. Right now, it's moved to the downside. What's going on here?
Well, it could be any number of things. First of all, it did beat earnings by 2 pennies, and these are very lowered bars, by the way. The industry has been in retrenchment. They're an oil services company, and the field has been undergoing a transformation that we've talked about a lot of times on this show and many others, which is that the boom times in shale oil, the growth phase, is really over. And because of that happening, there's simply not as much demand anymore. So the good news is they're not going to have as much CapEx in North America next year. Their revenues in North America, by the way, shrunk by something like 12%, offset by a 2% increase internationally, such that we only saw a 4% decrease in revenues. but their margins are under pressure in a few different lines, and so that could be what's contributing to the stock price right here trading down. So let's take a look at the intraday price action. We can see that we gapped up just slightly, rose to about $40, then selling off to about $38.50, $38.40 here. If we take a look at a longer term picture, we can see the stock really kind of under pressure for a lot of the year, although it is off the lows. And this low right here and this rise coincided with the general rise in the energy sector. It's been under pressure for so many years, but we did finally see that rotation to value and cyclical stocks that began in about September of last year. Energy finally able to participate a little bit, but if we take a look at a longer term chart, 5 years, which will capture roughly the peak in oil prices of about $100 in 2015, just really a lot of downside here. You can see it's off about 53% over 5 years.
All right, Jared Blickery, thank you. Well, there is a new member in the $1 trillion club. Google's parent company, Alphabet, has surpassed a $1 trillion market cap, with the stock touching a fresh high earlier today. Now, the tech giant joins the ranks of Amazon, Apple, and Microsoft. Now, Amazon is no longer a $1 trillion market cap. It has since fell below that mark. We have Dan Halley back with us. And Dan, when you take a look at this, how significant is this for Alphabet?
I think it's a big move, especially just for the confidence of the company as well as investors. Microsoft being up there, Apple being up there, Amazon being up there. That left Google to be the only company of those big name tech brands that wasn't in there. And I don't mean big name as in something like a Facebook, which is also a big name. I mean an infrastructure company that similar to what Microsoft is able to do and Amazon is able to do that wasn't in that category. Now, Apple's completely different. They're a consumer company predominantly, and they really don't have the kind of infrastructure capabilities that the other three do, which give them the ability to continue to grow. But Apple is Apple, so it's a little bit different there. I think going forward, what we can expect from the likes of Google is perhaps it to fall back a little bit. We saw Amazon kind of take back that $1 trillion mark. They did surpass it, but then fell below it. Right now, Google's market cap is at 1.012 trillion, so not exactly well above. So I wouldn't expect it to hang out there for much longer if it has any kind of fallback in the stock price. Microsoft and Apple, they are well above the 1 trillion mark, though, at this point.
Dan, what's interesting is that a lot of these tech giants are facing regulatory pressure. They're also facing calls from some of the Democratic presidential candidates here. We had Senator Warren and also Senator Sanders both looking or both wanting to break up big tech. When we take all of that into account, why do you think investors are able to shrug off some of those concerns?
It's not going to happen. That's pretty much what it comes down to, is there's not going to be a breakup of these companies. That's really what the big fear would be. We saw that with Microsoft, where there was a call to break it up into two separate companies, but that was then reversed, and we have Microsoft, as it is today, a $1 trillion company. I think, and that, by the way, led to the rise of Google and Facebook and Amazon and the kind of regrowth of Apple. I think what we're going to see when these companies eventually do face some kind of regulation is something along the lines of what we saw with Microsoft, where there's a new set of rules put down that enable the companies to continue to operate, but not exactly as they currently are. And the problem that Microsoft faced wasn't because of the rulings that were passed down to make it more competitive or to make the tech space more competitive. It was because they completely missed the boat on mobile, and that was really why you saw their stock fall back so much compared to the rest of the big tech names. So I don't think that this is going to have any real impact on what Apple, Google, Amazon, and Microsoft do going forward as far as regulations go.
All right, Dan Halley, thank you. We're also watching Twitter today. Shares are slightly under pressure. You can see the stock off just around 0.1%. Now the move to the downside comes after UBS downgraded the stock, saying that investments into ad technology will likely cap a valuation. The bank also lowering its price target to $35, so about $1 higher actually from where it's trading today. Dan Roberts is here with me. And Dan, when you see this UBS call on Twitter, what do you think about it? I mean, is there anything, there's been lots of concern, I think, over ads now for a while.
Well, if you look at the stock, as you said, it's barely moving. I mean, it's down 0.1%. Now, what's interesting in this downgrade note from UBS, UBS actually expects growth to continue pretty much apace. The problem that UBS highlights is the issues with bots and spam and false information on the site, security, user security and safety. So these are actually more macro problems that Twitter, of course, it's nothing new that the platform has been criticized for that. I do think that, Jack Dorsey is going to face some heat this year. I actually predicted last year that one of the business things we'd see in 2020 was that Dorsey will be pressured, and I think that'll happen, to step down from his CEO position, either from Twitter or from Square. For a while it went well. He was steering two publicly traded companies, but now with all the heat on Twitter, and you saw a lot of criticism of the fact that Dorsey plans to spend at least a third of this year living in Africa. Some people saying, look, when you're running two publicly traded companies and one of them is under some pressure from lawmakers for, not policing false information and bots and trolls enough, then this is not the time to go live in Africa when you have a US-based company. So I think Twitter might be the company that Dorsey steps back from. And in fact, when you see downgrades like this and they're based on fundamental problems with the service, that's another sign that this could happen.
Well, speaking of just regulating bots or really addressing that problem, Elon Musk. So Jack Dorsey asked Elon Musk for some advice here in terms of what he would change about Twitter or to help with Twitter. And what Elon Musk said was that he would work on really differentiating the real accounts from the fake accounts, so we can see. And what we're talking about. That Elon Musk obviously has a massive following on Twitter, is a huge fan of using that platform in terms of getting his voice out there. So it's interesting, one, even that Jack Dorsey was asking Elon Musk for his advice, and then two, what he was saying as well.
Yeah, this video came out, and it's unclear actually when this video is from, but it was some, internal Twitter event. It came out on social media. A lot being made about this. So as you said, Elon Musk says, first of all, differentiate better between bots and real human beings, which I think a lot of people agree. That's been a problem with Twitter for a long time, and it's mentioned in this downgrade today, which of course, as we said, not affecting the stock that much. Now, Elon Musk also joked that he doesn't think it'll be more than 9 years, and he thinks it'll be more like 5 years. Yeah. So someone is sending a tweet from Mars, which, okay, homie, okay, homie. Now, also, it's funny to see Elon Musk giving advice. Now, of course, Dorsey did ask for it, but funny to see Elon Musk giving advice on Twitter because Twitter has been a double-edged sword for this guy. Yes, as you said, he loves Twitter. He has a huge following. All his followers worship at the altar of Elon Musk, but it's also caused him a lot of problems. Things he has said in fired-off tweets, that the language wasn't chosen carefully enough. He said, I want to take the company private at 420. Got in big trouble for that. He said funding secured. Now, more recently, he finally got past that. By the way, calling the British cave diver a pedo. That also happened on Twitter, and he had to go to court for that, but he won that case. Now, more recently, Tesla stock has been on a tear, and he tweeted and said, wow, the stock is so high, lol. So Twitter is a very funny tool for Elon Musk, a little bit like it is for President Trump, but I think his advice is probably useful. Also in that back and forth, Dorsey jokes to Elon Musk, you want to come run it? Which I'm not saying that will happen, but I think Jack Dorsey might be looking around for the next CEO.
Yeah, we'll see. All right, Dan Roberts, thank you. Well, coming up, earnings season is off to a solid start, but will next week's big slate of reports bring an unexpected surprise to investors? We have two experts joining us to weigh in next. Well, it's still early, but earnings season is off to a solid start. About 11% of the S&P 500 companies have reported fourth quarter results. Now, earnings are beating by nearly 5%, with 71% of companies that have reported exceeding their bottom line estimates. This is all according to the latest numbers from Credit Suisse. Joining us now is Sam McElroy. He's co-founder of At Financial. And we also have Kevin Barry, Chief Investment Officer of Cap Trust. And Sam, let me start with you just in terms of what we've seen so far for earnings. Do you think we'll see reasonable growth this year? Is that what you're expecting?
You know, I think that we're all kind of hoping that we do. If we look at where expectations were for Q4 of last year, there was a lot of expectations that companies weren't really going to hit their growth records or hit what they were looking for in terms of earnings. So being able to see that we're actually starting out with stronger earnings here in 2020 is something that we desperately needed to try to justify some of the valuations in the stock market. So we can only hope that it kind of continues from there. But I think there's a lot of warning signs that we got to watch, especially in the IPO market.
Kevin, how about you? So far, we've had not too many S&P 500 companies report, but what we have seen has been very strong. Do you expect that momentum to continue?
I do, Shauna, for a couple of reasons. Number one, analysts brought their earnings way down. So they brought their earnings estimates down. Makes it easier to beat, number one. Number two, when we've seen revisions, we're seeing upward revisions, positive revisions, mostly in the information technology sector. And that's the biggest sector in the market. So when we're getting positive revisions there, that's very good for earnings overall. And lastly, as rates came down last year, kind of like a seesaw, rates came down, housing went up, it contributed to the economy, and the BAA yield, a long BBB yield, came down a lot, and that is very positive for earnings. So when we look at earnings, first we look at the direction of interest rates and credit spreads. That all comes together with a long BBB yield, and that's come down, and we think that's very bullish for earnings.
Sam, you mentioned some of the warning signs that you are looking at in the market right now. You briefly mentioned IPOs. What specifically about IPOs has you a little bit wary this year?
Well, I think anytime we start to get towards the top of a bull market, we tend to see that stock values are overvalued just in general. And so this is an opportunity for investment banks to basically try to get other corporations into the market, usually at inflated prices as well. So when you see a number of IPOs coming on the market that end up being losers or end up dropping in value, that can sometimes be indicative that the market is in fact overvalued. In fact, the last time that we saw some of the records in terms of what we're seeing right now was around the late 1990s, at the height of the dot-com bubble. So that's something that we definitely want to pay attention to.
Kevin, we got that phase one trade deal this week. It didn't address a lot of the core issues. That's what we're hearing from a lot of investors, from a lot of people on the street. But from a market perspective, was it enough for investors to kind of move past some of the uncertainty that has been surrounding trade now for the last several months?
Yes, absolutely. Think of the trade deal as being an election device. And so President Trump, if he had imposed that second level of tariffs, it would have increased the price of an iPhone by over $200. Who wants to run for election and have millennials vote for them when you're raising the price of an iPhone, or everyone for that matter? So it was a very political move. And so we got that. And the second thing we got was no extra tariffs altogether. So businesses are satisfied for now. And we don't think much happens until after the election on China trade. We do think there's an issue where auto tariffs could be imposed as we get closer to election, to solicit the votes of auto workers. That is a fear of ours. But for China, we think we're off until after the election.
Sam, what's your perspective? Do you expect anything material to happen before the election in November?
You know, as long as things kind of keep going at the rate that they're going right now, I would kind of share that opinion that it's probably going to be after the election. I think that one of the things that we really have to watch this year, though, is that it's not just an election year, but I think there's a good chance that it's going to be an even more divisive, potentially, election year than even the last one that we saw previously. I think that everybody is basically vying for a lot of things that are really on the line right now. And so as long as they can kind of get some of these pieces that have been potential issues to, let's say, rock the stock market or make it harder for you to be able to get your political agenda pushed through, I think we're going to see that that's going to be cooling off a little bit, hopefully, until after the election, in which case it may ramp back up.
All right, Sam McElroy and Kevin Barry, thanks for joining me. Well, coming up, where Starbucks is targeting its newest expansion plans. We've got all that. Don't go away. Welcome back to The Ticker. Let's give you a quick recap of what we've covered in the show so far today. Our first ticker was Gap. Now its board has decided to nix plans to spin off Old Navy. The discount brand has been hit by slowing sales in recent months. Gap also saying that the cost and complexity of the spinoff would likely not be worth it. Our second was Apple. Morgan Stanley and Nomura both raising their price targets on the stock. Morgan Stanley lifted its price target to $368 a share from $296. Nomura increasing its price target to $280 from $225. Apple stock is up more than 100% over the past year. Our third ticker, Snap. It's getting upgraded to buy from neutral at UBS. Now the bank saying that it expects Snap's improving user growth and ad monetization to continue well into 2020. Well, it's time for our last tick of the day, and it is Starbucks. The coffee chain is opening more stores in lower income neighborhoods, announcing plans to open or remodel 85 stores by 2025 in urban areas across the U.S. We have Dan Roberts, Dan Howley, and Jared Blickery all back with me to weigh in. And Dan Roberts, let me start with you just in terms of Starbucks' decision to do this. Why do you think this makes sense?
Yeah, I actually think this is built into Starbucks' DNA from back when Howard Schultz was still the CEO. I remember years ago, I think 6 years ago, I went to an event in Harlem where Schultz was giving out those wristbands. Remember, they looked like Livestrongs. And he was really pushing the idea of Starbucks trying to give back in underserved communities and lower income areas of the country. So this is really a more advanced, serious step toward the same goal. Now, of course, Schultz no longer the CEO, but still, I would argue in some ways kind of the face of the company, even though he stepped down and then he had that run for office. But I think this is a good thing. It's hard to imagine this not being good press for Starbucks. Now, that said, let's see what these stores look like. I mean, are they going to look the same as all the other Starbucks stores? Are they going to offer the same products? Are they going to have the same pricing? But as you mentioned also, there will be some new hires made for these stores. So I think it's a good thing.
Yeah, certainly. And Jared, it could really help the local economies.
It could, but we're talking about 85 stores right now. That's kind of a drop in the bucket when you consider they have something like 30,000 locations around the globe. So this is just a drop in the bucket for them. Maybe it's just a pilot program to see what works and what doesn't so they can expand it. But I agree with Dan. It is part and parcel with the Howard Schultz legacy here.
Dan Howley, could this help Starbucks overcome some of the mistrust that it has been facing out there?
Yeah, I think that's really something that they're trying to do. You know, they obviously do have philanthropic efforts. Howard Schultz, as we mentioned, kind of made that part of the business itself. But, you know, you remember that incident a few years back when 2 African-American men were asked to leave when they were just sitting there in the store. That kind of started off that huge controversy, and then they had the retraining of staff members. This was something that originally took off in Ferguson, Missouri, and then kind of grew from there. And as far as the pricing goes, we know that there are slightly lower prices in these kind of stores that they build out, but not by much. You're still going to pay $4 for a latte. So it's not exactly a cheap Starbucks, but it's a little bit helpful.
All right, guys, let's go beyond the ticker. Tech still dominating Glassdoor's 2020 jobs list, holding 20 of the best 50 jobs. Front-end engineer was ranked the #1 job, best job for 2020, followed by a Java developer and also a data scientist. Dan Howley, we talk about time and time again, it seems like over the last several months, that maybe some of these tech giants aren't able to attract some of the top talent that they once were. They don't have the exact same type of lure that they did in the past. Does this really prove that that's not really the case?
Yeah, I mean, you know, maybe it's not the tech giants that are attracting them, but it could also just be smaller companies that are getting online. Don't forget, every company now is virtually a tech company, and they need people like this to get the jobs done. I think that for the front-end developers, that seems to be a more fun job where you can be creative, but that also puts a lot of stress on you. These jobs are not easy, and they require a lot of work.
And Dan Roberts, like Howley's saying, it's not just some of the tech giants, it's some of the banks, it's some of retail, healthcare that are really filling some of these tech positions.
Teach your kids to code. Tell your kids to learn to code. That is what I will tell my children someday. Don't major in liberal arts like I did. Go learn to code. These are the jobs that pay the most, and that's going to be the case for years to come.
All right, well, there we go. Good job, Dan Roberts. All right, moving on here, we also have a big mover heading into the last hour of trading, and that is Boeing. That stock is moving to the downside following an ABC News report that there is another software concern for the 737 MAX. During a test last weekend, the model's 2 flight computers weren't talking to each other at startup. According to Yahoo Finance sources, this issue was found during a technical review before the software package had been finalized. Jared Blickery, I know that you closely watch the stock. In terms of this latest development, shares are off 2%. What does this mean for the company going forward?
Well, just looking at the stock price, it's at a very dangerous area right here. I've been saying for months, 320 is a level to watch. It breaches out, watch out below. The Boeing really needs to get the MAX off the air, I would say by June of this year. If it goes much farther beyond that, they're going to start losing a lot of money. They're going to have to pay their suppliers more. Some of the airline companies, this could be a really big deal for them if it postpones that eventual liftoff date for the 737 MAX.
And Dan, this could really delay some of the investigation. We already talked about the fact that it's already hurting Boeing, but Dan Roberts, this could either further delay some of that investigation.
Well, yeah, Shauna, just this morning on the First Trade, remember one of our guests was saying that the big unknown and big black swan event, it was David Nelson, was suggesting that the big black swan event is if Boeing doesn't get the rest of those 737 MAXs in the air. And we already know that it doesn't look like Boeing is going to be making more of them, but it has to get the ones that it has grounded back in the air. And yet the stock really hasn't taken the kind of hit that you would have expected in the last year, because in some ways it's a Teflon trade. So we'll see. We'll see.
All right, we'll leave it there. Dan Howley, Dan Roberts, and Jared Blickery, thanks so much for joining the ticker today. Taking one more look at the markets before we let you go. The Dow holding on to gains, as well as the S&P and the NASDAQ. All three of the major indexes moving to the upside. Keep it right here on Yahoo Finance. The final round will take you through the last hour of trading.
Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Stocks still pulling higher here as the markets look to wrap up a record-setting week.
Miles Upton, this says earnings season gets going in earnest. Traders looking at a slew of big reports next week that could keep the market momentum going. We'll have more on that in the market action coming up in just a bit.
Plus, UBS getting bearish on Twitter ahead of election season. It is our call of the day. And Wall Street analysts are betting on a big year for Apple. Is there still time for investors to get on board? Plus, we grade the week that was for Trump with your Trumpometer score. And you can't do the Trumpometer without Yahoo Finance's Rick Newman. So he is here to talk Trump and all of today's
58 minutes of the Trumpometer coming up.
Oh,
right after this.
Everyone's turning the volume up right now.
Exactly.
Only Trumpometer all the time. This is it. It is the last hour of trading. Checking in on the markets. It is muted market action, but it does not matter. It could be up just a sliver, and all three indices are going to still be at record closes. You just have to end in the green today. I will note, Miles, something that you have been talking a lot about.
Do tell.
Is the Russell.
That's right, underperforming today.
Underperforming
Very sad.
today.
Very sad.
I had kind of gotten used to this idea that small caps, and we were talking about Dow Transports, we had Dow Theory, we were pulling out a lot of different numbers to show how well we were doing here at record highs. But we're still doing well, even if the Russell's underperforming. Yes?
Yeah, I mean, we're still doing well. I think our old friend, the VIX board, VIX Futures board, we have a new futures contract on Tuesday. February will be the front month starting on Tuesday. We don't need to get too in the weeds on this, but just as a reminder, what has happened in this market over the last 18 months at various points, the VIX and the way that that contract is structured and the way it impacts those ETFs shorting volatility has, obviously there's a Volmageddon. We're not saying that that's probably going to happen, but, that has created some, an upset stomach, as it were, for this market. And so I would just note, if you want to talk about a synthetic or a technical type of event potentially coming in this market, next week will be the week to have it, because I think fundamentally, right, everything is absolutely perfect. Couldn't be any better.
Which goes to a theme that we've also been talking about. This reminds us a lot of 2018.
That's bad.
Or is that good? So
which part of
2018
The good part of 2018 was January 1st to January 15th. That was it.
Yes. So, and Davos, we're just having a lot of deja vu right now. What market highs, things seem to be going okay with the economy. The global economy is back. Good news out of China. But this fall issue, the VIX issue, maybe some complacency, or we just gotta get over this.
I mean, I am impressed that you keep coming up with new and colorful ways to describe record highs, and Miles always finding some tension somewhere in the market. I mean,
my job, Rick.
Great, he's the one that's always optimistic. I'm looking for
now he's worried about the VIX. The resetting VIX.
I'm not worried about anything. I'm reporting. This is reported.
So this is really like it's like this market's like a happy zombie. It just kind of slowly moves forward no matter what. Nothing can stop it. There's no resistance. The metrics say it's overbought, but nobody cares. I did see an interesting note from Briefing.com today pointing out that we are not seeing the sell-off in treasuries that you normally get when the market is surging higher. In fact, there's been, the 10-year has been very stable over time, which suggests that people remain in the safe havens because they're expecting something bad to happen, a correction, but they're still riding the gains. And we heard, I think one of the things we saw today, a couple of hedge fund guys saying, "Oh nope, I'm all in on this bull market. Let it ride."
Yeah, it doesn't make sense
So
what
let it
we're
ride.
saying, because if the economy is going to be doing so well and stocks are telling us that the future is very bright, if the future were very bright, wouldn't we be seeing some sort of reaction in treasuries? If the economy is going to be fantastic.
181 on the 10-year.
Same as where it was in 2011, by the way. Even though we've had 170% gain in the S&P 500. We don't talk often about housing, but we did get a good-looking housing starts number.
So I'm saying fundamentals are good.
That's a real fundamental, because when you're starting building homes, that's a big commitment in the future, and that's a lot of economic activity that's going to go along with that. So that is not a blippy indicator. That's a sticky indicator.
Yep. Well, for more of today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Miles, the Dow is up almost 0.1%, and we're looking at Boeing, the worst Dow performer right now. Boeing down around 2%. It moved down a bit lower. This is after the company said that it's working on addressing a new software issue, which it found during a technical review last weekend of the 737 MAX jet. And in a statement, the company said, "We're making necessary updates and working with the FAA on submission of this change." Now, it didn't give too many details as to what this new software issue is. According to a person familiar with the matter, the issue is unrelated to the MCAS safety system. That's a MCAS system that a lot of this issues with the 737 MAX has been focused on. This involves a secondary software which Boeing had been working on in June. There's no set estimate of to when there'll be a resolution about this, just that Boeing is working on addressing this. Now, the stock earlier today had been a little bit under pressure after Bank of America had put out a note saying that the total cost of this whole 737 MAX crisis could go up to up to $20 billion. But the stock really moved to the downside once this news came out that it was working on this new software issue, which it had identified during the technical review. Miles, Jen?
All right, Nez Perce live from the floor of the New York Stock Exchange. Just to look at Boeing shares there closely. We've talked about the stock for quite a while, that 323 level, that 320 level that Jared has pointed out many times, continuing to hang in here. You look at a longer term chart, over the last year, the low end of the range, as they would say. And I know that Boeing is going to say, oh, this is fine, blah, blah, blah. But, you got analysts over at Bank of America coming out saying that we, meaning Bank of America, is getting questions about whether the 737 MAX will ever get in the air again. And I mean, I know that I guess the most likely outcome is it does, but at this point, it is really hard to imagine what that looks like, of people getting onto, the thing that goes to the plane and actually getting onto a 737.
Well, what it would look like is Boeing, I think the worst case scenario for Boeing is that the FAA here in the United States just says this has to be certified as a totally brand new aircraft, which it's kind of getting there. Yeah. So yes, you're going to have to do new simulator training. Yep. Yes, new pilot training. Yes, pilots have to be certified for a new aircraft rather than just, oh, you flew the last one, that's good enough. I think that is the worst case scenario, and that's what Boeing was trying to avoid all along, which is why it cut the corners it did. So that means more costs for Boeing and probably more costs for the airlines too, which means they could throw that back at Boeing and say that's a violation of the original contract. So I think that all falls on Boeing, but that is a pathway to getting the plane flying again.
I think in hindsight, they should have just gone with a
Obviously.
Totally different plane, because not only, I know they have so many issues here and this thing needs to get renamed, but just with the tragedy in the beginning of the month in Iran, remember that was the 737. Before we knew what happened, how much talk there was about, is this related to the 737 MAX? Well, this is an 800. Is there anything here? Anything that happens now with the 737, even the older ones, is tagged with this. It was a new plane. There was so much that needed to go into it.
The tragedy of that for Boeing is this has been a terrific workhorse of a plane with an excellent safety record up until they blew it with the MAX. So to me, we've talked about this so many times, but this is possibly the biggest corporate screw-up of all time.
Yeah, because it's not only a mechanical engineering issue, but I guess
it's lives.
It's lives as well.
Culture in their company.
It's a branding issue. Like you basically took all the goodwill that the 737 brand had accumulated, and you puked it out on a plane that, one, wasn't a 737, and two, was fatally flawed.
Plus, New Coke didn't kill anybody. I mean, when you blow it this bad with branding, and I think it was 346 people in 2 crashes is the death toll. I mean, unforgivable.
Yep.
We will continue to watch the story. Again, Boeing shares under pressure today on that new report you heard Inez talking about. Right now, it's time for our call of the day. And today, it's Twitter. Analysts at UBS downgrading the stock to neutral, saying they see the company at a bit of a crossroads entering 2020 in terms of capitalizing on opportunities like the Olympics, European Football Championship, and of course, the U.S. election, while keeping the network safe and secure at the same time. Miles, big Twitter
Well, since I use the platform, Jen, we're all big Twitter users.
You guys are.
Okay.
Anyhow, okay, so you've got an inside scoop here.
Yeah, that's right.
And, well, what do I have? Reading the note, what I did think was interesting is that I feel like they haven't figured out the targeted advertising part of it.
I notice that on my feed all the time.
And I notice it in my feed.
Yep.
And they need to invest to make that work. The investment is going to cost money. That's why the margins aren't going to look great for the next 1 to 2 years, and the risk reward isn't as good. So get out of the stock now, see how this plays out. But as a user and somebody that also uses other platforms, advertising on Twitter I'm there for a reason.
Yeah.
And it's not to get distracted by your ad. On Instagram, I'm like, oh, that's a nice pair of shoes. I don't mind getting distracted. Twitter does not make the impressions. Is that ever going to change, whatever investments they make?
Yeah, I don't know. I mean, I still think, at least it still seems from the outside to some extent, like Twitter is a company that, while it is a little bit more realistic about what it is and isn't than, say, maybe Facebook, right? Facebook is continuing to pretend that it has no kind of relationship with the content on its platform, right? Twitter seems to be understanding that it's a news platform, first, second, and last at this point, really. But what that means is they need to be treating this the way that a cable network would be treating their advertising product. They maybe need to be treating this the way that a newspaper is treating this advertising product. And I don't mean like micro subscriptions and all that kind of stuff. It's just like, what is going to connect with an audience who has come here for news? They're not the first news platform in the world. There are people out there who know what the answer to that question is. It just seems that some of those folks don't work at Twitter.
Also, the stock is performing like a news organization.
Well, that is a problem, yes.
I mean, what did it hit? Almost 70 shortly after the IPO back in 2013. It's now around 34, dismal. And I feel like part of the issue with Twitter is there's more of a natural ceiling on Twitter than there is on Instagram or Facebook, it seems to me. It's just not for everybody. And Instagram is more universal. Facebook is more universal. I think to me, the more interesting Twitter story is Jack Dorsey said in an interview recently. Did you guys pick up on this?
I saw this.
That he eats only one meal per day?
Oh, we talked about that yesterday. I thought we were talking about Elon. Okay.
Oh, Elon Musk is the other part.
Yeah.
But, oh, you already talked about it.
No, we haven't talked about anything. Well, we talked about the meals.
Can we quickly do the meals with Vic?
Yeah,
What's your
what do
take
you
on
think?
that?
I couldn't possibly do it. I mean, but he is like the ascetic Twitter bro. I mean, right. I do kind of like that about him, that he is able to sort of impose this self-discipline on play. Anyway, what he said was he eats one meal a day. Yeah. It's a huge meal, meats and all kind of different meats and stuff, and then he basically fasts for 23 hours.
Mm-hmm. Yeah.
Miles really likes it.
I mean, we're all stunned into silence. We're like trying to contemplate that.
I'm in the middle.
You should have heard Dan Roberts talking about it yesterday.
The other news, though, that he had was that during a video call at a company meeting that was going on in Houston, Jack Dorsey apparently asked Tesla CEO Elon Musk what he would do if he were running Twitter. Because obviously Elon's crushing it.
Well, it should be.
They should 500.
It should all be electric, obviously.
The whole thing. What did he say?
Like make people be their real selves or whatever, which is actually funny. It's a very, in my opinion, it's a very anachronistic view of the internet, which is sort of interesting coming from someone who's as plugged in as Elon, because the notion that like anonymity on the internet is the real problem with the internet, a real problem with networks, is what people thought in 2008, and that's obviously not the problem with the networks. The problem with the problem. It's a problem. It's not really that big a problem, right? The problem would be that Twitter is still part of this group of social media companies, and even though the size of the company and the valuation, the way the market treats it, has nothing in common with Facebook, they all still have this problem of trying to deny the business they're in. They want to be in the platform business, and they're actually in the news business.
Wait, you're talking about the internet as a whole. I think with Twitter specifically, I think anonymity is a real problem.
I don't think so.
I mean, it contributes to the really negative culture because people can get away with saying anything.
The people who say...
I'm sorry, they're not even people. They're fake accounts.
The people who say the worst things on Twitter are verified, and they work at major media companies, and they like to put forward the notion that it's actually the anonymous people on Twitter.
I don't think you've seen the worst things on Twitter.
I
mean, they're in my feed, and they're way worse than anybody who would have to put a name to anything would be allowed to say.
I think we have a different definition of what bad is.
The trolls also, I think, scare off a lot of people who might otherwise participate in Twitter.
Yep.
Again, still disagree.
Hold that commercial. We need to keep talking.
Still disagree on that. All right, coming up here, Wall Street analysts betting big on Apple for this year, but is there still time for new investors to get on board with this runaway train? We'll discuss, but first, let's take a look at where European markets finished the week.
Now it's time for Tech Howl. Companies like our parent, Verizon, and handset makers are all betting big on 5G. And one phone in particular is expected to carry the wave, a 5G iPhone. Dan Howley is here to discuss with us. So this 5G iPhone, it's like, I don't know, some fantasy out there. But is it really coming?
It is basically the messiah of phones for Apple, apparently, as everyone has described it. And it should do well for the company, but at least one analyst at Nomura is saying that this is not going to be the case. And makes a good point. Basically, the thinking is that right now, 5G, as it stands, is basically faster downloads for your movies and music. Mm-hmm. But how much faster can it really get for us? For an average consumer, there doesn't seem to be any real gain at this point. In fact, if anything, you're overpaying for a device that can't take advantage of a network because currently the layout of them, it just doesn't exist. We have tens of cities as opposed to thousands that we have with 4G LTE. It took several years for a major layout of 4G LTE to really become as ubiquitous as we have now. Yeah. And that's not where we are with 5G yet. And despite that, we will see the iPhone in 2020. At that point, those networks still won't be at the level that we want. So the idea is you would end up paying potentially more for this iPhone. It might not be able to ride on that new network. And then what the hell am I going to do with speeds?
Right. I mean, I'm almost wondering, is Apple setting itself up here for a situation in which it releases a very expensive 5G-enabled phone, kind of telling consumers, you should be waiting for this or you should save up for this, and does so at the detriment to the rest of the line? Like if they just released iPhone 12 or whatever is next, they could just don't worry about the 5G until we're talking about the 2023 world.
Well, and that's the thing, you know.
Also, my new phone says 5GE.
That is phony.
Which seems fake, but
AT&T,
why? What is that?
AT&T calls it that because it's.
You're with AT&T?
Whoa! Someone just got fired. That's
so clear we're having technical difficulties.
I'm like,
what is that? I can't hear you. I can't hear you. Commercial.
I was like, why don't I have 5GE?
That's cheaper?
Traitor.
I'll tell you this.
Traitor.
Tell me off the air?
I'm on the family plan. I pay my father directly for the phone.
We know.
Work does not pay for this.
I'm so sorry. Continue.
Definitely won't make the highlight reel.
Video is now not usable anymore.
That's not really 5G.
I know it's not. That's why I'm asking why it's on my phone.
It's cheap marketing stunts. That's all that is. When we do get 5G, we will be able to, like I said, download music faster, load websites faster, download your Spotify playlist faster. But you can already do that so quickly. Okay, say you get a faster phone, right? You can download 4K movies super fast on your phone. Your phone's display is perfectly fine displaying movies at 720p because it's a small screen. There's no reason for 4K. So it's a silly move until we get the technology through the apps.
I predict there are still going to be people lining up to buy this, because some people just want to be the first to have everything.
Rick Newman is 100% right. Because
and I will not be one of them.
Also because Apple will make something else different. It will not just be a 5G phone, and I will tell you what it will be. It will be something that you can see, because Scott Galloway knows this. We've talked about it before. You need these 3 cameras here so people know you got the new phone. There's going to have to be something on there that shows this is a 5G phone, but it also does something else exciting. 4th camera, 5th camera, that 3D thing. There'll be more to it.
It's going to happen that way, and I think that's really what's going to be the selling point.
I should go work at Apple.
Yeah.
Dan Howley, Tech Howl. Have a great weekend.
I will.
All right, coming up here, are you retirement ready? Doug Bonaparte will join us to discuss the biggest thing millennials can do to control their financial destiny. But first, let's take a look at today's trending tickers here on Yahoo Finance.
Now it's time for our retirement segment brought to you by Fidelity Investments. A new report from the National Institute of Retirement Security has found that 40% of retirees rely entirely on Social Security for income during retirement. Should millennials be planning for that possibility? Joining us is Bonafide Wealth President Douglas Bonaparte. So, Doug, millennials will be lucky if 40% of them can rely on Social Security, right? I mean, are millennials going to get any Social Security?
So that's a great question. Clients ask that all the time. So what we do, we don't know, but I would think there'll be something rather than nothing. So we show scenarios with 100%, 50% current benefit, and 0. So they can kind of pick where they think they're going to end up.
But what if the 0 comes to fruition?
Miles is already distraught.
Like if I get half, that's okay. Yeah. But if I get 0, I'm just going to work till I die.
No, not true. We create plans around 0. It does put a lot more emphasis on saving for retirement. I think millennials, more than any other generation, have to carve out a very different pathway to get there.
And we've talked about this before a little bit. When you look at millennial clients and what their kind of tendencies are, I mean, you and I know that they should probably be like 90, 95, maybe 100% equities, right? But I find that my friends who have normal jobs and don't have to think about this stuff, people are still kind of scarred by the crisis. They're still just assuming that everything's fake and it's a casino and everything's going to be taken away eventually.
Right, and there's kind of like this myth out there, like millennials are scared to invest. I think that it's hard to get millennials to invest outside of retirement plans, but I think you'd be hard-pressed to find retirement plans out of the younger demographics that aren't mostly invested towards equities. Even if they're not doing anything and go into that target date fund, it's mostly equities. So I think that's a myth, really.
I'll make a guess about what's going to happen with Social Security. I think that it has to remain, and the way it's going to remain is a value-added tax. Which we're the only nation that doesn't have one. So in order to keep benefits going, Miles, for you.
Thank you.
Everybody's
everybody
going to be paying a little bit more for most of the stuff we buy at the store.
I'm over millennials and I'm onto Gen Z.
Yeah.
And I'm curious because
that's what you have.
That's what I have.
You have a small investment in that generation.
I have joined TikTok.
Okay.
But,
I've been canceled.
But Miles and I have only done one TikTok post and it's not even public. I might show it to you. So Gen Z, we always say, got to start investing the younger you are, and you say be riskier the younger you are. How risky can you be? Because these kids are like into Beyond Meat, they're into Tesla, they're into cannabis names. If you're really young and just got a job,
penny stocks too.
They like penny stocks. Is that okay to do for your retirement, or is that even too risky for your theory?
I have a hot take on this.
Oh.
And that's for young people, itching to get into the markets and investing, I would say, hold up. Like, let's take a look at... Hold up. Did you get the fundamentals down right first? Show me the cash reserve. Show me cash flow, like where your money is actually going. There's a lot of FOMO or, this fear of missing out of, it's kind of a slap to compound interest in the face to say, like, the sooner you get in, the more compounding you will get. But guess what? You won't be able to enjoy that if you don't have discipline to invest and you don't have the fundamentals down to feel good about investing in the first place. So, chill with the Beyond Meat calls, right? Let's get a nice 3, 6, 9 months of cash there, and then maybe we can talk about investing.
Stocks mostly go up. Miles points that out all the time. But there was this period of time called the 1970s, which were miserable for stock market investors.
Was the world in black and white back then, Rick?
Well, yeah, and we talked on rotary phones. Right. And do you advise people? It's worth learning some history about stocks because they don't always go up. I mean, we could have another 5-year period of sideways movement, if not worse.
5 years, perhaps. I think recently it's been demonstrated by colleagues that it's very, very, very hard to have a 10-year period of time where stocks lose. And we're generally thinking very long-term time horizons if you're talking Gen Z, I mean, we're talking 30, 40-year investment time horizons, maybe longer. So why are you talking to me about 5-year time horizons here? So let's be very realistic as to what the goals are, the timeline to get there, and then ascertain what kind of risk we can take.
My answer to that would be people aren't shocked into submission so that they don't go through some horrible period of time when they watch their investment fall by 60%.
use that time as an opportunity. To your point, make that your history of learning how to navigate tough markets. So you can look back and say, man, I remember 70s into 80s, what that was like. You're going to enjoy what's happening right now that much more and be more prepared for it.
If you buy the coins, you'll know all about what it's like to go down 80%. So that's how millennials are going to learn. All right, Doug, always fun. Douglas Bonaparth, president of Bonafide Wealth Management. Thanks for stopping by.
Thanks, guys.
And coming up on the final round, with a phase 1 trade deal and a USMCA accord nearly here, we will grade the week that was for President Donald Trump in our Trumpometer score. But first, let's take a look at where big tech is trading right now with a half hour to go in the session. All right, welcome back to the final round here on Yahoo Finance. Miles Little with you in New York. I'm joined as always by my co-host Jen Rogers. Also stopping by today is Yahoo Finance's Rick Newman. Let's take a look at the markets right now. A little bit of a quiet close here. All three majors are higher, so we are on pace for record highs. Not quite the enthusiasm in today's market that we saw during yesterday's session. Of course, any positive close, again, will be a record high. Just quickly, Rick, you and I were talking in the hall before we came on about Davos coming up this week, and about how it's been. I mean, it's kind of a silly event, right? Everyone gets together and they whatever, but it has also been an interesting contra for the market the last couple of years. The mood, as it were, at Davos has been the exact opposite of how stocks performed in the year ahead.
A lot of times, these rich people are very worried about the rest of us, and I personally find it very reassuring to know there's such a high level of concern by the people over there. But stock markets don't always see it that way. So you're the guy who has the data on the market, so riff on that.
No, it's just the last 3 years. It's been every other, right? 2017, the mood out in Davos was, post-Brexit, post-Trump, what are we going to do? Stock market went up 20%. 2018, Ray Dalio said you'd be an idiot for being in cash. Everyone was all bullish. Andy Serwer has a piece that I linked to in Tuesday's newsletter where he heard from one attendee who said it's the best mood they could remember. Well, 2018, the market went down 7%, and it was a complete nightmare. And then last year, we had darkening economic clouds, and stocks went up 30%.
Year. So. Davos is the apotheosis of globalism. I mean, if that is what it is. So if anything, it is a sort of a barometer on how are the globalists doing. And, that matters to the rest of us. I mean, it disrupted supply chains, which we have had in the the last couple of years. Not great for us, but we've recovered from that. So I never know how to read Davos, and my thinking about it is just don't try to read it at all. Just see if any rich people say anything that's actually interesting.
Apparently 100 billionaires are going.
Is that all of them?
No, there's 2,200
billionaires
in the world in U.S. dollars.
Oh, so most billionaires are not going to Davos.
I guess that's one way of looking at it. But where else do you find 100 billionaires?
Yeah. I suspect that Davos will be very bullish this year.
Contraindicator.
Yes.
I mean, look, it's always a good year for the people at Davos.
Well,
there's no such thing as a bad year for those people.
Well, they didn't like when Trump won. Anyway, we
They do
digress.
now.
We digress. All right, for more of today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Miles, 25 minutes left for trading today, and we're watching Snap, which today has seen a pop. This is after UBS upgraded the stock to a buy, saying that momentum with ad revenue with user growth is going to continue in 2020. Now, this stock from January, the beginning of January till now, is up about 22%. It's gotten some very positive analyst note, including very bullish notes on international user growth. Meanwhile, we're watching Dave & Buster's with big gains today, up about around 12%. This is after KKR disclosed in a filing today that it now has a 10.7% stake in Dave & Buster's, including shares and options. Now, KKR says that it has met with management and it will continue to have talks with management or the board. This week, Dave & Buster's said that same-store sales would be down anywhere between 2.5% to 3% for its fiscal year, which ends in February. Today, the stock is seeing a pop. Jen, Miles.
All right, Inez Ferre live on the floor of the New York Stock Exchange.
Let's go to this week in Trumponomics. Rick Newman. So the week, I'm trying to think, because there were a lot of big headlines. I mean, obviously.
Well, the impeachment trial started this week.
That's fresh on my mind, but it's all the trade stuff.
Yeah, I mean, we've been talking about trade so much that it's a denouement when these things actually get.
He said apotheosis, and now denouement.
I don't know what's a word. It's a little anticlimactic. Is that okay? All right. I was an English major. Denouement is a stage in a novel. You know, I mean, I think it's part 4 out of 5 or something.
Boy, I studied English too, and they didn't teach me that.
But we had, so we actually had finality on the Phase 1 trade deal, and the Senate finally ratified the USMCA, the new NAFTA deal. And I grudgingly give Trump credit for accomplishing something on trade. I don't think there's much to either one of these deals. But the USMCA will, I think that's actually going to be stable. I mean, I think we've put that to bed basically for probably 10 years. I mean, this doesn't really need to be reopened, even if a Democrat succeeds Trump. The China trade deal is another thing altogether, totally based on promises and assumptions. That could unravel more quickly. But nonetheless, Trump does have something he can tell voters he accomplished. I don't think it's much of an accomplishment, frankly, but I'm going to give him credit for at least getting a small something done.
All right, let's get
Last week was mediocre, and the question is, to create some tension here, will Trump exceed mediocre this week?
All right.
What's your bet, Miles?
I can't say. I have inside information.
I feel like
you do?
I think it's just a hold. That's my guess. I don't have any.
Hold rating. You know, I would say this is sort of a.
You knew mediocre was coming?
Hold rating, and we raise our price target $3.
Yeah, that's
after refining the model.
I think that's a great way to put it, because the Phase 1 deal with China really depends totally on what comes next. I mean, are they, and I think the number one thing to watch for from the U.S. side is, are they actually going to buy more farm products the way they've promised? People, trade experts who are trying to analyze where this is headed say there are very, very many reasons to be skeptical. China cannot just sort of favor American exports even if they wanted to. Other countries can raise complaints at the WTO and things like that. Do we even have the farm products ready? It's not like just like they're sitting there, and it's not even a given that China's going to do what it says it's going to do. So there are a lot of different things. But I think this is probably not going to cause too much trouble for Trump as an election issue, because I think he's done enough to sort of just put this off to the side for now.
I want to.
Markets are also relieved. Let's point that out.
This is somewhat tangential to the Trumpometer, but in the area of trade.
The Trumpometer itself is tangential, so it's no problem.
So let's go back to Tuesday night when we had the Democratic debate and that discussion on trade. And
it was electrifying.
Well, I mean, everyone on stage except for Bernie Sanders said the USMCA was great and fine. And I think now that we have a phase 1 trade deal, I guess just in your view, as you look at the future of U.S. trade policy, right? We've obviously ripped up the script with China, and we have to piece it back together. So Trump might get 5 more years to work on that, but he may not. Going forward, where does this whole thing head? Because, okay, we've got the phase 1 in place, but there's still a bunch of stuff that previously we had sorted out to some extent that is now up in the air.
Well, where this stands right now is our existing trade relationship with China is still there, but the cost of transacting is now higher because most of the tariffs Trump imposed remain. And so what we don't know is if a Democrat succeeds Trump, will that person kill these tariffs and go back to the way it was before, or leave them in place and use that to try to negotiate with China in some different way? If Trump wins re-election, for sure those tariffs are staying there, and the barriers could go up a little bit more. So the best case outcome that I see is, regardless of who wins in November, if this is the beginning of kind of getting China to play by the rules a little bit more, it could be a good thing. There's also the possibility that China has absolutely no intention of doing some of the things that are in this trade deal or of making any further concessions. And they might just be stonewalling Trump to see, betting that he loses, and they might get a better deal with a Democrat or something like that. So I think we don't know, but I think the markets probably don't have to worry about this until we know the outcome in November. And as we know, this has been an overhang for 2 years on markets. So off to the side for now.
Hold it mediocre, raise the price target just a little. Trumponomics for the week.
All right, coming up, will earnings season end up pouring some cold water on this hot stock market? Brad McMillan of Commonwealth explains what could put a damper on profit growth this year. But first, let's take a look at where big financials are trading right now with a little under 20 minutes to go in the session. All right, let's take a look at some of today's winners and losers in the stock market. Stocks in the red include United Natural Foods. The grocery wholesaler received a downgrade over at Wells Fargo to underweight with the firm kind of looking at some questionable trends there for the company. That stock down, can I read it? 10%? 10%. It's very small on the return camera down there. We used to have a big camera over to the side. I can't see it anymore. Another stock lower today, JB Hunt. JBHT shares lower after the trucking company reported disappointing earnings and revenue for the fourth quarter. That stock off over 4%.
Makes me better when you can't read it. Stocks in the green include Pinterest after the social media platform received an upgrade at Wells Fargo to overweight from equal weight. This stock has been up a lot this week.
After it went down a lot. After
That was last year.
That's old news, man. Don't worry about that. All right, stocks, what do you know? Hitting record highs ahead of Davos. So is this shades of the 2018 market? Brad McMillan is the CIO at Commonwealth Financial, and he joins us now to discuss. So, Brad, we've asked a number of our guests if it feels like 2018 to them at all. Are you seeing signs of that, or does this market set up the rally the end of last year into January 2020 feel different?
I think we're going to have a good year ahead, but it worries me as we get into mid-year. What we got last year was we got a huge expansion in valuations. Earnings didn't do that much. And this year, even though we don't expect earnings to do much, we don't really have the room for valuations to go up. So I think it's going to be a much calmer year.
Hey, Brad, you had something in your note that jumped out at me. This idea that there's still a premium to growth, but there are these companies that are not really tech companies in there that we need to be thinking about. And you mentioned Uber and WeWork as not really being tech. So I want to play a little game. There's literally no wrong answer, but I'm just curious. Is Pinterest a tech company?
No.
Is Beyond Meat a tech company?
Yes, because they have an interesting technology that creates a competitive moat.
Interesting. What about, is Slack a tech company?
Probably somewhere in the middle. They're a software company, so I would say probably yes.
Huh. All right, this is really...
we should play this game with all our guys.
This is going to catch on.
I'm just curious. What's out? I mean, so what other... Those were three that I wanted to know about that I've just been watching. Are there other names that you've been thinking about that in the media or in their S1s we say, oh, these are big tech companies, but you're thinking, not so much, watch out, investor?
I don't really look at individual companies, but I think a good example of what I'm talking about is when Visa bought Plaid the other day. Now, Plaid is something that doesn't touch the consumer at all. You know, and one way of looking at this, is it a company that really works with other companies to create value, or is it more consumer-facing? And a lot of the consumer-facing ones, again, getting back to WeWork and Uber, they're basically replicating non-tech services. Airbnb, for example, could arguably be a hotel company. So I think that's the difference. Is this something that's actually adding value to business rather than something that's trying to market to consumers in a new and different way, but just using tech?
Brad, Rick Newman here in New York. Do you think the Phase 1 China deal means investors don't have to worry about trade overhangs for the rest of the year?
I think it's a real good signal. Even though we're seeing the Trump administration start to talk about, well, now we have to deal with Europe. What the Phase 1 deal tells us is that, yes, there is rhetoric out there, but ultimately the administration can get a deal, can actually make some more progress. So I think that's going to cushion any effects. I do think this helps going forward.
And then I guess also in the political sphere, do you think investors are underappreciating some of the risks that the election could pose? Or is that kind of something that people won't think about, the market won't price in until we're right up against that?
I think we're going to see a slowly rising headwind. I think you want to look back to the 2016 election. Everything was kind of okay, but then the news, the confrontation just got worse and worse. I think we're going to have a slowly rising headwind. That's actually something that worries me with respect to consumer confidence toward the end of the year. But one of the good things for that is we've had this level of conflict pretty much all along. So this year I don't think will be nearly as bad in that respect as 2016 was.
On the political front, talking about two different outcomes, because we're all watching impeachment as well. And even though we all think we know what's going to happen, this is still a live event. So an acquittal, which would reduce uncertainty, which is a positive, or President Pence, which would reduce uncertainty, ditto. So you think that, and again, I know this is a leap, right? But that a President Pence would reduce uncertainty and the markets would take that in stride?
I think what you would see is Donald Trump, President Trump, is a disruptor. I don't think he would argue with that. I think that's part of what he sees as what he's trying to do. So we've had a tremendous amount of disruption politically. We've had a tremendous amount of back and forth. President Pence would be a much more conventional Republican in terms of policy, and he certainly would be less of a disruptor. From a market perspective, if you don't have to worry about the tweets, that's probably a positive.
All right, Brad McMillan, Commonwealth Financial CIO. Thanks for joining us, and have a great weekend.
Thank you. You too.
And Rick Newman, you have a great weekend as well.
I got to go?
That's it. You're done. You've earned it, though.
Do you have anything more to say?
You've earned
Always.
it. Oh, the floor is yours.
Ask me a question.
The floor is yours.
Goodbye, guys.
You think Slack is a tech company?
Thank you for tolerating me. I do. I think Slack is technology.
I think so.
But you could go through, you could say I think Uber is a tech company. I think
agree.
the technology is actually
He doesn't
remarkable.
think it is.
Not
really tech.
I think Airbnb, not a tech company. They're a hotel company.
Yeah, maybe. But Netflix is an entertainment company. Netflix should not be in the FANG stocks.
But the FANG stocks are just stocks that go up a lot.
I guess, but
there's the right number of consonants and
originally
vowels.
they were, tech
yes.
upstarts,
Yes.
and Netflix is just an entertainment company.
Just a company.
It's a studio. Netflix is a studio.
Spending, what the last analyst told us this week, $17 billion on content this year.
Yeah. What else would you guys like to talk about?
Well, we were talking about Jeff Bezos' jacket, which Jen has now tweeted about. But
yeah.
I can't believe Miles would wear it.
Of course you can. Have you seen the things I've worn before? There's that shirt.
Would you wear?
I have a jacket that isn't that different than this that I wore to Julia LaRoche's wedding.
we shouldn't make this an inside joke. We should put the jacket up. We don't have a.
That's not the jacket
That's
either.
not it.
Which I guess I'd wear that.
When he was in India.
What about the Bezos swimsuit? Would you wear that? $400 swimsuit that was such a big deal over the summer? Or no, it was in the
He
fall.
has interesting taste, I will say.
Is it the one where it was him and Barry Diller and the whole group of people out in
No,
Cannes
it was
or
one of his first pictures with Lauren. Was that her name, Lauren?
Sanchez?
In the French Riviera or someplace. Sure. And we did a segment on the what's Bras saying?
It was David Geffen's.
So because I had to look up the bathing suit because we did some stupid segment on it. Yeah. I'm still getting ads for that bathing suit because Google knows so much. Google knows so much about me. They know I'm exactly the kind of guy who would spend $400 on a bathing suit. I would buy a used bathing suit to save money. Google doesn't. I'm so proud. Google doesn't know this about me.
A used bathing suit.
Yeah, at the right price.
My God.
What else you guys want to talk about?
Used bathing suit.
I've bought a used bathing suit.
Oh my God. See?
True story.
Who are these people?
On Poshmark.
Don't you know you're on the Jen Rogers show?
We got to get out of this.
Somebody pull the plug.
You put them in the wash. Okay, Rick Newman, goodbye.
Bye.
Coming up, we're going to get back to
Goodwill
business.
doesn't accept underwear.
We're getting technical with Jared Blickery at the Wi-Fi Interactive Touchscreen. But first, take a look at where chip names are trading into the bell.
All right, welcome back to the final round. Time now to get technical. We are at the Wi-Fi Interactive Touchscreen with Jared Blickery. Jared, market not doing a whole lot. We are looking at a record close right now, but fading a little bit off the day's highs.
Yeah, if we look at the intraday price action, the Dow, which is up 35 points or a whopping 12 basis points, lots of squiggles and squaggles here, but really not a lot of range. Just kind of an uneventful day. S&P 500 up a bit more, about 1/3%. We can see we're rushing to new session highs right now, approaching 3330. That 3333 was a Bank of America target. I think the first ones who called that out maybe a year ago, maybe mid-year. I think it was after the trade war concerns were receding, so 33.33 on the horizon there. Russell 2000 underperforming today, had been outperforming even with the expanding yield curve, not able to make it happen. Take a look at the VIX here. That's hovering above 12. That's a pretty low level for the VIX. And I'm not going to go to the longer term chart. We've done it many times, but that's poised to break out sometime in the next day, week, months, whatever. And then finally, the 10-year T-note yield. That's up 3 basis points today, but not really seeing a lot of the factor and sector rotation that goes along with it. Utilities is outperforming today at a record high, along with 8 sectors of the 11 at record highs.
Well, speaking of Bank of America calls, I remember Mike Hartnett calling for NASDAQ 8,000. How quaint it was. NASDAQ now approaching 9,400. I want to talk about the VIX quickly before we head to break, and just what's happening next week with the VIX, with the futures contract. Some people are, looking at that roll, right, from the January to the February front month, and looking for some kind of volatility there. Obviously, there's trauma from 2018. You and I were discussing earlier market conditions today versus where we were a couple years ago ahead of Volmageddon. Any of this concerning you right now, or does the market seem to be in a healthier place?
I think the market's in a much healthier place. A few people saw Volmageddon coming, and they're not seeing the warning signs. But as you said earlier, the purpose of a black swan is that you don't know where it's coming from. We got too many eyeballs on this particular problem, probably be something else. I can guess what it is. I just want to access this tweet you guys were talking about before, and this regards Jeff Bezos' shirt. If this doesn't say what you really need to know about interest rate policy in the U.S. dollar, I don't know what does, Jen.
Well, okay, so Jen is very upset that I said I would wear this. What say you, Jared?
Ugly.
Yeah, I'm not upset that you would wear it. It kind of looks like the cow suit that one of our futures guests wears.
That's right. That guy's on all the time.
I love the guy and his content as well. As far as this, how much time do we have, by the way?
We have about 10 seconds.
Oh, thank God.
Would you wear it?
No.
Okay.
No.
Claire.
You know what, Jen? I've got about 5 months till my birthday. You can get me this jacket.
Oh, that thing is way too expensive.
And then I will wear it on the final round. All right, coming up on the other side of this break, we will have the closing bell. Plus, we'll talk about UBS getting bearish on Twitter ahead of election season. It's our final round call of the day. We're back with that right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udland and Jared Blickery, and we are just moments away from the closing bell. There it is, looking like we are going to close at record highs on the Dow, the S&P 500, and the NASDAQ. 8 of 11 sectors at records as well.
Intraday.
So, closing out here, record highs on the 3 major indices. 8 of 11 sectors, intraday record highs. Who didn't get in the party, Jared?
Real estate, and it's not that far from a record high itself. And then you have energy, which has been downtrodden. That is the dog of the sectors. And also one more, materials. That's about 8%, maybe 10% off of its record high. But I mean, this is about as broad-based as you can get. But this is also what happens persistently for long times. Eventually you get a top. Tops are very difficult to time because you don't really get a lot of clues until you see that first big downdraft. And a lot of times that's scary, and people then want to hang on. And that's human nature. So the job of the market is to keep people on the wrong side of it. And it does a pretty good job of that a lot of the time.
Another rally into the close.
Yeah.
Yet again. I mean, every day this week it seemed like we saw a frenzy of buying. The old 330 ramp looks like it's back in session here.
Yeah, from back in the day. I think 2009 was the first time I had heard of that. No association with Ramp Capital.
That's right. Yeah.
But we have so many records here. It's interesting, the sector leadership today. Utilities leading the day, not only today, but also for the week, which is interesting because not really correlating with what interest rates have done. Then you have communication services, Facebook finally breaking to new highs recently, Alphabet becoming $1 trillion company. Lots of stories behind these movements. Real estate, although it didn't reach a record high today, was the third best performer of the week. And to the downside, energy, just mentioned that, consumer discretionary, Amazon a big part of that, kind of a laggard, even though it jumped up a couple weeks ago, really hasn't been able to add to those gains.
Something else we've just been watching are the number of 52-week highs. Oh, it did come down a little bit, actually. I was looking. No, it's still there. NASDAQ, it was so close to 400, 399.
NASDAQ?
Yeah.
I'm looking at...
NYSE,
yeah.
336. And NYSE has just been single-digit new 52-week lows every day this week. I think we have 7 today.
Yeah, and this could spike higher. So it's strong. You want to see the breadth. You want to see the new 52-week highs expanding. That's what's happening. They kind of reverse on a dime, so there's really not to be done in terms of a timing signal there. But so far, so good. I just don't see any cracks even under the hood just yet. We have a lot of things that we can look out for, but that's all we can do.
Visa, your new favorite stock.
My new favorite stock.
Your new favorite stock.
Yeah.
Biggest performer in the Dow.
Everyone else in the universe loves Visa.
But anyhow, it's the best performer today, up more than 1.5%. And another day here where we do not have a move greater
than 1%?
Than 1%.
Yeah.
So
we've now got, I believe it's 70 sessions, yeah, something like that. We were at 115-ish, 120, somewhere around there before the February 2018.
Crypto doing really well this year.
Yeah, you know,
Bitcoin's up 25%, Ethereum 30%.
We didn't get a chance to talk about crypto over the touchscreen, but we said Bitcoin closing in on 9,000. I don't think it hit it today.
Yeah, I keep hearing
88.91, I'm saying.
Yeah, I keep hearing people talk about the expansion of institutional interest, whatever.
I know, keep seeing stories on that.
I think that's part of it, and that's really the long-term story. But there's no reason why recently it should have done that. It might have been the Iran conflict. We've seen this before where people want to move large amounts of money.
Yeah.
And Bitcoin and crypto, it's catalyst. So take it if you can get it.
Maybe they're pricing in the halvening.
The halvening, yeah, in May.
Yeah.
A little bit early.
Well,
we had Tom Lee on earlier. He was talking about granny tosses in basketball. But I asked him a question about Bitcoin.
Oh, he talked about, okay, sure. I didn't see that segment. I knew he was on there.
So I asked him about Bitcoin too, and had some bullish thing to say, not surprisingly.
I was going to say, I'm shocked.
Well,
shocked.
Yeah. I'm a long-term bull as well.
All right, for more on today's market action and this close at record highs, let's go to Inez Ferre. She's live on the floor of the New York Stock Exchange. Inez.
Miles, record highs again for the markets, and I just want to point out that the traders here have been pointing out that we are just about 2.2% away on the Dow from reaching 30,000. too early to talk about it now. Okay, let's talk about the Dow leaders. We're looking at Visa, which today reached another high. Also Dow Inc., Travelers, Home Depot up more than 1%. There were some good housing starts numbers that came out this morning. Also Apple, some Wall Street analysts had increased their price target on Apple. And then looking at the laggards, those include Boeing, down about 2%. This is after Boeing said it identified a new software issue during a technical review of the 737 MAX jet. Chevron, United Health, Walmart, and Disney down fractionally. And then I just want to look at the S&P 500 and the NASDAQ. The best performer on both of those was Qualcomm. Qualcomm up more than 4% today on the heels of an upgrade from Citi. Remember that the markets are closed on Monday, so I will see you guys here on Tuesday.
All right, Inez, live from the floor of the exchange. Have a great weekend. Talk to you Tuesday.
You too.
Time now for our call of the day, and today it is all about Twitter. Analysts at UBS downgrading the stock to neutral, saying they see the company at a bit of a crossroads entering 2020 in terms of capitalizing on opportunities like the Olympics, European Football Championship, and of course, the U.S. election, all while keeping the network safe and secure. So, Jared, on its face, you would think 2020 would be a fantastic year for Twitter because we have all of these big events happening, going to drive traffic there, users, DAUs, engagement. What's the concern for UBS?
Costs, and they got some heavy R&D costs that they're investing in this year to beef up their security, also their ad tech, and so this UBS is saying that they expect OPEX to grow 17 to 20%. That's greater than the consensus. Based on that, margins kind of under pressure here. They're saying we're just going to kind of downgrade this to neutral. And you look at what the stock has done or hasn't done over the last 2 years. It's been in a big trading range, basically 28 to the downside, and let's see, to the upside here, it's about 47, 48. And until it does something convincing, and it's trading well below its 200-day moving average, as it has since it had a huge miss in October, I'm not going to get excited about this stock.
And remember, they had a big miss, I think it was a couple of quarters ago, because they had their own sort of internal error where they couldn't serve ads that had been promised, and they had to take a loss on that. They had to refund customers. And so I think when you have this expected cost cycle coming up and you've had the documented issues with that over recent quarters, and the last couple of years, it's had its ups and downs, right? I wouldn't say it's been dead money over that period. I was looking at the chart on Yahoo today. From today's 2-year period back in time, it's up 40%. So you'd take that, but you could measure it from a lot of different points along there, and you're not making money. And so remember, this thing used to be in the teens, and a lot of people did quite well riding it from the teens to that $40+ mark that we're looking at. But since then, it's kind of hasn't been quite as inspiring. It was, in a way, right? It was Snap before Snap.
Yeah, and the speculation is what's going to happen with Jack Dorsey. Is he going to remain the CEO along with being the CEO?
And you wonder, is he the CEO just because there's no one else to be the CEO, right? I mean, I think there's been
Elon Musk is not available.
That's right. Although Elon could add it as a responsibility, but you look at kind of the tenures of Anthony Noto. It was fine, but it wasn't great, and there's been some turnover there at the high levels of the company with who can really crack the code on Twitter.
Yeah, it's just been one of those struggling, kind of lagging social stocks. Kind of got off the ground in the beginning and just hasn't produced over the last few years. But they're retooling right now. And technical position could very well change in the second half of the year, which is when UBS wants to reevaluate.
And everyone uses it a lot, too, so they got that going for them.
Well, yeah, including Elon Musk and Donald Trump. What happens if he's not reelected?
It's like the leader of the free world is all over Twitter, but they can't monetize.
It's interesting looking at, we know Snap has really outperformed in the last 6 months, but
it's $20 now.
Twitter and Pinterest are, kind of neck and neck here. I know Pinterest has been all over the map. Got a kick out. If you go out a year, obviously Snap has just been a monster, but Twitter and Pinterest aren't too off in their returns, these little niche social plays. Some breaking news right now. The Wall Street Journal is reporting that Best Buy's board is investigating allegations that chief executive Corey Barry had an inappropriate romantic relationship with a fellow executive who has since left the electronics retailer. The allegations were sent to the board in an anonymous letter dated December 7th. The letter claims Ms. Barry had a romantic relationship for years with former former Best Buy Senior Vice President Carl Sampt before she took over as CEO last June. The Wall Street Journal reviewed a copy of the letter this week. So Best Buy shares selling off a little bit here. Of course, Best Buy, in its not too recent history, got to go back a couple years, had another kind of scandal like this, right, Brian Dunn being pushed out of the company. Of course, we just had McDonald's as well. We've had this at Intel. You know, there's a lot of examples where we've seen this play out. Again, this is just being reported by the Wall Street Journal here. A little bit of news on Best Buy.
All right, and coming up here on the final round, we'll take a bite out of the big plant-based protein craze with one of the big players in the space. But first, let's take a look at some of the companies involved in that fake meat trade and how their stocks moved on this Friday. All right, let's take a look at some stocks that were on the move during today's session. Gap, the apparel retailer, last night abandoning its plan to spin off Old Navy into a separate publicly traded company. That stock popping on the news. Let's take a look at shares of CSX. The railroad operator reported better than expected quarterly revenue quarterly earnings, but revenue dipped below estimates. The company also warned of another challenging year in 2020 despite efficiency improvements. And Comcast, after NBCU unveiled the multi-tiered pricing model for its new Peacock streaming service on Thursday afternoon. You know, I was thinking more about that conversation we had yesterday. The one that I still don't get is the early release of the late night shows.
It is odd. I haven't gotten my head around it.
They're not releasing Saturday Night Live early, are they?
Well, I don't know.
It's live.
It's right. So
Good
they can't.
point, Jared. That's why they pay Jared the big bucks.
Medium size.
It's just, I mean, if I'm a broadcast partner, I'm like, what are you doing? And also, is there really is that what people, they just need Jimmy earlier? Or are they only watching him because they couldn't sleep in the first place?
New constituency, people who are getting off the game shows and just want that Jimmy fix a little bit earlier. They would have missed it otherwise.
I mean, but seriously, my 90-year-old grandmother she likes Kimmel, but she watches that because she can't sleep. Like, she's not sitting there like, I wish I could get this earlier. She's just like, there's nothing else on.
I would like to watch it earlier.
Okay, well, there you go. You are the target audience.
2019 brought the fake meat trade front and center. What is next in the food space. Excel Foods is an early-stage venture fund investing in consumer products, including high-quality food and beverage companies. Jordan Gasper is managing partner, and she joins us now. So, I mean, we get to talk about Beyond Meat, Impossible. We've been talking about them now for months, and I'm kind of trying to figure out where we are in the evolution of the plant-based food, because to me now I'm like, is this the middle of the baseball game, or are we still at the beginning? We've just been thinking we've been talking about it a long time.
So it's important to understand that we are a fund that's invested in 35 companies, and we have $105 million under management, and of those companies, 2/3 are plant-based.
2/3.
So we do believe that the horizon ahead is going to continue, and that we're in early days here.
Now, sorry, no, go ahead. Sorry.
No, I think that plant-based diets are something that we always had available. Soy and almonds aren't new. I think that there's just new flashy terms that people are using that make it more approachable, and there's more options available as alternatives.
So when I think about plant-based products right now, we're talking about meats, and I think we're talking about substituting, whole meals. But is that kind of where you're seeing a lot of activity, or is it still? Or is it maybe like foods that are more snacky or smaller parts around the diet that are plant-based? Because, when I think of a snack, it's like, yeah, it would tend to be a plant-based product, right? It's a piece of produce or something, granola perhaps. But so where are you guys seeing that opportunity? Is it kind of the meal itself, or are these companies that are looking at meal-adjacent parts of the diet?
So it's both. I think that we've taken a considerable stake in a company called Alpha Foods, which is a plant-based protein platform that's in a convenient meal solution. It's portable, so burritos and tamales and pot pies. I think that it satisfies a lot of the consumer demand for a meal solution rather, and it is a snacking option in some ways. But I think that what we're seeing is investments are going into both meals that satisfy kind of a complete solution, and also on-the-go portable snacks. Beverage is another category we've been investing heavily in. We're an investor in a beverage company, functional beverage that's refrigerated, called Koya. Koya is 18 grams of protein, plant protein, and so
in the drink. What does it taste like?
It tastes delicious, and it's expanding rapidly. And conventional is an unbelievable market for the company. And so, this is a product that was born in the natural channel in Whole Foods, and you have Walmart, as a key partner. So it's pretty exciting to see that these products are not just available in sort of the natural channel, but have now spread to convenience. 7-Eleven's done a great job in opening up their offerings for natural products. We've seen conventional. We're seeing that in general, food service, obviously a lot of highlights from Beyond Meat. QSR has opened, and that's pretty exciting, with Starbucks and Dunkin', now thinking about their commitment to oat milk. So.
Yeah, just thinking about some of the larger players kind of getting into this, like Tyson and Nestle. This is, and as you say, this is in the beginning stages. The pie is still growing, but how do these bigger players and what they're doing affect the way you invest, if at all?
It's a great validator, and it's ultimately an opportunity for a partner ahead. And so a lot of these venture arms that are coming off of the strategics are focusing on plant protein and plant-based products more broadly. I think that we've seen most of the strategics really have embraced the idea that this is a way to meet their consumers and customer demand. So they're either innovating their own holdings, or they are investing into these young, authentic brands like we are.
We had Michael Pollan in, who wrote The Omnivore's Dilemma, famous foodie. We were talking with him about some of the early plant-based food offerings. And you were just talking about how they're not really that healthy. There's a lot of salt. We've been hearing that from other people as well. Do you think that's an issue going forward, or is that just these early offerings? Is it going to evolve and become healthier, less sodium in the future?
I think that there are early offerings, and I think that as innovation develops and matures, it always does improve. And so in the same way that everything's now low sugar, and there's been a huge reduction in sugar, there will inevitably be an increase in focus on sodium. And that's also going to be a function of consumer palates changing. And if you think about the products that we all grew up on versus the next generation, their expectations of what food will taste like from, a sweet and a salt perspective will be a little bit more evolved.
And then, you mentioned portability. Is that around people wanting to more simply get their, grab and go kind of style? Or is that about anticipating the future of food delivery? Because I know as a shopper, I'm more reticent to buy groceries, for example, online because sometimes they don't travel, or the bag gets hit and all that stuff. Is part of the way that these companies are thinking about, the companies you guys are investing in, thinking about packaging it, assuming a larger percentage of grocery delivery out 10, 20 years than we're seeing right now?
So when we look at portability, we're actually thinking about the actual products. We're thinking about a beverage or a handheld solution, something that meets an on-the-go lifestyle that someone can actually pick up and carry with them. I do think that e-tail is a huge area of focus. There has definitely been obviously highlights of coming from the Amazon Whole Foods deal, and that omni-channel distribution is changing food and beverage pretty considerably. But we've seen that from our perspective, portability is more a function on how the consumers are adopting the product.
And then you talked a little bit about distribution, but just quickly, is direct-to-consumer a model that is going to gain credence in this space, or are we still going to be looking at the traditional, you mentioned convenience, grocery, those kinds of channels for getting these products out there? And obviously, go back 20 years, the only thing people cared about was shelf space. Is that still a big part of this business right now?
It's such a good question. Yes, shelf space is still really important, and I think it's increasingly going to be understood that you can't really negate the impact of Walmart in your distribution or Costco. I mean, these are huge players. So I think it's a great opportunity to be able to sell products online, but a lot of the products that are coming to market are refrigerated and are frozen, and so that distribution is still really challenging, and so you have to think about kind of the challenges that come in from taking a product from point A to point B when it has to be cold chain stored.
Generally speaking, is the home run for the 35 companies you're investing in becoming a publicly traded company or getting acquired by a legacy big player out there?
It's such a great opportunity to have an IPO in this space. And I think it was something that's very atypical for our industry. I think for the vast majority of the companies in our portfolio, we anticipate it'll be a strategic acquisition or even a financial partner. We're seeing that private equity, particularly later stage, is getting increasingly focused on the food and beverage space.
Really interesting. Jordan Gasper is a managing partner at Excel Foods. Next time we have to eat some.
I know.
I'm not sure about the protein drink. The protein drink. It's a lot of protein.
It's like
a lot of protein.
Well, it's like Soylent, but it doesn't suck.
Yeah, we did the Soylent, and I couldn't.
No, Soylent is bad. Muscle Milk's good though. That's the original. All right, coming up here, we'll have what we're watching next week in the Look Ahead. Plus, it's the second biggest uncut diamond ever found. So why is LVMH looking to carve it up? What does Bernard, Jen? Arnault, LVMH chairman and France's richest man have in mind? We'll discuss coming up after the break.
And now here's Miles with a look ahead at what will be making headlines next week.
All right, the World Economic Forum at Davos kicks off on Tuesday. Every year, this event is kind of an eye roll. A bunch of rich people, thought leaders, and politicians get together in the obscenely expensive Swiss Alp resort town and talk about saving the world. But for investors, the event is at least worth noting because in each of the last 3 years, it's been a great contra for the market. In 2017, Reuters said the event's mood was anything but celebratory, and then in 2017, the S&P went up about 20%. Now, go forward a year to 2018, Ray Dalio said you look pretty stupid holding cash, and our own Andy Serwer said that attendees called the mood the best in memory. Stocks then endured their worst year since the crisis. Last year, the AP said the economic outlook was darkening as the world's wealthy descended on Davos. And 2019, as we all know, one of the best years for financial markets this century. And so you are welcome to ignore all the do-gooding talk of the disassociated executive class in the week ahead. It's more than a little self-serving and off-putting. But there have been worse ways to get a sense of how the market won't trade in the year ahead than by simply fading the mood at Davos. So maybe pay some attention, if for no other reason than you'll hear what not to think in 2020. Now, turning to the calendar for next week, on the earnings side, things will get increasingly busy. More than 40 members of the S&P are scheduled to report their quarterly results. Results from Netflix after the close on Tuesday should be one of the week's big highlights. Investors will also track results out of IBM, American Airlines, United Airlines, Southwest Airlines, Procter & Gamble, and American Express. And then on the economic data side, things are going to be a little quieter. Existing home sales, initial claims, and the first look at manufacturing and service sector activity in January will highlight the schedule. And don't forget, the week ahead is a holiday-shortened one. U.S. markets are closed on Monday in observation of Martin Luther King Jr. Day.
Fun week ahead. And
Four-day weekend for some of us.
Yes.
4-day weekend for some. 3-day for others.
I'm taking Tuesday.
Oh.
But now I'm sad that I'm taking Tuesday because Netflix is reporting.
Oh, right, yeah.
You missed a big one.
Well, Jen, you only get 4 of these a year. Tough.
You learn so much in the look ahead.
Plus, the thing with Netflix is they have a great letter.
I know.
It's always fun to go through the letter.
Maybe I'll change my mind.
Oh.
Maybe I'll just bring all the kids to
We didn't think
work.
about this. Well, Shauna's supposed to be on the show, but she usually does the earnings for us.
Oh.
So we're going to have to. Maybe I was going to say, maybe Jared will do it.
I'm going to be sitting with Shauna on set for the rest of the day in case something goes south. So I'll just do the earnings myself.
Okay, so Jared will do on the 9th floor. He'll break the earnings.
Right. Any other producer paperwork we got to get out of the way
Good.
here?
I'm so glad we figured
No, we'll
this
send
all out.
emails over the weekend. Okay. It's fine.
Louis Vuitton is making its ambitions in the luxury jewelry market known in a big way with yet another extraordinary purchase. The French brand has purchased the world's second largest diamond. It is a 1,758 carat jewel. It's the size of a tennis ball. It looks ugly there, but it won't be when they're finished. It's called the Sewello diamond. The diamond will be polished and manufactured into a number of smaller jewels. I don't know, like marble size maybe, not tennis ball size.
100 carats is a lot, right?
Yeah, I mean,
okay, just checking.
10 is a lot. According to a press release published on Wednesday,
1 is a lot.
a price tag is yet to be put on the stone. But when the world's largest diamond was sold in 2017, the cost was a hefty $53 million.
Yeah.
I don't know.
It's a good PR move. Kind of talks as to the exclusivity factor, but diamonds, those are, wow, they still are forever, but they are reproducible now.
Now they're synthetic. We've had them on the show. They can make diamonds.
What is just bizarre about the synthetic diamond thing, and we've talked about this a number of times.
Says the man who's getting married.
Forgive me. Well, look, I purchased a real one last year. Well, but the lab-grown ones are just as expensive.
Yeah, well,
they were like a little bit less.
But they're 5 to 10% less expensive.
But they're brilliant and their color is perfect.
Right, but I remember being like, oh, maybe I'll look into the lab-grown one, but like, no, they're just expensive. And I actually know someone, his fiance wanted about to be fiance, wanted a lab-grown diamond. Yep. He bought it, went to a real jeweler and needed custom work done or whatever. And the first guy I went to took it, wasn't so sure about it, then called him a week later and said, you know what, I can't work with this. He's like, it's not real. It doesn't feel right to me to do work.
Because it was flawless.
On a lab-grown diamond. Yeah, so he had to find another place. This was like a week out from his proposal. So now he's scrambling to get this thing done. It worked out, but, you know,
Well, that's because that guy probably sells real diamonds. And
of course, right.
I mean,
you can't
get a fake moat.
How long did De Beers have a complete
down.
stranglehold on the market? 130 years? I think it's probably the most successful monopoly, oligopoly in history. I don't know of any other, or cartel, let's call it that, that has survived as long. OPEC certainly.
Probably JP Morgan, right?
Oh, yeah. Record high, guys.
The Fed.
Record high.
The Fed is the most successful oligopoly of all time.
Jekyll Island.
Jared Blickry, have a fantastic weekend. You'll be here Tuesday. You've got Netflix earnings and lots of other fun stuff to get ready for.
Yes.
All right, and coming up, we'll have more on the final round, plus our top take. Another tech giant joins the 4 Comma Club. Big tech's biggest, now worth over $5 trillion combined. It's almost 20% of the market. What could go wrong? We'll discuss coming up after the break. Welcome back to the final round here on Yahoo Finance. Miles Sullivan with you in New York. I'm joined as always by my co-host Jen Rogers for the final half hour of this program. Let's take a look at where the market settled on this Friday. All 3 majors finishing at record closes. Saw a little bit of a buying push into the close. I guess we might as well just talk about Dow 30,000, and as reminding us, we're only about 2.5% away.
That can happen in a day. I mean,
sure, why not?
A big day up, and there you are.
Who's to stop this market at this point? But certainly, the good times continue. We'll see what happens as we head into the teeth of earnings season. Netflix really starting things off for the big tech names next week. And speaking of,
let's turn to our top take stories we're watching in today's market, and that's big tech. Now worth over $5 trillion with a T dollars. That's thanks to Alphabet, the Google parent company, became the 4th U.S. tech company to reach $1 trillion in market value. Follows in the footsteps, of course, of rival tech titans Apple, Microsoft, and Amazon. And if you just want to throw in Facebook for good measure, these 5 tech companies now account for over 17% of the S&P 500, continuing to attract investor dollars despite intensifying regulatory pressure. And it's also attracting a lot of attention from people wringing their hands over this. Oh, gosh, these 5 companies are worth so much, and they're concentrating all of this attention, and 17% of the S&P. Is that unusual? Is it bad for the market?
Well, it is factual that it's the highest percentage concentrated in the market's 5 biggest companies since the tech crisis, right, since 1999. Now, of course, last year, the 5 biggest companies accounted for around 16% of the market, so it's not like this hasn't been in place for a little while. I am old enough, and you were old enough to remember the market of 2016 when we saw the S&P, or 2015, the market was flat for the year, but the market's gain, so 108% of the market's gain, even though it didn't go anywhere, was attributable to these 5 companies. I think it was plus Home Depot and a couple others, right? So we've seen concentration in this market. We see concentration in every market. It's not in and of itself a bad thing. It's just kind of a thing, right? I mean, I guess,
you gotta accept
like,
it.
I guess you can sit there and say, oh, just, you know, one of these goes bad and it's all bad. Like, you could say that, but like, it's not like this market doesn't have a lot of other positive, bullish trends around it. You know, we talk about breadth, rotation, sector leadership, all these kinds of things. 8 of 11 sectors hitting record highs today. Like, all that stuff points to a market that's on reasonably solid, broad footing. But yes, these are large companies that have an outsized weighting. So I'm contrite.
You are zen about the whole thing.
What's your view? I feel like you might be nervous.
Yeah, I'm just a little nervous, having done the 4 horsemen ride before. With the .com.
All generals fight the last war.
I know. I'm still well. I skipped the Great Recession, I guess, and I'm just going back.
It's not like you weren't there for the recession, but for some reason, I like when the WeWork thing came up, you were just Enron all the time.
Yep, I got to go back.
You've seen many scandals since Enron, but Enron is the one.
I'm scarred.
And WorldCom and Bernie Ebbers and all that stuff.
Well, we'll keep watching it.
I'm going to be fine.
I'll watch it.
I'm going to be comfortable.
I'll watch it.
All right, Sotheby's and streetwear website High Snobiety are teaming up for a new streetwear collection inspired by old master paintings. And joining us now to discuss is David Pollock, Sotheby's Senior Vice President and Yahoo Finance's streetwear maven. There you go. There's your title. Reggie Wade stopping by. So David, I guess just start with thinking about this collab and kind of where streetwear has gone. I mean, I think a few years ago, people would not be imagining Sotheby's is the kind of brand that is looking at streetwear as a real opportunity for them and their core customer and the people they're trying to reach. But certainly, we're in a new paradigm with where that all is going.
Yeah, I mean, we've been merging into some of these different fields. I mean, Reggie was talking about before we came on the sneaker sale that we had a little while ago. So they're absolutely, we're looking to get into these new fields. And, you know, I think that actually the collaboration has been one that has taken us a little bit by surprise, the pickup that it's gotten. You know, to have Old Masters on hoodies and t-shirts is not something that people would have expected, which is exactly why we love it. You know, they approached us, High Snobiety, that is, approached us to put Old Masters on some of their merchandise, and we loved it. You know, we thought that it would be a way for us to bring Old Masters to a new generation of collectors. You know, we have a really wonderful and dedicated collecting group, but to bring these types of pictures to a new generation, those types of folk that wear Jordans and wear Yeezys, we were really happy to do that.
Can I just ask a dumb question here? Old Masters, is this like all the famous paintings I'm supposed to know?
This is all the Rembrandt you're supposed to know, the Leonardo da Vinci's, all your trips to the Louvre, that's what we're talking about. Old Masters.
I just want to feel
Yeah, feel the good. They're beautiful.
And I mean, so you said they approached you, and they're very thick, you guys.
Good
they're
stuff.
Very
thick. High quality.
Was it a really easy sell when you had to take this up the flagpole, or you just decide on your own and people?
No, no.
You really like, all right, guys, let's just do this, or there's no debate inside Sotheby's?
We are all about bringing Old Masters to a new demographic. You know, as I said before, there's a whole generation of collectors around the world who, of course, know who Rembrandt is and who Rubens is, but for a lot of people, they don't, right? And so myself, you know, I've been with the company for 11 years. That looks really good on you. To have a 16th century allegory of abundance on you
on the show.
is looking really great. But a lot of people don't know that. They don't know who these artists are, and so this is what it's trying to solve that problem.
Now, Sotheby's have done work with Victoria Beckham and other celebrities. Who are some of the celebrities you would envision going in on this new streetwear line that you guys have?
Well, we've all seen, of course, you know, Jay-Z and Beyonce posing in front of the Mona Lisa. You know, we want to work with people who believe in heritage, believe in quality, believe in rarity, and if they're doing that in their own field, we're happy to collaborate with them.
Will you be doing anything around sneakers coming up? And speaking, so their Beyonce sneaker line and streetwear line drops tomorrow, Ivy Park. Would anything maybe you could break on that? You do anything?
If Beyonce wants to work with us, we're happy to listen. I can assure you that.
Wait, but could you see having any Old Master sneaker tie-ins, or is it mostly going to be just clothes?
For this collaboration, it's clothing, it's hats, hoodies, T-shirts. If it's really successful, of course, we're happy to think about what could be next. Yeah. You know, the line drops on the High Snobiety website on Monday morning, 9 a.m. It's a really rare limited edition run.
How limited and how much is this?
I think it's going to be about 400 to 500 pieces each. So, you know, I think that's also why I think this is the streetwear hypebeast community. Actually, there is really great overlap with the Old Master community because it's all about rarity. It's all about getting these objects as they drop, and we're a one-of-one, you know, group.
And so I guess, I mean, and if you guys might not have an answer to this or haven't thought about this, but when I look at, like, you know, these collabs that Reggie's kind of talking about, I always go to StockX and think, like, do they want there to be a resale market in this? Remember we had the North Face coats a couple of months ago, and like the resale was a double markup, and I don't know if they're happy about that. Have you guys thought about how this might play in the secondary market, or you're just kind of to see where this first collab goes? And
I think we're seeing where this first collaboration goes. Of course, you know, Sotheby's, we are a
secondary
secondary market,
right? Yeah.
So I mean, we're very used to this. How popular these items end up going, we'll see.
Yeah.
You know, the prices are starting about 65 euros, 125 euros for the hoodies. So I would be surprised if they were selling for 500, 1,000, but you never know.
What's the art market like these days?
The art market's huge. I mean, generally, where the art market has been very, very strong since 2009. Of course, the world took a turn. Since that moment, the art market's been on an upward trajectory. Obviously, I think it's the contemporary art market that gets a lot of the headlines in terms of the very big prices. The Old Master market, these objects have been in circulation for literally hundreds of years. So traditionally, you would say that we're a steady market. When great paintings come up, they make really big prices. So we have a very, I would say, upward but flat, good market. And when a great rare object comes on, it can make, you know, many millions.
Were there any Old Masters that you wanted to use that you couldn't?
Well, all of these that are being featured on the T-shirts and the hoodies, these are all coming up in our sales, which the exhibition begins next Friday. So, you know, we're promoting, we're thinking about it. None of these are in museum. These are all going to be on view starting at Sotheby's next Friday. But they're not necessarily our most expensive paintings or highlights. These are visually arresting images that we thought would appeal to a wide range of
Yeah, and I think it's just interesting thinking about the streetwear trend and what, like, on the clothing, there's a description of what the item is. You know, like, I think there's this tendency towards, you know, you can, like, there's a jacket that says jacket on it, right? And I think that's just an interesting clothing trend.
Yeah, we want to
comment into the ether.
We want to teach. You know, we want to look cool, but we also want to tell you what you're looking at for sure.
All right, good stuff. Interesting. David Pollock with Sotheby's. Thanks for coming by. Reggie Wade, have a great weekend. Coming up, the Astros cheating scandal deepening. We'll hear from MLB All-Star pitcher Trevor Bauer, who has his own information on Astros players wearing buzzers underneath their jerseys. We are back with that right after this.
Another baseball manager was dismissed Thursday when the New York Mets fired Carlos Beltran. There are also new allegations that Astros batters wore buzzers at the plate to indicate which pitch was coming next. Cincinnati Reds all-star pitcher Trevor Bauer joined Yahoo Finance's On the Move earlier to break down what the scandal means for MLB going forward. Take a listen.
Yeah, there's a lot of moving parts to this. Some things that people may not understand is Manfred is basically voted in by the owners. So if you hammer the Houston Astros organization, then that makes their organization worth less, makes everybody's organization worth less. It's not good for the business side for all the owners, right? So there's that part of it. The players side, it's really hard to prove who used what, when, to what extent, or like, if I'm a hitter and I go up there and I don't want anything to do with this, but someone's banging on the trash can anyway, then am I now involved in it? Do I give it? It's a really slippery slope. I actually think he's done a pretty good job of walking a middle ground. I think that, you know, there's going to be people on both sides that say it's too harsh, it's not enough, but I think he's done a decent job balancing the whole thing.
I've heard a lot of people say that in terms of how damaging this is for the sport, it's the worst scandal for Major League Baseball since the steroid era. But I think arguably in some ways it's worse than the steroid era, because that was individual players. This was a coordinated effort by a lot of people on one team, players, also at the employee level, although Manfred's note says lower level employees. I mean, I think this is the worst thing since the Chicago Black Sox, you know, in 1919. But how damaging is this for the sport? Because regardless of what additional punishments or firings come, people are going to remember this for years to come, and there's an issue of fan trust.
No doubt about that. It's a huge black eye for the sport, and I would tend to agree with you that it's worse than the steroid era. Look, you got an individual, or many individuals that are on steroids perhaps, but you still have to compete and hit the ball. You still have, like, you don't know exactly what's coming. Perhaps the pitcher's on steroids and the hitter's on steroids. Now it's in some ways a fair playing field in that specific matchup, you know. So, but this is just, you know, it's a big black eye. I think it's definitely like up there with the Black Sox scandal, and yeah, hopefully we can just get it all come out now. Let's get it all out, clean the game up, and then we can move on, because fan trust is an issue that MLB struggles with.
Yeah, you know, all the blood is coming out for sure right now. And last night you were already being very vocal on Twitter. You're a very outspoken player. I know that people say, well, sign stealing has always been an issue in baseball, and it's kind of rampant. But there's obviously a difference between kind of casual sign stealing that maybe happens all the time. And, you know, even in football, people try to read the coaches, what they're saying. There's a difference between that and having a coordinated effort involving cameras and, you know, banging on a trash can. And now the new allegations of buzzers. I mean, where is that line? And what do you make of the newest allegations, the buzzers? Because MLB has already responded to that, but not a lot of people buy it.
Yeah, so I'll start there. I've heard I have to preface it by saying I don't have any inside knowledge directly of the situation. I've never played for the Astros. But I've heard from 3 independent people that don't know each other, that this is a real thing, that it happened. So that's the extent to which I know of. I've been hearing about this for 2 years. Other players that I've talked to have heard similar things. So it's this kind of like inside baseball rumor that's been going around. And so that's what I know on that aspect. I think it's certainly within the realm of possibility technologically. Now whether it happened or not, I'm not sure. I'm not positive. But it's, yeah. So there's that part of it.
And then in terms of the line.
Yeah, in terms of the line, sign stealing has been going on for a long time in baseball. From the simplest stage of you get a runner on second base, if the catcher puts down one sign, the hitter might look one way or the other way to signal, or put his hands on his knees, or only one hand or something like that. That's generally accepted, and it's on the catcher, hey, switch up your signs. Then, we started getting replay review, and we started being able to see live feeds of the game. And so you would have people down there watching the game, and they would notice certain things. Maybe they see that the pitcher's hands are higher or lower. That's a form of it, right? And so this is all just trying to gain an advantage. And I think the conversation really comes down to what do you think is the biggest misstep here? Is it the time by which you can relay the signs? Is it the method of relaying the signs? Is it the fact that you're relaying signs in general? I don't think anyone in baseball is sitting here being upset with the fact that signs are being relayed. That's been part of the game forever, right? But how quickly can you get those signs? Do you have do you have a technology? Maybe you have some sort of computer decoding system that you input the the signals to, and so you can actually decode what the catcher is giving the pitcher. Is that crossing the line? I think it depends on what certain technology you decide is illegal or should be illegal or whatever, and then you can kind of decide on the line from there.
Depending on what now comes out, where do you stand on people calling for the World Series titles to be vacated? Something MLB doesn't really do. NCAA has done it. A lot of people don't believe in it. It's just a symbolic effort. And then, if you do vacate a World Series title, that punishes some players who presumably didn't cheat.
No doubt. I think that's the slippery slope there. I'm personally not in favor of vacating a title, because you don't know how it would have turned out, on the fair playing field. I think that that's one of the reasons I say that Manfred's done a decent job of kind of finding that middle ground. A lot of people are calling for it. Some people aren't calling for it. It's a tricky situation. It's a really tricky situation. So I don't have a strong opinion on it. I'm more so on the side of don't vacate it. It happened. We're going to punish people how we punish them, and let's move on.
All right, coming up, we'll have what you missed today here on Yahoo Finance, and we are back right after this. It's time now for all the best moments that you missed today right here on Yahoo Finance.
You know what's going to save Boeing? China Phase 1, all right? They have to buy a lot of manufactured goods from the U.S. The U.S. doesn't make a lot of manufactured goods, but Boeing, when things are operational, makes expensive stuff, and China needs to buy it.
It's a big black eye. I think it's definitely up there with the Black Sox scandal. And yeah, hopefully we can just get it all come out now. Let's get it all out, clean the game up, and then we can move on. Because fan trust is an issue that MLB struggles with.
Has anyone here in the last, 3 months been inside one of a Gap branded store, either Gap, Old Navy, Banana Republic? I've been in Athletic.
Yes.
Buy anything there.
Yes, and here's why, Banana Republic. But it's what we talked about an hour and a half ago. They always have a 40% off sale. So you can get a sweater that they always say is $75, and you get it for almost 50% off.
That's not good from a branding standpoint.
No, it's not good at all.
But it's good for Adam.
It's great. Look, I like Banana Republic, but I'm the generation. I will gladly point out that chinos and a T-shirt is not hip. I mean, your generation, that's not what you wear.
I have one T-shirt from the Gap.
That's it.
You know what I'm the generation that wears chinos and lines up in front of the fairway.
I quite frankly don't think that Netflix feels threatened by any of these entries. I think they still continue to see their competition, not Disney and not HBO Max, not Peacock, but they see their competition as other forms of television consumption.
Yeah.
I mean, still more than half of TV now is consumed linearly. And all of these companies will benefit from expanding into that category.
The real estate investing is going to really change, really quite dramatically over the next decade. There are really two dimensions of risks to real estate investments. There are the physical risks that we can see. It's the wildfires and the floods that are much more directly impacting property values and insurance costs. But there's also the need to actually very quickly green the portfolios of buildings.
I think we're going to have a good year ahead, but it worries me as we get into mid-year. What we got last year was we had a huge expansion in valuations. Earnings didn't do that much. And this year, even though we don't expect earnings to do much, we don't really have the room for valuations to go up. So I think it's going to be a much calmer year.
Final look right now at where the markets settled for this Friday. It's not that exciting on a percentage basis. It's not a
records
huge
count. All
move
records
to the
count,
upside.
Jen.
Yes. But that is every record counts. Every point here counts. Closing in on 29,350. Gosh, look at these numbers. It could just continue. As Jared said, it just can go like this.
They're going to get bigger over time, too.
Oh, wow. Wow.
Little heat check here on sentiment. One of my friends texted me about the regular stock market today. Just wanted to let everyone know, let my group of friends know that it was at 1,200 when we started working.
Oh, geez.
And now it's at 3,300. So,
You've been really good for the market. Russell down
Millennials, great for the market.
Smidge, but we had little ticks up here at the end. 8 of 11 S&P sectors also at 52. Oh no, all time. Not even just this year. All-time highs.
Peloton up 2% today. You riding that thing at all or no?
Oh my gosh, I tried to get on it today.
What happened?
I had to reactivate it because I hadn't been on it so long and I couldn't do it. And then
you just decided not to do it?
I just gave up. I was so mad. I have to call them and do something. It's really annoying.
So you bought a bike that has iPad-enabled stuff, and it's like, gotta call them.
Yep.
What is it? Okay.
Yep.
Fine.
Yep. Another reason maybe not to like Peloton. But I tried to ride it. That's it.
All right, you got 3 days to ride it now. Long weekend coming up.
That's all for now from New York. I'm Jen Rogers with Miles Edlin, and this is the final round on Yahoo Finance.